detailing that later on. And coming up, U.S. President Donald Trump says U.S. Steel should remain an American company, pushing back on its potential $14 billion sale to Japan's Nippon Steel. We'll have the latest with Joe Doe. This is Open Interest.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why. But we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Comcast getting downgraded to a sell over at BNP Paribas Exane. The firm citing earnings risks in areas such as advertising and media. Next up, we have Carnival actually getting upgraded over at Morgan Stanley. The analyst says that most of the bad news is already priced into cruise stocks, but you can see currently down about 8%. And finally, we have Ford getting cut over at Goldman Sachs. Ford is especially vulnerable to Canada's 25% retaliatory tariffs, since the majority of the cars that it sells in the country are manufactured in the U.S., Shanali.
And let's turn to another stock that we are watching, U.S. Steel, because President Trump says the steelmaker should not be owned by a Japanese company, suggesting that he does not support Nippon Steel's $14 billion bid for the steelmaker. Bloomberg's metals reporter, Joe Doe, joins us at the desk. You're seeing a big drop-off, and the reason you're seeing a big drop-off is because you saw a big boost the other day when he called for a review of the previous CFIUS review, didn't he? It's confusing, the messaging.
I mean, you really cannot make this stuff up. I haven't seen anything like this. We've followed this since August of 2023, and it's been a wild story since then. Monday, when the president came out and did the order to re-review the CFIUS review. A day later, Ancora, the activist investor, says they're actually withdrawing their activist trying to nominate the board and put in a new CEO. And it felt like kind of for the first time, like since March of 2024, that this deal might actually have a chance. And you were talking to the people invested in the stock, and they're like, well, this is pretty good. And then after a great day in the markets, right, you know, the stock jumped up to $46 along with everything else. That's the highest we'd seen since March 2024. The president comes out in the Oval Office and amid talking about steel generally, says this about U.S. Steel. And the stock immediately dropped off after hours by 16%. And I started getting calls and texts just saying, what the F? Right? I mean, this is really hard for investors to understand. The president has said, listen, I don't want U.S. Steel to be owned by a Japanese company or any other foreign company. He's made that clear. But the fact that in the background we had reporting that Lutnick was meeting with Nippon Steel and the activist investor, it felt very much like a Trump, let's get the deal done type of thing. But obviously he came out yesterday and said what was on his mind.
Well, I mean, I think it's pretty fair to say that on both sides of the aisle, steel is considered of national security interest, right? We have to have our own steel makers, but we do have others, right? We have Nucor, we have Cleveland Cliffs, we have Bethlehem Steel. So do we need to have U.S. Steel? Is that important for national security just because the letters U and S happen to be at the front of the name?
Listen, you don't want like a company to just go bust, right? And to be clear, U.S. Steel will not go bust if this deal doesn't happen. Like, this is not a company that, by the time the deal started to happen, it wasn't like U.S. Steel was where it was in 2015, there were serious questions about whether or not this company could survive. The company since then bought a bunch of mini mills down in Arkansas. They doubled the capacity down there. Investors liked that narrative. That narrative is what attracted so much interest in the market to buy the company. Listen, U.S. Steel is here. It is here to stay. The question is, how is it here to stay? Does Nippon Steel ultimately get this deal? I don't know. There's a 45-day review by CFIUS that's going to happen. The president then will make a decision. It's just that yesterday, the president came out for the first time in what felt like nearly 2 months and gave his latest opinion, which was Japan should not have a majority stake in this company. I don't know what to tell you guys other than it could change tomorrow or the next day, or he may actually just kill the deal. We just have to wait and see.
Well, we'll have you back when he does. I'm sure we'll see you again soon. Good luck covering the ins and outs here. That is Bloomberg's Joe Doe. Now coming up, investors hitting the brakes on CarMax after the company missed fourth quarter estimates and pulled its financial targets. We'll take a closer look next. This is Bloomberg Open Interest.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Open Interest. Let's get a check on stocks right now. We're seeing down moves after the absolute hysteria that accompanied buying yesterday. The S&P was up 9.5%. The NASDAQ was up 12% and change. So these moves down, normally, 2.25% off on the benchmark index would be a real problem, but they don't look so bad compared to what we saw yesterday, holding at 53.35. In terms of absolute levels, that's not great. Let me look quickly here at yields, because this is important to watch. We're going to talk to Richard Farley about leverage loans and the credit markets. A lot of people talking about a potential train wreck there, but it looks like that's been averted as well. In terms of individual stocks, you can see we have moves down across the board here of the big heavyweights, NVIDIA and Apple, Ford and General Motors off, as well as Stellantis and Tesla. A lot of car stocks there because we want to highlight CarMax right now. That stock sputtering after pulling the timeline of its financial goals due to macro uncertainty. It also reported worse than expected fourth quarter results. Bloomberg's Craig Trudell joins us now, our global car czar. And Craig, I figured CarMax has an ace up its sleeve because prices are rising quickly, both in the new car market and the used car market. Do they not profit well from that?
I think that may be a big part of why we're seeing the reaction here, because you have seen analysts come out and say, look, this could be a company that's essentially a refuge from all of this chaos when the new car market is going to have this big disruption, this big inflationary event. It's going to lead to a lot of consumers being priced out of the new car market. They're going to go to the used car market. And here's a company that's sitting on, an awful lot of vehicles that just got a heck of a lot more valuable. I think, of course, there's more to the story than that. It needs to go out and acquire more inventory for the used cars it needs to sell, and the wholesale market is going to be sort of turned on its head by all of the chaos that we've seen out of the Trump administration. So it's not necessarily as clean a story as it might seem to be, sort of on the surface.
Craig, what are the cross currents here? It's a great distinction to make between the used car market and the new car market. But ultimately, when you think about the state the consumer is in and potential pains, we're going to see it in the next couple of weeks from some of the big lenders here. Can consumers afford new or used cars with leverage in this coming environment?
That's a great question. I mean, just yesterday I saw a headline out of Edmunds, which is a car market researcher, where they noted that in the first quarter we saw a record share of new vehicle loans taken out that were 84 months or longer, and that is just sort of incredible. That I believe it was more than 20% of new vehicle loans taken out in the quarter were of that length of term, and so the consumer is absolutely stretched. We're seeing that in a lot of places, but in the car market in particular, especially since, to your question, the car market has never been sort of more unaffordable to the consumer than it has been the last few years.
Craig Trudell, our global car czar out of London, thanks very much for joining us. By the way, fantastic story by Gabby Coppola on the Bloomberg terminal about Audi's best-selling car. In the U.S., it's the Q5, right? A kind of compact SUV. But since it's put together in Mexico and they're not USMCA compliant, they're going to be a total of 52% tariffs on that vehicle.
That is quite the sticker shock.
That's unsellable.
So buying the tiny cars are not going to get you away from buying a more expensive car per se. Guys, can we check on these markets quickly? Because you were seeing almost every sector in the red today. Yes. A lot of negative feelings out there after that big rally we saw yesterday.
Indeed, you can see the S&P 500 down 2.5%, but still, that's not doing much to erase that 9.5% gain yesterday, though. As Shonali pointed out yesterday, we are still in the red for the year, Matt Miller.
Yeah, coming up in the next hour, Richard Farley joins us on credit markets. Did they almost seize up? Mandy Sue joins us on the options market. Plus, AOL co-founder Steve Case talks to us about venture capital. This is Open Interest.
building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The Dow dropped 800 points at the open, giving back some of yesterday's historic turnaround after President Trump paused trade tariffs for 9 months. The EU has responded, delaying taxes on American product. But David Wessel at the Brookings Institute says many are still worried.
Uncertainty about what the future holds is particularly high now. And that's a recipe for, frankly, for a recession, which is not certain, but certainly likely possible.
CBS's Weijia Jiang says tariff concerns continue to be top of mind for American farmers.
Will Hutchinson, a 4th-generation Tennessee farmer, says he is very concerned.
This is going to have an immediate and drastic impact to our ability to compete on the global marketplace for our goods that we produce here in this country.
The inflation rate dropped to 2.4% in March. That's down 2.8% year over year from the month before. But business analyst Jill Schlesinger says the numbers don't tell the whole story.
Overall, this report was better than expected, but it feels dated in light of all of the tariff news that we've seen over the last week. What we do know is that prior to the announcement of tariffs, inflation was trending lower.
House Speaker Mike Johnson's a happy man this morning.
I'm happy to tell you that this morning I believe we had the votes to finally adopt the budget resolution so we can move forward on President Trump's very important agenda for the American people.
He scrapped a vote last night over about a dozen conservatives from his own party who opposed the plan's lack of budget cuts and massive tax cuts. The bill would fund Mr. Trump's plans for the border, defense, and energy, but it would raise the debt limit. A mega deal in the world of haute couture. CBS's Vicki Barker at the foreign desk.
It's Versace.
Just weeks after Donatella Versace stepped down from the fashion house founded by her late brother Gianni, another era is ending for the label. Luxury Italian brand Prada has just announced it's buying Versace from U.S.-led Capri Holdings for close to $1.4 billion.
Uber's released a new lost and found list. Most common items riders forget to take with them: phones, wallets, and keys. The other stuff from CBS's Michael Wallace.
A list of unique items included Ozempic, Shrek ears.
Oh, for the love of Pete.
Divorce papers. A Viking drinking horn, 10 live lobsters, and a Ghostbusters ghost trap.
The Dow is now down 900 points. That's over 2%. S&P and NASDAQ each down about 3%. This is CBS News. Some pardoned Capitol attackers want their money back, the money they paid for repairs to the building.
A Justice Department court filing is before a federal judge who's considering a former defendant's request to be repaid the $500 in restitution he sent after a misdemeanor conviction. USA Today reports an assistant U.S. attorney says there should be reimbursement because Tracy Hager was actively appealing his conviction when President Trump issued the pardons for more than 1,500 people. Others convicted of more serious charges paid $2,000 in restitution. Steve Kathan, CBS News.
President Trump's forging ahead with his quest to make America's showers great again. He signed an executive order lifting restrictions on how much water can be used in shower heads. The president's blamed newer, more efficient models for ruining what he characterizes as his perfect hair. He says they force him to stand in the shower for 15 minutes till it gets wet. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive
Nice
Broker
job.
Studio.
You did it. You did it. You got it.
That right.
Yesterday was Friday, by the way.
Yeah, yesterday was Friday. So good Thursday morning from the Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. We got markets selling off today. Got the S&P off about 2.6%. We'll break all that down coming up. Sean Donnan, Bloomberg News senior economics writer. He's going to give us the latest on the tariff news. It changes by the minute, so we need to check in often with Sean and his team there. Dana Dioria, Co-Chief Investment Officer at VetNest, is going to join us here to discuss her outlook for the markets. Michael McKee, Bloomberg International Economics and Policy Correspondent, on the economic data we got today. CPI came in pretty tame, I think, across the board, so we'll break all that down. Kevin Whitelaw, Brussels Bureau Chief, on what the EU is thinking about tariffs here as it thinks about the United States. So we're going to break all that down in the next hour. Right now, let's go to John Tucker and get a Bloomberg Business Flash.
All right, for some perspective, the S&P 500 paring back more than a quarter of yesterday's surge. Investors still bracing for a protracted period of global trade hostility. Remember, tariffs still at 10%. The Chinese tariffs 125%. And most of the guests we talked to this morning say 90 days is not long enough period to try and come to some sort of agreement. The S&P 500, 154 points lower. That is down 2.9%, 5302 on the index. The Dow Jones Industrial Average down 950 points. That's down 9.4%. NASDAQ 100, 673 points lower, down 3.5%. The Russell 2000, 3.7% lower. That is down 71 points right now. NVIDIA, Tesla, Apple, among the Mag 7 stocks, leading the indexes lower. NVIDIA down 5.8%. Tesla down 6.8%. Apple right now is 3.4% lower. Data today, consumer price index dropping for the first time in nearly 5 years. But Bloomberg economist Anna Wong sees evidence consumers are backing off discretionary purchases. Remember, it is the consumer that drives this economy. CarMax backing away from the timing of its financial goals. And here you go. Egg prices for consumers hitting a fresh record, rising 5.6%. $6.
Egg prices were coming down.
Well, this is for March from the numbers that we got.
Okay.
$6.22 a dozen, so that doubled from last year. Not excellent. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. So the two of you are gone tomorrow.
We are. Yeah. Not together, separately, but we are both gone.
I didn't want to start any rumors.
John Tucker is going to be that host. Can I just go to the egg thing again? Because if you look at the egg index, large egg prices delivered to warehouses on a national level, they are down.
Okay.
Quite a bit. I'm just saying.
Well, like I said, that was the March figures that we just got this morning. Still pretty significant.
Yep.
I mean, if you can get them.
Yeah. Do you already miss us? Is this what's happening?
Yeah.
He already misses us. All right. Happy Thursday. Happy Friday to me and Paul. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance. Let's scroll down to some of the stocks on the move today. And for that, we go to Isabel Lee, Bloomberg Cross, as a reporter. What are you looking at?
Carnival. It's edging lower by now actually more than 9%. Carnival upgraded. So Morgan Stanley upgraded Carnival rather to equal weight from underweight. So the analyst said that a lot of bad news seems to be priced into the cruise stocks given share price decline. So basically, its risk reward looks fairer now. But why is the stock plunging on this? They did reduce their price target to $21 from the previous $25. And cruise stocks in general have really seen a huge drop this year from year-to-date highs, averaging around 41%. But I feel like, and analysts say this, you would want to steer clear of the cruise sector when there's a recession or an imminent recession, because who would be taking cruises?
Well, I think cruise people are pretty passionate people. I mean, it's almost like a utility to them. I don't know, but you're right. That's a discretionary spend.
I've never been to a cruise.
You never,
No,
me neither.
No one here has, so we can't really say.
No, Charlie Pellet.
But it's not just that.
I
It's
have
also
a kayak.
things like
Does that count?
Kayak.
no. But thanks for asking. Also, you got apparel and furnishings also falling in the CPI. So if you put them all together, maybe you're seeing a little bit of broader weakness there. What else are you looking at?
CarMax, this is a big drop because it's down by almost 17%. So they backed away from the timing of their financial goals. They really just joined a long list of companies doing that. Delta is the recent example. They pulled their 2025 profit guidance. So CarMax is a used car retailer. They did make progress towards their target. They said they will, but they didn't give any timeline. Trump's tariffs are expected to hit the auto sector in particular with a 25% levy of imports. We have car buyers rushing to dealer lots last month. So really, we're going to see if it drops even more today, but it's really suffering steep downturns.
I bought my car a few weeks ago. I wasn't thinking about the tariffs, but maybe
Good
that was
timing.
maybe that was good timing.
He sounds like he bought the car for himself. Let's just be clear. This was an offspring purchase.
Yes, for an offspring. And we leased it for the offspring.
But this was a very good lease at the end of the day. And also just goes to show in a tough tape, right? The story about Delta not having guidance, very different than like a CarMax, etc. What else?
Lastly, Constellation. So all stocks in the red. This is also in the red, down 4%. So they're a beer, wine, and spirits maker. They issued downbeat guidance, weighed by new tariffs and really muted demand. So the company expects earnings to be lower than estimates for 2026 fiscal year. But this already factors in the tariffs, because we've also heard a lot of companies not factoring in tariffs. We have Truist Securities saying they were surprised the company offered guidance at all. Even before this, Constellation has been struggling with lackluster sales, because we all know that alcohol demand has really been sinking. And even with this tariff, that's going to be... It has.
Not in my house.
Let's be honest here.
What are you talking about?
But there have been so many different Surgeon General warnings now about like how many drinks you can drink a week and still be healthy. There was kind of a reset after COVID when everyone was drinking like they had wooden legs. Only talking about me, but that's okay. Anyway, but it was interesting to see Constellation Brands with that and really pivoting to the higher end wine and spirits from that. All right, thanks so much, Isabel Lee, a Bloomberg Cross Asset reporter. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. All right, let's get to the main story of the day. And as, of course, global trade. Want to get more on this with Sean Donnan, Bloomberg News, a senior economics writer. So we've had a wild 24 hours. How would you describe the trade situation today?
Look, I think what's fascinating today is that we have had markets go up and then start to come down again as they realize that we still have in the United States the highest tariffs that we have had in a century, and they remain in place, and they're still doing damage to the U.S. and the global economy based on what we're starting to see in terms of shipping bookings, in terms of companies talking about canceling orders, putting just hitting the pause button on all sorts of decisions. So the tariffs as a kind of economic event haven't gone away, even though President Trump kind of scaled back some of his plans yesterday.
Sean, when you listen to some in the Trump administration, they seemingly their number one talking point is the number of countries that have reached out to the U.S. to talk about trade, talk about tariffs. I think the most recent number I saw was 70, and it seems like the higher the number, the better from their perspective. How is this all going to work here? I mean, is every country going to send a delegation? Are they going to send a term sheet over the fax? What are they? How does this happen?
Yeah, look, I think we've already been hearing some stories of countries sending term sheets, or the Trump administration asking for countries to pull together term sheets. We know that delegations were coming over even before the Liberation Day on April 2nd. So there's been talks going on. People have been trying to sketch out the outlines of a deal. But one of the key points we're also hearing out of the Trump administration is that countries probably aren't going to get a break below this 10% baseline tariff. And there's also these sectoral tariffs that have gone into place, like that 25% tariff on imported cars. That's not going away. And that really affects the European Union. It affects BMW. We've got a fantastic story on the terminal today by Gabby Coppola from the autos team on the Audi Q5 SUV, which is made in Mexico, and basically is made as a kind of global product. And the tariffs that are going to hit it are actually mount up to something like 50% of its price here in the United States. And then the smaller Q3 is made in Hungary. Likewise, it's going to be hit hard by all of these tariffs. So, a lot of countries are trying to figure out right now what they can get from Donald Trump. And if the answer is you're not going to get much below a 10% baseline tariff and these sectoral tariffs, remember there's also pharmaceutical tariffs, there's lumber, there's copper, there's all sorts of other sectors that are going to be hit by other sectoral tariffs that are coming up, then really what are we going to offer in return? And then you have, the biggest kind of economic giant outside of the U.S. there as well, which is China. And what we've seen break out there is all-out trade war. I mean, essentially, we've got now on the U.S. side 125% tariffs, on the Chinese side 84% tariffs. Talk to most business people or economists, they will tell you that those are prohibitive tariffs. Those are tariffs that mean that you kind of shut down all trade other than in essential goods, and those essential components that you need to kind of keep production lines running in the United States, or that you can't get from anywhere else, are just going to go way up in price, and that's going to have its own economic effect.
Okay, so then we have that baseline 10%. We still have a very hefty trade war with China. What about EU and Canada? So if the baseline 10% is still there, the sectoral tariffs are still there, where are the other added tariffs? They're not really negotiating.
Well, they're starting to, like we heard from the European Union today, that they're starting to work out what they can do, and that they're pausing their retaliation. But if you remember, under the announcement April 2nd, they were facing a 20% tariff. So coming down to a 10% tariff is on, this broad tariff is good. But then you have all these other questions around cars, for example, as I was mentioning, and pharmaceuticals, which is a huge issue for the European Union. In fact, U.S. companies make a lot of the inputs for pharmaceuticals that we buy here in the United States in Ireland. And that's a huge source of the trade deficit with the European Union.
All right, Sean, thank you so much. We appreciate it. Sean Donnan, he's senior economics writer for Bloomberg News, joining us from Washington, D.C. Via that Zoom thing here. And again, I'm just looking at that article about, building the Audi's top-selling SUV. They're getting tariffs totaling maybe 52%, basically saying that makes this car unsellable in the United States. What does a company like Audi, which is part of Volkswagen, do? Interesting times. This is
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg newsroom with this Bloomberg Business Flash being brought to you by Interactive Brokers. Trader at 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more. And your timetable. Learn more at ipkr.com/round the clock. Right now, we're giving up some of yesterday's gains. S&P 500 down 2.8%, down 151 points right now. 53.06 on the index. The Dow Jones Industrial Average down 905 points. That's down 2.25%. The Nasdaq 100 down 616 points. That's a decline of 3.2%. Right now, Tesla and NVIDIA leading losses in the Magnificent Seven stocks. as the group pauses after yesterday's surge. Nvidia down close to 5%. Tesla shares down 6.3%. Then you have Apple down 3.5%. In the S&P 500, CarMax is actually the worst performing stock. It's down over 17%. They removed timelines for the financial goals due to uncertainty about the trade war and the broader macro factors, as they put it. U.S. Steel shares, they are dropping right now. U.S. Steel down 8.2%. President Trump said he loves Japan, but he didn't want a Japanese company, Nippon Steel, to name it, to buy the steel manufacturer. And then, again, that deal news today in the luxury space. Prada buying Versace, $1.38 billion in cash, buying Versace from Capri. Remember, they paid $2 billion for it. This has been ongoing for months. The purchase, the largest in Prada's 112-year history, returning Versace to Italian ownership. I'm going to say Prada projects a more subtle aesthetic than Versace.
Really? That's where you're going.
That's the line in the story. I don't know what the hell I'm talking about.
I mean,
I'm just
I
parroting
think it depends because Prada prided itself on like being weird. Now, weird different than
Okay,
Versace weird, but still
is like flashy.
Flashy, yeah. Prada's not flashy, but
like
maybe
me.
like architectural weird. Yes. When I think Versace, I 100% think John Tucker. Yeah.
Yeah, sure.
For sure.
Okay.
Yeah.
Okay.
When I think Prada, I think Michael McKee.
All I know is they sold it for a lot less than they bought it for. So anyway,
I have no idea. I'm with John on this one. This is a little bit like Matt Miller talking about his Lamborghinis and Ferraris and
naturally aspirated.
Yeah, but luckily you guys have me,
and
that's the good thing there. All right, John Tucker,
Okay.
thank you so very much.
Anytime we talk about sports, you can throw out
Versace?
Versace,
Yeah. We like John Tucker there with the scarf wrapped around his neck. Okay, this is Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker studio right here in Midtown Manhattan. You can also check us out on YouTube. Just go to youtube.com/Bloomberg Live and check us out there. So as I mentioned, Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now. So, Mike, it was interesting with the CPI. Bloomberg Economics had the note out that said this wasn't about falling prices necessarily, but it was more about falling demand in travel, leisure, and apparel, and furniture sales, and stuff like that. Walk me through the details.
Well, the biggest drop was in gasoline prices, which is sort of a combination of anticipated falling demand by the gasoline producers, refiners, et cetera, given the impending tariffs. And then we also saw some declines, as you mentioned, in travel prices, and that was definitely tariff related. But the rest of it was sort of mixed news. Food prices were up by, food at home, grocery store prices were up by 0.5%, a fairly large gain. Then 2 months in a row where food prices are up. And we saw apparel prices rise, but is that just a natural move, or was that also an anticipation of tariffs? Furniture prices, we get a lot of furniture from China, those were also up. So the report is kind of a mixed news thing, except that the overall good news is it went down. And if you were not going to have tariffs, if none of this had happened, it would be exactly what the Fed would love to see.
Right.
So when do we expect to see any inflation impact in these CPI numbers and the PC deflator? When do we expect, if there's going to be any inflation impact, when do we expect to see that?
It's a little hard to say. Probably, maybe, could be hedged enough here. Next month, this month's data, when it comes out next month, because it could reflect tariffs that the president has already put on. But it's probably going to take a couple of months. Maybe we get something in the May numbers. First of all, companies have to figure out whether their products are tariffed or not. That seems to be bouncing around. And then it's a question of how much stuff people have in inventory they can sell that they bought at the lower prices, how soon inventory actually docks at a port and is the tariffs are applied. So it's kind of hard to say exactly when we're going to see this, but it would be coming. And given the fact that we still have 10% tariffs on everybody, and now these huge tariffs on China, you will see it.
When is the biggest, what are you looking at next in terms of the biggest indicator? Is it going to be inflation expectations? Like, is that going to be the thing that's going to sort of give us that kind of insight?
Yeah, because that's tomorrow, so I'm pitching ahead to all the appearances I will do with you guys tomorrow.
Well, John Tucker's in charge tomorrow, so he will gladly have you on the show.
But University of Michigan tomorrow, the Fed has sort of downplayed the long-term inflation expectations number, suggesting that it doesn't quite reflect reality in the history of the Michigan numbers. But they do worry about the short term, and that has gone up significantly. And they have said, and Jay Powell said, that we are obligated to keep prices down, and we are very worried about the short-term inflation expectations should they become unanchored. So that'll be somewhat big news tomorrow. But I think we're redefining what big news in economic data means here, because everybody's, once we get to the point that you asked about when does this hit, once we get to that point, then markets are going to react to every little data bit. But anything that is up to this point, people are going to say old news.
PPI tomorrow. How do we interpret PPI versus CPI?
Well, PPI is the easy difference to know is that CPI is what you pay to buy things, and PPI is what companies charge to sell things. And we may see some of the China impact in the PPI because we saw those big inventory builds in terms of industrial supplies and things like that in the past couple of months. And so if you were a Chinese company or from anywhere else in the world selling to the United States and there was this rapid rise in demand, you might raise prices. So we could look for some of that tomorrow. But so far, producer prices have been much better behaved than consumer prices. So overall, it hopefully is a continuation of the good news that no longer matters.
Can you clear something up for me? This is the stupid question for me from the peanut gallery. A guy picking up stuff at the port, that's the person who's going to pay for the tariff. It's not the exporter off in whatever
it's
China.
It's not the exporter.
It's the guy in Port Elizabeth, Newark, New Jersey.
This is the silly thing that the administration keeps pushing, that what they're talking about is that not that the exporter is going to pay anything, but that currencies, the dollars should rise, and that makes their currency cheaper. And so they...
Right.
You know, there's an impact on them in that case, and sure, but it's the company that bought the stuff.
Yep.
So this is the whole story from yesterday. There was like a back channel what thing that he wanted to buy. Some guy at Bloom's. Anyway,
oh, yeah. No,
gotta go back and listen to that.
Yeah. Don't even go into that.
It's a whole different thing. Mike, thanks a lot. Mike McKee, moving national economics and policy correspondent, joining us now. All right, let's get to Dana Diorio, co-chief investment officer at Investnet, joining us from Hartford, Connecticut. Okay, so what do? It's been a crazy 24 hours within the market. How do you position?
Yeah, that's the big question. It's so funny because actually I'm at our conference in Las Vegas, our Investnet Elevate conference, and I was just on stage yesterday, literally as the pause was happening, telling everyone to stay the course. The timing was, madness, and kind of showing what had happened on Monday when we had, this false report of a reprieve and stocks, skyrocketed only to come back down. And when you're a financial advisor trying to trade on this, it's absolutely impossible, of course. And so, the messaging then and now is, kind of, you've got to stay put. I mean, certainly if you have clients who are not diversified and they're super concentrated, or, a lot of people let their equity positions get a little bit big in this hopes of a pro-growth, corporate type of policy from the administration. That's obviously all, kind of been obliterated. And now we're looking at a picture that's very different. And so you had people who are high in equities. If you're too high in equities, take some off the table for sure. But these are the times that you need to ultimately stay the course and wait it out, or you turn the paper losses into a real loss.
Conference in Vegas. Nobody has conferences in like Sheboygan. They're always in Vegas or Miami or Scottsdale. Dana,
this is true.
I mean, they know what they're doing. Dana, so what about earnings here? I think, I have not seen earnings estimates really come down that much, but I've got companies left and right pulling their guidance and all that kind of stuff. How much earnings risk is out there, do you think?
Yeah, I mean, your last speaker said it, right? I mean, what's going to be crazy right now is you're going to have the first quarter earnings come out. You're going to have, March economic reports come out. And of course, all of these are going to paint this, incredibly rosy picture that's not reality anymore, right? In fact, they'll probably be rosier even than they normally would have, because you had folks, pulling forward consumption, pulling forward demand. And so things will look great. And you'll have this series of reports, and this earnings season is going to be part of that. And so paying attention to that, of course, it gives you no information. It's really, what is the guidance? And if you're a corporate planner, I'm not sure you can give great guidance, right? I mean, the volatility of, just what you have to potentially plan for in the short run. And then, if you're, some of the idea here, of course, is, hey, look, let's bring, some of the manufacturing back to the States. Let's kind of encourage people to have CapEx here. But how do you do a long-term plan? I mean, it takes years, right, to bring this stuff here.
Yeah.
How do you plan around that? So I think guidance is going to be probably overly, I'll almost say might likely be overly pessimistic, because nobody really knows what they're dealing with.
Which, to that point, Delta yesterday withdrew guidance, stock popped. Today, CarMax does something similar. I mean, it pulled back its financial goals because of the volatility, but same thing. And that stock's down 20%. So where are we in valuations?
Yeah, well, I mean, obviously we started the year very high. We've shaved a good piece of that, but that was part of the problem, right? We came into the year with that expectation of a bull market, with high valuations as a start. Not everywhere, but certainly as an index, right? In a market cap weighted basis, valuations were high. And so, when you come in with high valuations, really everything has to go well. And if you have this exogenous shock, and everybody knew tariffs were coming. It's not as though, this was entirely unexpected. And that's why you have that pull forward of consumption. But the magnitude, right, the breadth of it, how quickly it all was intended to come to pass, that did catch everybody off guard, and, kind of wiped out that picture that rationalized those higher valuations that we were sitting with.
Dana, thank you so much for joining us. Always appreciate getting a few minutes of your time. Dana Dioria, she is Co-Chief Investment Officer at InvestNet, joining us from Hartford, Connecticut via that Zoom thing here.
Vegas, remember?
Oh, Vegas. That's right.
The
She's
conference
at
in
the
Vegas.
conference.
Yeah,
exactly.
Yeah. Boom.
Boy, Vegas. There we go. S&P off 2.4% here today. The NASDAQ off 2.9%. So the sell-off continues after that reprieve yesterday. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Tariff turmoil still in the driver's seat for investors. S&P 500 down 130 points. This is a decline of 2.4%. The Dow Jones Industrial Average down 777 points. NASDAQ 100, 531 points lower. That is down 2.8%. As the Magnificent Seven stock swoon. NVIDIA, after yesterday's run-up, down 3.4% right now. You have Tesla shares down 5.6%. Apple is down just about 3%. And after yesterday's rally, Citigroup advisors saying, don't chase this, don't buy the dip. CarMax pulling the time period it plans to achieve long-term targets. They're citing the potential impact of broader macro factors, including the tariff turmoil. As shares right now, they are lower. CarMax down close to 20%. The inflation data, inflation cooled broadly in March. CPI, when you strip out food and energy because they're so volatile, increasing just 0.1% from February, the least in 9 months. Deals in the work. Capgemini in advanced talks to acquire an outsourcing company, WNS Holdings. And according to the journal WW International, the health and wellness company that we know as Weight Watchers, preparing to file bankruptcy. And you can guess why they're doing that. Blame Ozempic. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. Head over to youtube.com and search Bloomberg Podcast Live. That's where you'll find us. Busy times in the world of tariffs. We just had the European Union announce that they will pause metals counter tariffs against the U.S. for 90 days. Let's get the latest reporting from Europe. Kevin Whitelaw, Brussels bureau chief for Bloomberg News, joins us from the Brussels studio. Kevin, give us a sense of how Europe is thinking about trade with the U.S. these days. What are they doing with their tariffs? How are they perceiving the U.S. and tariffs these days?
Well, frankly, they're just trying to keep up at this point. Just yesterday, they had decided to approve some retaliatory steps that they were going to take against Trump's very first set of tariffs. Those were the ones on steel and aluminum. They approved this retaliation that had been well telegraphed, and then hours later, Trump pauses his newest one, which had been the so-called reciprocal level, so that extra level that was going to give the EU 20% across the board tariffs on their imports into the U.S. So they did pause their retaliation, said it was supposed to take effect in mid-April. They're going to pause it. That's what they decided today. They have been talking consistently all the way throughout about wanting negotiating space. They really, really don't want a trade war, and so they're trying to figure out what room there is for negotiation. They've been very clear they're happy to talk about tariffs and reducing tariffs to zero and on many things, industrial goods and cars and that kind of thing. But the Trump administration has made it clear that it's also talking about what it calls non-tariff barriers as well.
Mm-hmm. Who has, actually, better question first. Within the EU, are all the leaders in agreement on how to manage the situation?
They're mostly in agreement so far. So trade is a competency of the European Commission, so that really is very squarely something that Brussels is in charge of, but it still does need sort of sign off at times from the member states, or there are times where the member states could block things. And so other than Hungary, most member states have broadly been in the same place. I think there are some subtle differences, though, where there are some countries that are sort of getting ready to want to take a harder line on the U.S. at some point, Germany and France in particular, whereas you are seeing some other countries like Spain and Italy be a little more cautious about that, really want to try to keep the negotiations open and try to do everything they can to avoid a trade war.
So, Kevin, is the EU, are they going to send a delegation to D.C. to negotiate? Because we hear the administration saying how, up to 70 countries, are, kind of in line to kind of negotiate with the U.S. How is the EU handling it?
I mean, the EU has been eager to negotiate. They've been reaching out. Their trouble has been finding anyone to pick up the phone and take their meetings. And so, the EU trade chief Maros Sefcovic has been in D.C. He did meet with recently with the Commerce Secretary and the Trade Rep and the Treasury Secretary. He'd like to do that again, but at this point, they're kind of waiting for someone to schedule some meetings and be there. The real problem I think the EU has even beyond that is it's not really clear whether Lutnick and Bessent and Greer are in a position to make a deal. So much of this is going to come down to Donald Trump. And as we've seen, he can seem like he's not interested in a deal one day, and then the bond market crashes, and suddenly he's talking about deals again. And so I think everyone's trying to understand what really is Trump's strategy with these tariffs here. Right. Is he looking for deals? Is he really trying to cut something? Or is he really talking about something that's a much longer term structural thing that's going to be a feature of his entire administration, no matter the economic pain?
I mean, it definitely, from what he himself has said, it's the latter, but also instinct on when to change it. So that makes that a much more difficult interaction if you're the trade minister. Who has the upper hand then, just in terms of, say, good flows, trade balances, fiscal support?
It's a really good question. I don't think there's a straightforward answer to it. I think on some level, Trump could throw around the weight of the American economy and some of that leverage there, and that can be a very effective weapon. On the European side, it does come. This fight comes at a more vulnerable time where the economies have been suffering a little bit. And, they're obviously reeling from a couple of different things. They're trying to figure out how to fill a bit of a void being left by the United States in Ukraine. They're trying to figure out how to, stimulate their economies, and they're lagging competitiveness. And so there is that concern. On the flip side of that, suddenly Europe is looking like a pretty reliable market that's got a pretty predictable set of rules that aren't about to change. And so, and they're going through what they think is a pretty effective, or they hope it's going to be an effective effort to try to streamline and simplify some of the burdensome regulation. If they can do some of that, maybe down the line, the power of their single market is going to help them compete. But I think in the short to medium term, it's certainly an uncomfortable time for this fight to be happening.
What have we heard from the UK?
Yeah, good
question.
The
UK has been in a slightly different situation, at least, in the reciprocal sort of tariff, numbers that Trump rolled out. The UK wasn't getting any extra penalty. So there's that baseline 10% was all that was going to hit the UK. They weren't raised like the rest of the EU up to 20%. And Trump has so far been pretty happy about his relationship with the UK Prime Minister. But in reality, I'm not really sure that they're actually all that advantaged down the line. And if anything, I think it has raised a lot of interesting dynamics and opportunities for the UK and the EU to sort of get closer again.
Yeah, funny, because wasn't that whole split like 9 years ago? So there is that. The other distinction that many are citing is that Europe has a much greater bandwidth right now for more fiscal stimulus than the U.S. does, and I wonder if that gives it not better negotiating power, but a little bit more heft this time around than it did in the first Trump presidency.
I mean, the problem they have in Europe is that one or two countries have a lot of, have some room for fiscal stimulus, and Germany in particular does. So in that sense, you're right. But in other senses, there's countries that really don't. So Italy, Spain, Belgium, there's a bunch of countries that are pretty indebted and are already sort of violating or at risk of violating the EU's fiscal rules. And so you are going to see some extra spending around defense, but you're still not seeing from the European side yet this idea that they are really ready to embrace a broader set of common, joint debt to really, really ramp up either the defense transition or the clean tech transition. And so if at some point this fight gets to a certain place, you could see that it might drive that conversation and force that and maybe open that up. And that's the thing to be looking for. But right now, at least, we're not quite there.
Kevin, you're a graduate of Princeton University, so I have to ask this question. What is your go-to sandwich at Hoagie Haven?
Got to go cheesesteak every time.
There you go. See, everybody's got one.
What's yours?
Cheesesteak hoagie. No tomatoes, but everything else. It's the same order I've had since I was 12.
So what other options are there at the hoagie place?
Everything. And I don't think they've raised the prices since everything. Everything they've got there. And it's the Hoagie Haven. It's got to be the best place on earth for sandwiches. Everybody's got their own. That's mine. But every Princeton graduate has got an answer to that question. You can't go to Princeton without being a diehard fan of Hoagie Haven. And Conti's Pizza as well.
He's nodding, by the way.
Kevin Whitelaw, Brussels Bureau Chief, Bloomberg News. He goes for the cheesesteak at Hoagie Haven in Princeton. S&P 500 off 150 points. That's 2.85%. We'll have more coming up. This is Bloomberg Morning.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Thursday, everybody. This is Alex Steele, Paul Sweeney, Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. So this was the week where we got CEOs putting out their investor letters. We heard earlier in the week from Jamie Dimon, and today we got Andy Jassy and his Amazon letter. Poonam Goyal is Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. Hey, Poonam, what did we learn from Andy Jassy's letter?
That startup, which means you never get off your feet. You know, you're always on your toes. And I think that's really what's helped Amazon thrive. It's just thinking, what next? Why?
So, I mean, just from the retail side of the business here, how do you think Amazon will deal with these tariffs here? I mean, do they just pass them along to consumers? Do they try to push some of that back onto the wholesalers? Do they take it in their profit margin? How do you think this is going to play out?
I think it's going to be a mix of everything there. Remember, on the Amazon business, the retail business, 60% or more of that is 3P. So that is where Amazon does not have the risk or need to figure out how they're going to deal with the added cost. On the 40% of the business, part of it is consumables. And consumables or food largely is insulated from the tariffs. So then that leaves us the discretionary part of the Amazon business. Amazon so far has said that they've halted shipments from China, given the very high tariffs that we're seeing there. We think they will not pass on the entire cost. We think they can shift the products that they sell. They can shift the sourcing where they source the products. But clearly, Amazon will continue to aim to be the low-priced retailer that we've known it to be, just like Walmart has said. They're not passing along the prices, right? They want to be low-priced. They're going to figure this out. And it's too early to still tell what really happens because, well, things are changing by the day.
Yep.
No, by the minute, really. Now, Amazon has also bet heavily on AI, and it's committed a lot of its $100 billion in planned CapEx this year to AI-related projects. Do we have a sense of if that is changing based on all the volatility and uncertainty?
So far, we don't think that is changing. A bulk of that was dedicated towards AWS, and we do think that the investments there are still needed. In fact, in our scenario analysis, we didn't expect that big of a drop in AWS momentum because if you think about the companies that are investing into cloud and into technology, most of the CapEx there is maintenance CapEx, right? You just kind of need it to stay alive. And then the incremental that's discretionary, sure, they can pull back on some of it, but likely not all of it.
So, Poonam, all right, I kind of get the Walmart and the Amazon thing. They're so big that they can, deal with these tariffs probably. But how about everybody else in your retail universe? I mean, what are they saying here? I mean, it seems like it's going to hit in consumers' pocketbooks at some point.
It is. I mean, there's no way to avoid price increases. It really depends on how high these tariffs actually come out to be. So if you put China aside, which I think for my athleisure company, when you're talking about the Nikes of the world, they have 18% exposure to footwear in China, and they can mitigate that. They can say, okay, whatever we produce in China will be used for China and outside of the U.S., and then turn to Vietnam, where the tariffs are now lower, and the other countries to source product from there. Now, if you assume that 10% increase that's in place for the next 90 days, what does that mean to prices? We put together a model, and that means that prices will need to rise by roughly 6% if you only increase prices in the U.S. Nike can probably pass along a low single, mid-single digit price increase to its consumers on its high value product. But on the low value product, we expect them to tightly control the price increase there and keep it as low as possible because those consumers are more sensitive to price.
Is there a retailer that makes all its stuff here in the U.S. and then will be totally not exposed?
Makes all its stuff in the
right?
U.S. And no, not when it comes to footwear and apparel. That is very difficult.
So what would it take to you guys see this meme going around? It was like a video, an AI video showing regular U.S. people putting together a shirt or stringing together a sneaker and that kind of thing. Would putting up a plant in a factory here to make shoes or to make a shirt, is that realistic?
No, not at all. We cannot make all the footwear and apparel that we consume in the US. Number one, we don't have the factories. And number two, we don't have the seamstresses and the talent to do so. So unless we're importing in a bunch of people to do this and then putting out the capital to build these factories, which that itself could take years, it's something that we just cannot do.
All right, Poonam, thank you so much. We appreciate it. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence. Looking at these markets here, they're kind of rolling over a little bit here, Alex. We got the S&P now off 3.1%. The Dow's off 1,052 points. That's 2.6%. The NASDAQ off 635 points, 3.7%. So seeing a kind of a continued weakness in this market here today. It kind of calls into question yesterday's rally a little bit.
I mean, the notes seem to be circulating that the total crash threat is off the table, but this is still a kick the can down the road. And Charlie McGalligot over at Nomura was just saying, like, well, what happens in 89 days from now?
Right.
Are we going to be in exactly the same kind of place? Plus, if you take a look at the back end, I'm continually surprised at how little the back end moved yesterday and today, considering the massive run up in yields that we saw over the previous couple days. And until that comes down, is that going to really inhibit risk on sentiment?
Yep. And, you look at the earnings estimates out there for the S&P 500. Analysts have not really brought the estimates down. And, again, the consensus is for about 10%, 11% earnings growth in S&P 500 earnings for 2025. We've had some people come in here and say that could be flat, and that's a big difference. And maybe that's been priced in, but we haven't seen it necessarily in the numbers. Maybe the market's ahead of where the analysts are. We'll have to see where that plays out. But I think that's uncertainty level, if you look at today's action, remains.
All right, well, for our listeners in the U.S., reminder, go ahead and listen to us via satellite radio, Sirius XM channel 121, 24 hours a day. Bloomberg Radio, Sirius XM channel 121, brought to you by Oracle.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday to me and Paul. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks, and we have them lined up for you today. Nathan Dean of Bloomberg Intelligence will be breaking down the last 12 hours in D.C. and that policy reset. Deborah Aiken will be here to talk about Prada agreeing to buy Versace. Then Jen Bartashis, Bloomberg Intelligence senior analyst and retail staples, will be talking about Walmart and egg prices. Yeah, let's get into it. And then Barry Ritholtz is here as well. What his take is on the last couple days and how do you position yourself? And finally, Ken Shea, Bloomberg Intelligence on Constellation brands and what that means for tequila and wine sales, which apparently are still holding up, by the way.
No surprise there.
It's all helped by Paul Sweeney.
Yeah,
Let's kick it all off for you right now with the Bloomberg Business Flash, and for that, we go to Charlie Pellet.
Hi, thank you very much. Quite an hour coming up right here on Bloomberg Intelligence. We've got stocks selling off, not just lower right now, but in fact, lows of the morning on the S&P 500 index down 175. Yesterday, recall the S&P surged 9.5%. Right now, that index is down 3.2%. The Dow, though, down 1,068, a drop now of 2.6%. The NASDAQ Composite Index is down 3.9%, down 660 points. The 10-year at 4.32%, with the 2-year currently yielding 3.80%. Gold up $75 the ounce, $31.58. Gold, the precious metal, up another 2.4%. And West Texas Intermediate crude now down 5% with a 59 handle. WTI 59.22 a barrel. Again, bears repeating, we got crude selling off by 5%. Earnings season kicks off in earnest tomorrow morning when we hear from J.P. Morgan Chase, Wells Fargo, and Morgan Stanley. Dana Dioria is Co-Chief Investment Officer at Envestnet. And right here on Bloomberg Intelligence last hour, she told us the broader earnings picture may prove to be deceptive because of the uncertainty over tariffs.
What's going to be crazy right now is you're going to have the first quarter earnings come out. You're going to have, March economic reports come out. And of course, all of these are going to paint this incredibly rosy picture that's not reality anymore, right? In fact, they'll probably be rosier even than they normally would have because you had folks, pulling forward consumption, pulling forward demand. And so things will look great.
Dana Dioria of Investnet talking to us from Las Vegas. Speaking of earnings, CarMax backing away from the timing of its financial goals, joining a growing list of companies indicating that uncertainty around President Trump's trade war is making long-term planning difficult. KMX on the ticker, and right now it is down by 19.9%. Again, recapping lows of the morning on the S&P 500 index, with the S&P down now by 3.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We are live in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube as well, so you can head over to youtube.com, search Bloomberg Podcast Live. That's where you'll find us. As Charlie was just reporting, a pretty broad sell-off here in the equity markets today. Let's see where the action is under the hood. We can do that with Denitsa Sekova, cross-asset reporter for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Denitsa, what are you looking at today?
Let's start with the United States Steel. We saw a drop as much as 10% earlier today. Now some of the losses are fading. Still a very bad day for the company. It comes after President Trump said he doesn't want to see the steelmaker owned by a Japanese company. Of course, there has been so much back and forth with the supposed acquisition of Nippon Steel. President Trump has repeatedly said no to wholly owning the company, but he has been open to investments in the past. But what we heard now is that he pointed to the producers' rising steel orders as evidence that it doesn't need any investment right now. He actually said if we go back to U.S. Steel from 90 years ago, it was incredible. So there is a lot of optimism for the orders there. We saw a 16% jump earlier when things seem to be moving in terms of that acquisitions, but now we're seeing a big drop year to date. The stock is doing okay.
Yeah, and there's a lot of debate on, like, will U.S. Steel be okay? I mean, a lot of analysts say, like, yeah, they'll be all right at the end of the day. Let's go to Nike. Oh, my gosh. The whippiness of these shares was crazy. You get the stock now down by 10% despite this tariff pause.
Yeah, every morning I go and look at Nike because I think for
That's
me...
a fair point.
Yeah, I think it's the proxy of where the sentiment on tariffs is. We saw a massive gain yesterday. Big drop today, as we say. It's kind of become a symbol of that corporate fallout from tariffs. Yesterday, we obviously had the pause for 90 days. We saw a massive rally. In many retail brands, we saw Lululemon, we saw Walmart, but now as those news are setting in, as people are worried about recessions, as people are worried that still some of the tariffs are on the table, Nike is really suffering. Of course, its supply chain is being specifically threatened. We have some stats that about half of their production is actually coming from Vietnam, which is one of the countries that U.S. has been actively negotiating with, and it seems like things have looked better. But obviously, over the past 30 years, we have a great story on the terminal that Nike has invested billions of dollars in production in Vietnam, and now obviously that's being threatened. The stock is down nearly 30% year to date. Even yesterday's rally couldn't lift it up enough to improve that.
Constellation Brands, booze. What's happening?
Yeah, but it's up on the day. It's coming off the news of downbeat guidance because of the tariffs. Of course, analysts are even saying that they're surprised they offer guidance at all. And what they offered is kind of optimistic from what we're seeing today. Yet we're up on the news. Of course, this comes like an overall climate for drinking as alcohol companies haven't been doing so well as younger generations have been opting for non-alcoholic drinks and kind of healthier alternative, have been more health conscious. So there has been this big theme of people shrugging those brands. Of course, the big issue with Constellation is that it's importing popular Mexican beers, and with the trade war, that can obviously be hit very hard.
Yeah, and that's not going to be good for that company at the end of the day. Okay, great. Thank you so much. We really appreciate it. Denitsa Sekova joining us, Bloomberg, a cross-asset reporter. For more conversations like this, go ahead and listen to Stock Movers podcast and subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. All right, we were debating in the last hour, like if John Tucker is Versace and Michael McKee is Prada.
Right.
Now they're going to be uniting. So it's like a Mike Tucker kind
I
of
see what's
Prada
happening.
Versace
Okay.
thing. All right, Deborah Aiken, Bloomberg Intelligence luxury goods analyst, joins us now. It's funny because neither of them are those things. So Prada is going to buy Versace for about $1.38 billion. Walk us through the intricacies of this deal.
Hi. Yeah, it's been talked about for quite a while, and we already last night heard maybe that the acquisition price would be down by a couple of $100 million. The big thing here has been that under Capri, Versace has not had enough investment in it over the last year, particularly in the field of the tapestry bid for Capri, which didn't go ahead. And which took a lot of the headlines last year, and where all brands under the Capri banner suffered. We've had Chairman John Idle come back into the business as CEO for Capri, and with the focus really on Michael Kors, which is 70% of the sales. And after a difficult year last year, 100% of the profitability of the company leading into this year. So it's all about turning around Michael Kors, which has 70% of its business in Americas, is at accessible price point, and where actually we think that there'll be much more pressure given the tariff situation and the cost of living on all consumers, and also in the US. If we turn over to the Versace acquisition, and what's going on there with Prada. Prada has been one of the top performing companies. It's really done ever so well with Prada for the last few years and gone to normalized single digit growth. And then it has a brand Miu Miu within its portfolio, doing ever so well. It's number one on the list index for luxury brands in terms of brand equity, brand heat, with Prada at number 3. And during the December quarter, Versace dropped 3 places to number 14. So we think it shifts Versace into the right hands, into Italian luxury owners who can really work well to try to reinvigorate this brand and the brand equity behind Versace.
Hey, Deb, I'm really interested in the valuation here, being a former banker myself. They're selling this thing for $1.38 billion US dollars. In 2018, they paid $2 billion for this. So a lot of value destruction. Is that a Versace specific issue, or does that reflect lower valuations in luxury generally?
I would say it's both, but it's mostly Versace specific, because if we look at the size of Versace then to now, the fact that it's given double-digit declines in organic sales growth through the couple of years where actually the market was growing 5% or so, and that 1.7, to put it into perspective on an EV, would have been against traditionally a market for a very solid brand, Versace, with a lot of heritage, running from anywhere from 3 to 5 times, probably 3 times for Versace, given it isn't particularly big. Under the what was Michael Kors and then became the Capri group, the expectation was that they would run it from 1 billion in sales toward 2 billion, and that just didn't happen.
Right.
So that's partly why. I think also because of the state of the market, we started 2025 with the luxury market focusing for low to mid single digit growth. With everything that's going on, we pull that back towards neutral.
Hey, Deb, thanks for joining us. Always appreciate getting your thoughts there. Deb Aitken, the leading voice on all things luxury. She is a luxury goods analyst for Bloomberg Intelligence. She's based in London. Got a red headline coming across the Bloomberg terminal. House adopts plan to advance Trump tax cut debt ceiling hike. So maybe some movement there. And whenever we talk D.C., we talk D.C. policy, we talk to Nathan Dean. He's senior policy analyst for Bloomberg Intelligence. He's based down there in Washington, D.C. We banished him to D.C. He's down there. Nathan, talk to us about this news coming across, about just kind of what we want to see from, or what the House would like to do in terms of the tax cut, the debt ceiling, all that type of stuff.
Yeah, so this is a big win for Speaker Mike Johnson. Essentially what this does is this allows Republicans to move forward and begin the specific negotiations on how they're going to extend the Trump-era tax cuts, and then subsequently what are they going to cut to try and offset some of that expansion, whether it's Medicaid, the Inflation Reduction Act, and SNAP benefits. Now, the fact that the House passed this resolution is fairly significant, allows the momentum to keep going. But the question that I have that we'll likely find from Bloomberg News later today is, what did Speaker Johnson have to do to get those hesitant Republicans on board? Because, you know, right before I came on the air, he was huddling with a lot of the moderate Republicans on the House floor. I want to find out what he had to do in order to get that deal to move forward. But again, it's a big win for the Trump administration, because now they can spend the next few months trying to come up with those specifics. We've always told our clients that we think this is eventually going to happen, that there is going to be a deal, but the question that still remains is, will this deal increase the deficit? I think so, fairly likely. And what gets cut to extend these tax cuts? And we don't think it's going to be all that much, assuming that they move forward with the plan that they're adopting right now.
Okay, so to that point, is this the House version of the Senate bill that passed last weekend, or is this their own version that now they go discuss with the Senate?
No, so this is the House adoption of the Senate resolution. Now, if you remember, you know, in order to pay for these Trump-era tax cuts, you're looking for around $4.6 trillion. Now, what the Senate did is they're essentially assuming that's current policy and that's baseline, which means that the cost of it is essentially zero. Now, the Senate also included $4 billion with a B, in terms of estimated cuts, which they call is a floor. The House problem is that the House was looking for around $1.5 trillion with a T in terms of cuts. So now the question goes, okay, well, if the Republicans are now pursuing $4 billion with a floor, with the idea that it could go further, you know, are they essentially going to agree on a deal that doesn't cut much, therefore increases the deficit fairly significantly, assuming you don't get enough economic growth to pay for it? Or do the House Republicans, who are insisting on trying to do more cuts, hold out to the end when they realize that cuts to Medicaid, the IRA, and SNAP benefits are just too difficult to actually stomach, and they rather just kick the can and go for the easy solution?
All right, I'm all for the easy solution in my life, Nathan. So why don't we just let's be clear? It looks like they're going to pass this thing. Tax cuts are going to be extended, and we'll just add to our national debt. Isn't that kind of what's probably going to happen?
Well, you know, there's two things that are coming up. One is the timing of this. I mean, look, they don't have to do anything here until the end of the year, December 31st. But this does include a $5 billion increase in the debt ceiling. And according to Treasury, you know, that X date is probably going to be sometime in July and August, suggesting that this plan will have to pass in addition to that. But to your question about the deficit, the real big question we have here is that what additional tax extensions or, tax cuts come in this? The Senate plan had $1.5 trillion in additional tax cuts. Think when Scott Bessent, the Treasury Secretary, says no taxes on tips, no taxes on overtime, and so forth. Is that enough stimulus to essentially allow the economy to regenerate some of the momentum that it's lost over the last few days? You know, it's still a question to be decided. So there's a lot of time left for the specifics to have to play out. You know, we think this is going to probably go until June at the earliest, September at the latest. So, you know, we have a lot of time to prepare for this. But again, Congress is doing the easy thing right now. They're waiting for the difficult times and the more specific times to come later.
But I wonder if there's a greater sense of urgency now that we've had this market turmoil on the equity and the bond side, and those don't seem to be dying down irrespective of yesterday's move. It's like, get the good stuff out.
Yeah, absolutely. I mean, if you think about the good stuff that the Trump administration is promising for business, it's this idea of tax extensions and also deregulation. You know, we saw last night an executive order, if you will, calling on regulators to essentially bypass, it's a little wonky here, the thing called the Administrative Procedure Act, where they can essentially say, you know what, let's just go deregulate and say it's done. Normally you have to have a comment period, a process, and it takes like about a year. So I think there is some urgency going on at the White House that in response to what we've seen over the last couple of days to get that good news out. The problem for the good news on the tax debate is that it is going to take time to get all these Republicans on board, because as we just saw, it was a challenge just to get the Republicans to vote for the blueprint. It's going to be an even greater challenge when they see what the economic and the actual impacts of these policies will be.
30 seconds here. Did the president win yesterday, or did he put the 90-day things?
Harsh.
Or was it just bowing to the market?
I think the president gave the markets breathing room. I mean, the situation hasn't really changed. In 90 days, these tariffs potentially could come back, but I think the president gave the market breathing room so they could develop a bigger strategy that may be a little bit more susceptible to having Wall Street view them in a more favorable light.
You know who didn't win at all? the shorts in the equity market. They lost hard pretty much all across the board. Hey, Nathan, really appreciate it. Nathan Dean, Bloomberg Intelligence, a senior policy analyst, joining us there. All right, coming up, we're going to take a look at the broader markets here with Lara Castleton, a U.S. head of portfolio construction and strategy at Janice Henderson, and Jen Bartashis of Bloomberg Intelligence will be joining us on retail and food prices. I told you national-wide, prices of eggs are coming down. She will give us the lowdown. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. President Trump's tariffs on Chinese imports are now at least 145%. That includes both a 125% rate that covers reciprocal duties as well as levies imposed on China for retaliating against U.S. import taxes. This according to a White House memo. It also encompasses a 20% rate imposed by Trump earlier this year over fentanyl trafficking. Stocks are lower. The Dow, the S&P, NASDAQ, all in the red right now, with the S&P down 186 points. Low of the morning, down 3.4%. The S&P now at 5271. The Dow is at 39,489, down 1,119 points, down 2.8%. And NASDAQ is down 702 points, down 4.1%. The 10-year at 4.33%, with the 2-year currently yielding 3.79%. Spot gold now at $31.64 the ounce, up 2.7%. West Texas Intermediate crude down 4.3%, $59.65 a barrel. And Bitcoin down 3.3%, 80,390 on a Bitcoin. Amazon CEO Andy Jassy, in a note to shareholders, his annual letter, says the company must operate like the world's largest startup to meet demand for artificial intelligence and reduce bureaucracy. Again, recapping, the sell-off continues today on Wall Street, with the S&P after yesterday's rally down 3.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. To our worldwide audience out there, we're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us there. All right, here's my Janice story. The first time I ever went to a Starbucks, like 20 years ago, was waiting to go into a meeting at Janice out in Denver, Colorado. I'm not a coffee guy, so I had no idea what to order, so I just ordered what the person in front of me ordered. There you go. That's my Janice story. Laura Castleton joins us, U.S. Head of Portfolio Construction and Strategy at Janus Henderson, based in Denver. Laura, you sit back and you think about portfolio construction and strategy. How do you do that with this volatility that we're dealing with this year?
Well, thank you for having me. There's a couple more Starbucks that have popped up over since I'm sure you were here. Yeah, there's a little bit of volatility going on in the market, making our conversations a lot more in demand, you should say. Very clearly, planning long-term is what we need to be focused on for our clients. Near-term volatility is very extremely difficult. Heading into the tariff announcement a couple weeks ago, we were talking to clients about really staying the course, not panicking, but being more diversified than what we had maybe been in the past.
What does diversified mean? And I know that's a stupid question, but I say that and you look at the 30-year. If I own the 30-year for diversification, I just got burned.
Correct. So on diversification, what we're talking about in our client consultations, it's diversification of that typical 60-40 portfolio, absolutely. But then it's also diversification within the 60 and within the 40. And when we actually survey, so we've worked with over 25,000 model portfolios, over 6,500 clients globally, and recently came out with a piece just kind of isolating the average moderate portfolio that we come across. One of the biggest topics of conversation we're talking about right now today is actually the diversification within the U.S. equity allocation, because that concentration's reached north of 80% of investor portfolios. So it's not just across assets, but it's also within.
Hey, Laura, how about international markets? You know, in the first quarter, the rest of the world's markets really outperformed the U.S., the S&P 500. And that doesn't happen very often. Is that kind of a short-term blip, or is that something that we need to, think about longer term?
That's a very good question. It was very interesting to me to actually get some incoming calls from clients asking about international, because to your point, that has never happened before. I do believe with the tariff policy that's come in, obviously we don't know what's going to happen long term, but it is signaling a structural shift in what we're trying to accomplish longer term with our budget deficits. To me, that does warrant potentially diversifying away from only the US dollar. And so while international markets have been strong this year, there's a shift in how they're spending abroad. They're stimulating their economies, and that warrants having some diversification outside of just only that heavy concentration of the US dollar.
What do you expect in terms of this volatility? Like, clearly diversification is good for all. I mean, the idea is that it should be good for all investing climates. However, the longer the volatility goes on, the harder it is for investors to stomach that.
Absolutely. So that's exactly what we're coaching our clients through, is very clearly, even in the past week, if you wanted to make some pretty big bets on going into certain areas of the market, let's talk even fixed income markets, you could easily get whipsawed the next day, the next week. And so when you're talking about diversification, you need to be spread across the yield curve, across sectors within fixed income, across regions within equities, and you should start to see some bounces from some of these other areas while other parts of your portfolio are kind of dipping. So we're really talking about staying towards that long-term goal. And luckily, a lot of the clients that we work with are managing money for clients that have a long-term financial plan. So while they're getting headlines every day about the volatility, for the most part, they're being able to coach their clients that volatility happens. This is not outside of the norm, but on a long-term basis that you're still well within your reach of your goals.
Laura, are the folks at Janus Henderson, are you guys, is your base case a recession, or maybe we can skirt past it?
So base case is not recession. That obviously has been coming up into conversations quite a bit more. So it's not out of the picture this year. And remember, before the tariff announcements, growth was already slowing. There was already that lack of confidence within the economy that could bleed into slower growth, leading to a recession this year. So it's not without of the realm of possibilities, but it's not a base case. And it's also not necessarily a doomsday scenario for portfolios. Recessions happen. It doesn't necessarily mean it will be the exact recession we experienced the past 2 times, which were quite severe. And there are ways to plan around that, namely be high quality within your names, focus on the fundamentals within your company balance sheets, and within fixed income, really shore up the quality in your fixed income portfolios as well.
Before I let you go, corporate credit, spreads have blown out. They're continuing to blow out, particularly in high yield. Does corporate credit play a role here?
Yeah, that was one of our biggest overweights we saw in a lot of client portfolios leading into these events, was the heavy allocation to corporate credit, and really one direction spreads could go was wide. We've started to see that, although they've maybe started to trickle back in a little bit. That is still an ongoing risk and easily avoidable in our minds to be diversified across yield curve. So on the shorter end of the corporate credit spread curve, you do get a little bit more insulation from spreads widening. And then within the securitized area of the market, spreads were already a little bit wider. We were able to insulate ourselves from that area by hiding into securitized. But corporate credits are typically that canary in the coal mine, and it's something to watch for that recession indicator going forward.
All right, Laura, thank you so much for joining us. Laura Castleton, U.S. Head of Portfolio Construction and Strategy, Janus Henderson Investors, out there in Denver, Colorado. Great offices out there, great firm. Actually, it was when I was on the sell side, it was the biggest account in Denver. You had to get the vote from Janus, and I did. All right, let's talk retail here. We talked Jen Bartash, and she covers all the retailers for Bloomberg Intelligence. I'm going to talk Walmart here because, Jen, so goes Walmart, so goes, it feels to me, kind of just the overall retail environment. What's Walmart saying these days about its ability to pass along price increases to its customers, or do they take it in their maybe some lower margins?
Yeah, it's a good question, Paul. Walmart just had their investor day, and obviously tariffs were a large topic that management had to address. With Walmart, historically, they have such scale that they're really able to leverage that with their suppliers to try to negotiate lower prices. And they might have more of an advantage than some of the smaller retailers out there. At the same time, because they have such a diversified set of products. So if you think about it, as you know, Paul, Walmart is the biggest food retailer in the United States.
I know. Thanks to
over 50% of the revenue comes from just grocery. So their exposure to general merchandise is already a little bit lower, and not all of that is sourced from overseas. So their ability to offset tariffs without cutting into margin is probably better than a lot of other retailers that we're looking at right now.
How do they, okay, is it just scale, the power of scale that they have these agreements? And then at some point, how does that negotiation unfold?
It is, Alex, to your question, a bit. It's about scale because they order such huge volumes, and they order in advance that for their partners, there's some security in that, knowing what your orders are going to be and being able to plan appropriately. But at the same time, because they have such a diversified operation, they can spread out cost across it pretty effectively. So it's a combination of those two tactics that really will help them help them mitigate any of the impact from tariffs that we're seeing.
How about everybody else?
Yeah, I was going to say that feels like that's bad news for literally everyone else.
Yeah, I mean, how about everybody else? How do you think this is going to play out?
Well, I think what we're looking at is, especially for retailers with a high exposure to China specifically, given yesterday's announcement of the 90-day pause, and room for negotiation, I'm really focusing in on companies that have a higher exposure to China. That includes companies like Dollar Tree, that includes Five Below, and it also includes Target. And for those companies, what they all have in common is that they sell a lot more discretionary goods. And especially in the dollar store segment, you're talking about low price point goods where there's a lot less room to be able to raise prices without really disrupting your customers. And so those are the companies that we're looking at right now that really have the greatest exposure and have the highest difficulty in being able to manage through the tariff situation.
Hang on a sec. Cat and Jack stuff from Target is made in China?
Yeah.
Stop. Mind blown. This is where you go and you get your super cheap, like my daughter's going to grow out of this in 4 minutes, but it's still a cute t-shirt thing.
Right.
Wow, interesting.
Well, what I'll say about Target is they've done a really good job in the last 3 or 4 years of diversifying away from China. So they still have exposure to China, but it's not nearly what it was, say, back in 2017. So they've expanded into Cambodia, to India, to Vietnam, to other countries, which, and with the current pause in tariffs, is probably a big sigh of relief for Target, because they have done that diversification effort.
Yeah. All right. Jen, thanks so much for joining us. Jen Bartashis, Senior Retail Staples and Packaged Goods Analyst at Bloomberg Intelligence, joining us from Princeton, New Jersey via the Zoom thing. Yeah, I guess if you're a Walmart, you're an Amazon, boy, this scale really is going to pay off in this environment.
Yeah, I know. What about the small, like,
I
mom
know.
and
I'm
pops?
thinking about the mom and pops in my town, the toy store, the card store. I don't know what those folks are going to do. Particularly at the lower price points, as Jen was saying.
I have a friend who sells yarn for macrame, and she placed an order yesterday because the tariffs were put on pause, and she's like, either this was a great decision or I'm going to go bankrupt. Like, this is a completely binary situation. And she runs like a small business out of her house. Like, it's that kind of situation that many people actually do. All right, coming up, we are going to break down these markets more with Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business. He always has opinionated things to say, and I'm sure he will not disappoint. You're looking at an S&P almost off by 4% now. We're down by about 210 points. The NASDAQ off by almost 5%. Paul, we've seen this movie before. The VIX now back up to 42. And that long end, very sticky higher, up again another 7 basis points on the 30-year.
Yep, exactly. I'm looking at the 2-year down 12 basis points. So big changes in this shape of the yield curve. Well, more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Another leg lower. In fact, lows of the session again on the S&P 500 index. Down 213 points now, down 3.9%. Dow Industrials lower by 1,330 points on the Dow. A drop right now of 3.3%, while the NASDAQ Composite Index is slumping 785 points. For NASDAQ, a drop right now of 4.6%. Broad-based selling. Russell 2000 Index lower now by 4.9%. The 10-year at 4.34%. The 2-year 3.79%. Gold is surging $90 the ounce, up another 2.9%. Spot gold at $31.73. West Texas Intermediate crude right around $60 a barrel, was trading below that number. Right now, WTI 60.30. It is down 3.3%. The Consumer Price Index dropped for the first time in nearly 5 years. And with that story, here's Bloomberg's Vinny Del Giudice.
The surprise U.S. inflation data covering March show lower costs for energy, used cars, auto insurance, hotel stays, and airfares. Even with some U.S. tariffs already in place, the cost of some goods typically assembled in China were down. We're talking toys, appliances, and tools. Grocery prices were up, though, and egg costs once again ran high, as did meat prices. Looking ahead, the Federal Reserve is worried about the impact of tariffs. Vinny Del Giudice, Bloomberg Radio.
Prada has agreed to buy Versace for about $1.38 billion in cash, strengthening its position as Italy's largest fashion group by adding one of the luxury industry's best-known brands. Prada is buying Versace from Capri Holdings, which paid $2 billion for the brand in 2018. Capri's brands, by the way, include Michael Kors and Jimmy Choo. Right now, ADRs of Prada, they're surging 7.7%. Capri, though, down 9.7%. Recapping, stocks moving lower. Lows of the session now with the S&P today down 3.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, Tom from the Upper East Side writes in and says, I want to talk about volatility. He likes to call out the VIX for the equity market, 42. That's big time elevated. How about the MOVE index? That's also spiking over the last couple of days. Let's check in with Barry Ritholtz, see how he thinks about it. Barry Ritholtz is a host of Masters in Business on Bloomberg Radio. He's also the founder of Ritholtz Wealth Management. Hey, Barry, whether you're looking at the equity markets or the bond markets, volatility is the name of the game, and maybe the volatility and the spike in yields over the past 36 hours moved our president to maybe rethink some tariff strategies here. How do you think about volatility in both stocks and bonds?
So, such an interesting question. Let's unpack it in pieces. The volatility we've seen in stocks was really the equity markets adjusting to the impact of tariffs, lowering revenue for companies, reducing consumer spending, at the very least, reducing the growth rate from a GDP of, plus 2.5%, 3% to plus 0.5%, plus 1%, maybe even negative if you believe the Atlanta Fed GDP Now data, minus 2 or 3%. But the bond market reflects something completely different. And what you normally see during a sell-off in equities, you see a rally in bonds as money rotates. I think what we've seen over the past few days, when you see yields spike at the same time there's a massive sell-off in equities, that's telling us not that people are selling stocks or bonds, they're selling dollars. They're getting out of dollar-denominated assets and repatriating their capital. And anybody who understands the fixed income markets and the power of the dollar as the reserve currency says that is very distressing. That is very worrying. If someone were to say to me, what do you think motivated the president to go on this 90-day hiatus? Was it the stock market or the bond market? I'm going to tell them it was the dollar market. That's what moved him. So volatility is just a function of this giant shift in economic expectations and where we're going to be 3 or 6 months from now relative to the new policies.
Is that what's going on with the back end of the bond market and why those yields just do not seem to want to come down right now?
Yeah, so when you look around the world and you look at the Pax Americana we've enjoyed since the post-World War II era, we send people our paper. We get to print paper. Hey, here's an IOU. And they send us goods and services. I think that's a fantastic deal, as do most traditional economists and fund managers and policymakers. This is very much an outlier strategy, an outlier policy that we haven't really seen implemented. It's 100 years. You got to go back to 1930. So when you see the funky activity in the way both bonds are trading, the way spreads are widening, not tightening, and the way money is moving around the world, it kind of looks like other countries are battening down the hatches. Hey, there's a storm coming. Let's everybody come on in. There's a lightning storm out there. Get off the baseball field. Bring your cash and your assets with you. There's a little bit of doomer prep going on in capitals around the world, because not only are the goals and ends of the tariff policy not well understood, this was kind of rolled out in a very big-footed way. The Fed is so communicative about what they're going to do. Hey, we're raising rates in a couple of meetings. Hey, here are the metrics we're looking at. All right, we're getting closer. We're going to raise rates. All right, here's the press conference. We raise rates. Oh, and by the way, here are the minutes of our meeting. So the markets are very used to that. Suddenly, April 2nd, here's what we're doing, and it's giant tariffs. None of the market participants expected something that radical, and it rattled them.
So what do we do here? What are you suggesting to your clients here? Because we've got, again, the market rolling over again today.
So, a lot of times it's always fascinating to see the reaction to these things. A lot of times when you have a very rapid sell-off, hey, that rubber band gets stretched too tight in one direction, and it doesn't take a whole lot to cause, all right, we're going to make up a third, a quarter, a half of those losses. We saw it following September 11th. We've seen it in other major sell-offs. Look at the pandemic. So what we've been telling clients are, hey, unless you really need this money in 6, 12, 18 months, if you're contributing to your 5-year-old's 529 and you don't need this, for a dozen years for college, or 401k, a retirement plan in 10, 15 years, you'll be fine on the other side of this. The challenge is for people who are going to need this money over the next 6, 12, 18 months. If they're about to retire, nobody likes to hear, maybe you might want to hold off a year or two, but it really depends on their specific situation. The volatility we're seeing, what makes this so unique is that we're not looking at pandemics or profits or any of the other, or even sentiment. We're not looking at the usual metrics. We're looking at I don't want to be blasé and say whims, but we're looking at the thought process of one individual who we have seen tends to be spontaneous, improvs a lot, kind of mercurial. It's really impossible to predict what's going to happen when it's so dependent on simply the desires and whims of a single individual. It's kind of unprecedented when you look at market history. I mean, I have to go back to the Iraq War or World War II to see, how much a market's going to turn on what Churchill said in the UK or what Roosevelt said here. Even then, it's just so rare to see it so dependent on the moods of just one person.
Not the moods, instinct. As he mentioned yesterday, instinct. That's what he's going for. All right, Barry, thanks a lot. We really appreciate it. Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business. Definitely check out his weekly podcast as well. Coming up, Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst, will be joining us on Constellation and how costs may jump from 25% beer import tariff. We're going to get the breakdown on that in just a moment. S&P extending its decline to more than 4%. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everyone. Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. So Constellation Brands, a really good barometer for any kind of trade issues between the U.S. and Mexico, issued a downbeat guidance due to some of those tariffs, plus muted demand. They now expect earnings of about $12.33 to $12.63 a share in the fiscal quarter for 2026. Ken Shea is Bloomberg Intelligence Senior Consumer Products Analyst joining us. Hey, Ken, we mentioned muted demand and tariffs. How much of the wobbliness is because we're just drinking less, and how much of it is because prices will be higher?
Yeah, hi, Alex. Well, you asked the million-dollar question here. There's so many moving parts to the Constellation storyline here. It's really a challenge on analysts to put it all together. But you touch on the right points, and that is the near-term challenges facing Constellation and other brewers, for that matter, is weak demand. A lot of it is economic. Constellation would also point to their key demographic is the Hispanic demographic, and they're having a little tougher time with the employment situation and the slowdown. But they have some longer-term threats also. I mean, you have more substitute products. You have legal cannabis. You have the hemp-based CBD THC products that are now gone Main Street. You don't have to go to a dispensary to buy THC anymore. You can just go to the local liquor store. You have the GLP-1 drugs, where people our studies show that are consuming less alcohol because they're on those drugs. All those things are weighing on the near term and perhaps longer term sales growth potential for beer. And that's what the analysts are trying to wrap their heads around right now.
What is the price elasticity on alcohol? Can these companies pass along price increases?
Well, it depends on the product, Paul. The good news among that otherwise onerous outlook is that Constellation's Corona and Modelo brands lead the market in terms of growth. Those products continue to command premium prices. They're growing faster than the market. So they're generating best-in-class operating margins on those products. But, you know, they're not immune to the slowdown. And clearly, they lowered their guidance yesterday. While their fiscal fourth quarter came in a little better than expected, some of the concerns out there is they lowered their longer-term sales growth projections. It used to be, you know, a high single-digit kind of sales growing segment for many years. They came out and said, you know, over the next few years, you're going to see more like low single-digit. And the analysts were a little taken aback by that. And to Alex's question before, how much is that near-term, you know, cyclical economic issues, and how much is longer-term demographic things weighing on this category?
So,
and no one really knows, so we'll find out.
Nobody knows, right? So then what does Constellation do about that? Like, do they go build a beer plant in the U.S.? Do they look for some M&A? Do they pare back? Like, what do they do?
Well, they're innovating. I would argue that Constellation is one of the more innovative beer companies. So they're taking that base of a really good brand family of Corona and Modelo, and they have Pacifico, but they also are extending into cheladas, which are very flavorful beer malt-based products. They're getting into the malt-based, you know, seltzer markets a little bit. They used to do it, but I think they're coming back with a better product now. They have a no-alcohol version, Corona. So it's innovation, I think, that they believe can continue to drive sales growth. But there's no silver bullet. I mean, there's no big acquisition out there, I don't believe, that they're going to make to enhance their growth. I think they have a good brand and a good asset to grow. But again, you're not going to escape the long-term headwinds facing alcoholic beverage products in general, as a matter of fact.
So can you follow the beverages, the tobacco, and the cannabis companies? Is there a place to hide in your sector here in a world where we're going to see potentially slower growth from some of these trade policies?
Well, of the ones you mentioned, Paul, I mean, the tobacco, particularly cigarette company, those cigarettes are some 90% of that business still. They are pretty much immune to the tariff situation. It's pretty much a domestic business. Yes, there's some tobacco leaf imports that come in and so on, but by and large, that's a domestic business. So if you're worried about tariffs, perhaps that's a place where you can go. In terms of, you know, beyond tariff threats, really the soft drink side of beverages is a good place to be. I would argue that even the tried and true carbonated beverage sodas, the diet sodas, are still performing pretty well. They're innovating well. Keurig Dr. Pepper continues to come out with new innovation that's moving that category. They're kind of leading that category's growth right now. They're doing a pretty good job doing it. So that's a good place to go in terms of the universe that I cover. Cannabis is tough. Cannabis, the regulation on cannabis is not easing. The Trump administration is not being kind to the cannabis industry, and we're not expecting much in the way of legalization, liberalization near term, with the exception of some states. Some states will probably continue to legalize, but from a federal point of view, I would wait for the next administration.
Yeah. Dr. Pepper. I haven't had Dr. Pepper in a long time.
Big Texas drink.
I think I kind of want one.
Yeah,
all right.
Good. Good.
And they have Diet Dr. Pepper too. This is cute.
Really.
All right, Ken. Thanks a lot. Really appreciate it. Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst. I just want to point out we've been talking about the back end of the curve, right? Moving pretty hard. So's the dollar. The Bloomberg Dollar Index is down a whopping almost 1.5%. Again, these are moves that you don't see in these kind of markets, and I think there was a zeitgeist, the conversation yesterday that, like, do you want the U.S. to start trading like an emerging market?
No, thank you.
And is that what we're kind of looking at?
Yep. So just a lot of uncertainty out there, certainly.
That kind of sums it all up. All right, that wraps it up for me and Paul on this Thursday. Balance of Power with David Gura and Kelly Lyons is up next after this global news update as you're taking a look at the equity markets still on the decline. S&P up over 4%.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. Another deep dive on Wall Street. A day after stocks soared, the Dow Jones Industrial Average is down about 1,500 points. And there's a new number that characterizes the trade war against China. CBS's Linda Kenyon at the White House.
The White House says it's a clarification. When President Trump yesterday announced a 125% tariff on Chinese imports, he did not include the previously announced penalty of 20% for fentanyl. By adding that penalty, the tariff against China is now 145%. The Trump administration says these escalating tariffs follow China's decision to retaliate with higher tariffs of its own against U.S.-made products.
Top Democrats are calling for an investigation into possible insider trading related to White House moves that paused tariffs yesterday against other countries ahead of the market surge. Latest look at inflation from the government shows prices in March rose 2.4% from 1 year ago. CBS's Jill Schlesinger breaks down the major components.
Consumers say they are bracing for higher prices, but at least in this report, the news was pretty good. Food costs were up by 3% from a year ago, while energy prices were down 3.3% from a year ago.
A close vote today in the House of Representatives.
The yeas are 216, the nays are 214. The motion is adopted without objection. The motion.
And by a narrow margin, Republicans pass a budget blueprint that's a key move to push through the Trump agenda, also passing a bill that would require proof of citizenship when registering to vote for federal elections. LA police have arrested the wife of Weezer bassist Scott Schreiner on suspicion of attempted murder after they came upon her during an unrelated chase. CBS's Elise Preston.
The chase through the backyards of several homes led police to Jill Schreiner. Police say she was holding a gun and pointed it at the officers. They commanded her to drop the weapon. When she didn't, they fired, wounding her in the shoulder.
A jury has awarded $1.68 billion to writer and director James Toback's accusers, as we hear from CBS's Michael Wallace.
Many of the 40 women claim Toback approached them on the streets of New York City, promised to make them movie stars, then sexually abused them. Toback was nominated for an Oscar for writing Bugsy.
I only talk this much before I'm going to kill someone.
He has long denied the allegations and has argued New York's 2022 law extending the statute of limitations on sexual abuse cases violated his constitutional rights.
OpenAI is countersuing Elon Musk, alleging unfair competition. And on Wall Street, recapping the situation, the Dow is down 1,691 points, the S&P down 260. This is CBS News. lot's been said in recent months about a former first couple's future together. Now the subject of some of the talk speaks out.
Former First Lady Michelle Obama has broken her silence about talk of an impending divorce.
Like all women and a lot of people, I operate from guilt. What should I do?
She explained on Sophia Bush's Work in Progress podcast that after years of letting her kids and her husband's schedules dictate her own,
I chose to do what was best for me.
The 61-year-old scoffs at speculation she and the former president have gone their separate ways after she was a no-show at President Trump's inauguration and Jimmy Carter's funeral. Deborah Rodriguez, CBS News.
The Italian fashion house Prada announced today it's reached a deal to buy longtime rival Versace for $1.38 billion. The deal will create a luxury group that could better compete with Gucci. I'm Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
A step forward turns into maybe a big step back for the equity markets. Welcome to Balance of Power. I'm Kaylee Lyons in Washington, D.C. Joe Matthew is off today, and joining me in his stead is Bloomberg's David Gura, who makes his trip to Washington in the midst of a trade war between the two largest economies, which our understanding about has changed a little bit as the 125 reciprocal tariff on China, which the president announced yesterday in an escalation, is added on to the 20% fentanyl-related tariffs, bringing the total to at least 145% in the market today, David. Certainly taking note of that.
Yeah, the enthusiasm that we saw yesterday certainly waning as the session goes on, and I think we see that wall between the U.S. and the Chinese economy getting higher and more fortified in the hours that have passed since yesterday, and I think a lot of concern and confusion about what's going to happen here over these next 3 months or so as these negotiations take place with the White House and all these countries.
Yeah, so maybe that's a taste of the bad news today. If there is any good news, if you're out there looking for it or you are hoping for progress on tax cuts, we did get that today on Capitol Hill. The House was able to pass a budget blueprint that had already passed the Senate that sets the stage for the real fight still ahead, which is crafting a reconciliation bill that's going to cut more than $1 trillion in spending, in theory, to make permanent or at least extend the 2017 tax cuts. So you, again, have some forward progress, but it's kind of being shadowed by the tariff.
Absolutely, and this was no sure thing as well. You look at what played out yesterday on the Hill, and there was confusion once again as you saw kind of more right-wing members of the Republican caucus there having to leave the chamber with Speaker Mike Johnson to negotiate a series of cuts. They liked what they heard from the President of the United States and from the Speaker and eventually voted for it. But now I guess our focus shifts to what's the pathway going forward here for that legislation, sort of all of the President's legislative priorities.
Yeah, and maybe we'll hear from President Trump about that. I would note he is assembling a meeting of his cabinet, and the press is going to be allowed in at some point, which means we should have a taste that we can bring you live here on Bloomberg Radio when that begins. But much is unknown, as always, with this White House.
Absolutely. So as we look at the markets dropping here on this Thursday afternoon, the VIX rising once again, seeing that volatility, that fear gauge spiking once again. Let's turn to New York and Charlie Pellet for an update on the markets. Charlie?
Hi, thank you very much, David Gore. Thank you very much, Kaylee Lyons. You mentioned the VIX, 48.01 right now on the VIX. The Dow, the S&P, NASDAQ, very much in the red right now. However, let us keep this all in perspective. Yesterday, we had the S&P surging by 9.5%. NASDAQ yesterday up 12.2%. History, yes. So right now, we've got the S&P down 4.8%, down 261. Dow Industrials down 1,628, a drop of 4%. The NASDAQ Composite Index down 5.5%. Risk appetites vanishing after the biggest burst of buying in years. The 10-year at 4.37%. Your 2-year now at 3.81%. Spot gold trading right now at $31.56 the ounce. Gold advancing today by 2.4%, up $73. A retreat for West Texas Intermediate crude back below $60 a barrel, $59.42. WTI down by 4.7%. Tiffany Wilding is economist at PIMCO, and this morning on Surveillance, she talked about tariffs and markets.
You are seeing the president basically do what he said he would do on the campaign trail. We think the 10% tariff across the board, that's sticking. Higher tariffs on China is sticking. I mean, they are very effectively trying to decouple the U.S. economy from China, and that's exactly what they said they would do.
Tiffany Wilding of PIMCO. Speaking of China, it has announced it will curb imports of Hollywood films, opening a new front in its trade war with President Trump and the U.S. Shares of entertainment companies are being hit hard right now. Case in point, the Walt Disney Company down by 7.5%, Paramount Global down 1.5%, Warner Brothers Discovery plunging 13.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now with David Gura and Kaylee Lyons.
Charlie Pellet, thank you very much. David Gura here in for Joe Matthew, and we continue to process what happened yesterday, that extraordinary reversal that we saw in the markets. The president backing away from what he said was going to be a sustained plan to have a baseline tariff of 10% and a series of reciprocal tariffs on countries around the world. He decided to just go with that 10% baseline, with the exception of China. That tariff now well over 100%. Again, a huge market reversal yesterday. Here's what the president had to say after he decided to make that change.
There's a lot of winning out there. We're having a good day in the stock market, as you can see, an all-time record day, and hopefully it continues. I think it should. Our country's stronger than it's ever been, and somebody had to do that. We had to take the medicine. We had to go through the operation, and that's what we've been through, and a lot of presidents would not have done it. No president would have done it, I think.
So perhaps the president is not going to be super enthused to see that the market reaction is not continuing today, as we saw yesterday, as we contend with these tariffs, knowing full well that A, there is always still uncertainty out there as to whether or not the president could change his mind again, and B, because of that uncertainty, even with the delay, it already could have had or still will have an economic impact. And that is the subject of a piece of analysis that you can find on the Bloomberg Terminal and online today, in part written by our colleague Sean Donnan, Bloomberg senior economics writer, who is joining us now here on Balance of Power. So, Sean, as we consider that we had already heard from a number of corporations, be it Walmart or Delta, even Amazon reportedly was canceling inventory shipments from China. Even before this delay was announced, already we've seen it affecting behavior and, I would guess, the economy as a result.
Yeah, no, absolutely. And I think that's one of the big takeaways from the last 24 hours. Yes, while the president has scaled back some of his tariffs, we still are landing at this 10% baseline rate, which is going to cause a lot of recalculating related to supply chains for companies. But then you have this much bigger, really a prohibitive tariff of 145% now on imports from China. And, you know, what we're hearing over and over again from people in the supply chain business, from people who monitor the data, from actual companies who have orders, you know, waiting or literally at the kind of loading dock in China to ship to the United States, is that they're all hitting the pause button. And that is going to hit the U.S. economy. It's going to hit the global economy. People, you know, some of the companies that we've been talking to have a few months worth of inventory that they can work through. But after that, it's, you know, huge question marks about what comes next. And that's this kind of uncertainty effect that economists have been talking about for weeks when it comes to tariffs and the economy. You know, how do you build a factory in this climate? How do you hire people in this climate? Everyone's kind of hitting the pause button, and that's never good for the economy.
Sean, we've heard the president lean into two metaphors. One is medical. He talked about the patient and the medicine that he's administered. The other is sartorial, talking about the kind of tariffs he aims to put in place. And he said, they're not off the rack. They're going to be bespoke. They're going to be tailored. And I'd love to get your sense of what these next 90 days look like, what the White House has telegraphed about how they're going to embark on all of these negotiations with all of these 70-plus nations, trading partners in the months ahead. Any clarity on what that's going to be like? And I think we all know that when it comes to these trade agreements in the past, these have been years-long endeavors in the making.
Look, let's just build on those metaphors. I think what the president announced yesterday is that the operation is going to take another 90 days. And what other people are saying is there's going to be some side effects to the medicine, and they may not be pretty. And then, you know, if we're talking about the suit, well, he's, you know, the off-the-rack suit is that 10% baseline tariff. Everyone gets that off-the-rack suit, and we're not moving into a world of tailor suits. We're moving into a world where, you know, they're going to be shortening the sleeve a little bit here and there to kind of fit the client. This is going to take time. A lot of these negotiations in, the kind of pre-Trump world took months and years to carry out. They're incredibly complicated. In fact, that's why a lot of times trade negotiations don't get concluded. It's just really hard stuff to do. The whole idea that you can solve all of the tariff barriers facing U.S. exports in the world in the next 90 days and get countries to agree to swallow a 10% baseline tariff, which is what the president seems to be doing. And we've heard from other parts of the administration that, getting below that 10% is only going to happen if you come with a kind of almost a miraculous deal from the other side. And then we also have these sectoral tariffs that other countries are going to want to see taken off. If you're Japan, if you're South Korea, if you're the European Union, these 25% auto tariffs are as meaningful as the 10% baseline tariff, and perhaps more so.
Yeah. Well, and there's steel and aluminum to consider. The president's still promising tariffs on pharmaceuticals, for example, possibly lumber, semiconductors. There is no sign that this is over yet, obviously, Sean. And to the point David was asking about the countries that do want to negotiate, I wonder about the countries that might not, specifically China. As the president argued yesterday, he thinks China wants to make a deal. But Sean, have we really seen any indication of that from Beijing?
No, look, I think the indication we're seeing from Beijing, at least publicly, is exactly the opposite of that. They are, battening down the hatches. They were meeting in Beijing today. We reported out of Asia earlier to kind of talk about the stimulus measures to kind of shore up the domestic economy to weather the tariff storm. I think there's a view in China that you hear from analysts is that the leadership in Beijing has decided that they can, plow ahead without the United States in that economic relationship if they need to. In fact, if you think back to the first Trump term and the Biden term and all the export controls that were put in place there that were meant to kind of limit China's access to semiconductors and other important products, they've been taking a kind of, if you're looking at it from Beijing's perspective, they've been seeing kind of hostility coming out of Washington for a while. This is obviously a huge escalation, but is it the type of thing that's going to cause you to enter a conversation? Do you think that these tariffs are going to go away? What is it that you can give to the United States to make Donald Trump happy? Donald Trump wants to eliminate the trade deficit with China. That's going to be pretty hard to do. And, meanwhile, caught in between these two economic giants are the companies that do business there and the consumers that buy those products. That smartphone is not getting any cheaper today.
Sean, we got about a minute left, and I'm looking here at the NASDAQ down about 6%, the S&P 500 down about 5%. Have we decoupled from China? This was something that the past administration pushed back on a lot. They said that wasn't their objective, to decouple from China. Are we effectively there with the tariffs where they are today?
So look, I think that the view of a lot of experts is that Donald Trump has never been someone who wants to decouple to China. He simply wants to sell more to China. But with these tariffs, they're becoming so prohibitive that we are certainly a lot closer to that decoupling cliff edge, as we put in the headline in the story that we ran out yesterday on this subject, than we were a year ago when Janet Yellen was in Beijing and saying America does not want to decouple. The cost of that would be too great.
Sean Donnan, thank you very much for the time. That's Sean Donnan, Bloomberg senior economics reporter, senior economics writer, and as Kayleigh said, a piece that I think both of us commend to you to read with him and Enda Curran writing it. This is Balance of Power on Bloomberg Radio.
6:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at another down day for the U.S. stock market. This after yesterday's surge. Right now, we've got the S&P dropping by 5.7%. The S&P is down 313. Yesterday, you recall, the S&P 500 index gained 9.5%, but right now down 5.7%. The Dow is down by almost 2,000 points right now for the Dow. That represents a drop of 4.9%. NASDAQ is down 6.6%, down by 1,132 points. The 10-year at 4.36%, the 2-year 3.79%. Gold now at $31.60 the ounce. Spot gold surging 2.5%. West Texas Intermediate crude below $60 a barrel, very close to 59 even right now, down by 4.9%. And Bitcoin today is down 5.5%, 78,520 right now on Bitcoin. CarMax shares are plunging after backing away from the timing of its financial goals, joining a growing list of companies indicating that uncertainty around President Trump's trade war is making long-term planning difficult. Shares of the used car retailer, they are down now by just about 19.8%. Again, recapping another sell-off for the U.S. stock market with the S&P 500 index dropping now by 6%. Keep it locked into Bloomberg for the latest on these fast-moving markets. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your hosts, David Gurup and Kaylee Lyons.
All right, Charlie Pellet, keeping track of the steepening market losses today from New York. Thank you so much. I guess not many people paying attention to the words of the House Speaker, Mike Johnson, which actually sound pretty familiar to the words posted on True Social by Donald Trump yesterday about this being a good time to buy in the stock market. Certainly a lot of investors don't seem to be feeling that way at the moment, as there is no bid coming in like we saw yesterday. But of course, David, we were hearing from the speaker, not just talking about the markets, but also gloating because he was able to pass on the House floor something that we weren't totally sure last night he was going to be able to do, that budget blueprint that looked a little bit different coming from the Senate than what the House wanted. And yet he, with the help of President Trump, was able to get this thing done.
Spoke with a weary Congressman Brennan Boyle last night, who'd spent the day kind of navigating all of this, uncertain of what the day was going to hold in those negotiations. But indeed, the speaker had conversations with the president and members of his caucus who were reluctant to go along with that initial piece of legislation. Mike Dorning is with us now. He's the deputy leader of our Capital Influence team here in Washington. Mike, contextualize this achievement here for the House Speaker. There was something familiar about what happened on the House floor yesterday when these kind of renegade members of the Republican caucus, and he had to walk out, get down to brass tacks, I guess, and try to hammer something out. What's your takeaway from what's happened, and what does it portend for these negotiations going forward?
So I think the most important takeaway whenever you're thinking about these is that the Republicans universally want these big tax cuts. So they're committed to this. They are going to get this done. They have some differences over how much to cut Medicaid and social safety net programs. And it's all about keeping that going. They have political momentum now early in the year. Even though they don't really need to get this done until the end of the year, they don't want to risk becoming unpopular or their political momentum slipping. So they need to lock it in as soon as possible. So it's all about keeping that going. And you just have this tension between the moderate Republicans who would rather not cut Medicaid and food assistance so much, and the fiscal hawks are saying, we don't want to run up the debt too much. Yeah. And so this is all about norming differences and having squabbles and like positioning and a little screaming here and there.
In good measure. Yeah.
And it's just moving it along until someday they'll resolve that tension.
Well, and the tension you're speaking to is just the tension within the Republican conference in the House, not even the kind of tension that exists between what many people in the House want versus what the Senate may be willing to tolerate. We heard from the Senate Majority Leader John Thune, who also had to have a hand in convincing some of these holdouts that many senators, I think was what he said, view $1.5 trillion of cuts as a minimum. But that doesn't necessarily seem like a commitment to cut as much as the House wants.
That's a way of whitewashing away differences. Yeah, a lot of senators would like to do what you want to do, but like he's not saying that we will do that.
Yeah.
He's just saying, yeah, a bunch of people. It sounds good in the moment when you're saying it, but like any good politician, he knows how to sound like he's assuaging you without really committing to anything other than I feel your pain.
Mike, a question just about the atmospherics on Capitol Hill. So we were talking about the way that the speaker has embraced all of this, but as we look at our terminals here and see the NASDAQ down 6.8% today, the sell-off deepening and extending despite what happened yesterday with the president's announcement. How does the conversation shift? How much introspection is there about the way in which all of this has been sequenced, and how much irritation is there among Republicans that this component of the president's economic package wasn't what came first, it was the tariffs?
So the Republicans are, underneath the surface, pretty divided on the tariff program, and there's a lot of traditional Republicans that really are free traders and not that interested in the tariffs. But publicly they will say, hey, Trump's just trying to get a fair deal and, he's doing the right thing. But you can see that they're worried, but they don't feel like there's much they can do. And particularly for a lot of Republican senators in particular, but even House members represent agricultural areas. And those are areas that are going to get hit hard by the retaliation from China, and they would hit harder if other places retaliated. Yeah. Last time, Trump essentially just wrote them a check for their losses. But their losses are going to be bigger this time, and it's just going to be harder to manage writing like a big check at the same time that you're cutting Medicaid and food assistance and tax cuts and talk about debts and things. They'll probably manage to do it in the end, but those people get nervous.
All right, Bloomberg's Mike Dorning, who helps lead our Capital Influence team here in Washington. Thank you so much for joining us on this day. Well, you may be able to cling to some good news on Capitol Hill in terms of forward progress. Markets don't seem to be taking much stock in the prospect of tax cuts coming down the line. As we just saw, the NASDAQ 100 briefly cross 7% declines, right now down about 6.6%. The S&P 500 down the better part of 6 percentage points as well. And a lot of that selling pressure is into the technology stocks that were absolutely ripping yesterday. Apple, after having its best day since 1998, is now down about 7.25% on the day. Nvidia is down 11 percentage points as they contend with the 145% tariff that is on Chinese goods. And all of this, David, overshadowing what could have been good news for the markets in terms of inflation data today as well.
We got that CPI data from the Labor Department this morning. CPI excluding food and energy up 1.1% since February. The entire overall CPI down 0.1% since February. So yes, it could have been good news, as you say,
and yet
been eclipsed by all of this.
But let's still talk about that data, even though it doesn't seem to be making much difference in risk appetite today. Stuart Paul of Bloomberg Economics is joining us here from New York. So, Stuart, just talk about the data, which obviously doesn't reflect the impact of whatever tariffs were put into place anyway. But does this send a positive signal about the economy, or do the fact that it is backward-looking data completely override any positivity?
Well, so it depends what we're really thinking about. So if we're thinking strictly about the reciprocal tariffs that have been put in place, you're right. The data don't reflect anything about the reciprocal tariffs. If we're thinking about the tariffs, the supplemental or additional tariffs that were implemented on China, particularly with regard to fentanyl, this should, back in February, this should have shown some of the tariff impact that was imposed on China. Instead, we saw core goods deflation, and we saw consumers pulling back spending. We saw limited price pressures on some of the more discretionary services categories, things like airfares, hotels, and car rentals. So things really related to travel, those are really sentiment-driven. They're really discretionary services categories. So if we could take anything from the report today, it is that even though there were some tariffs in place, limited tariffs on China, there was not full pass-through on the goods that would be most effective, and sentiment is starting to have an effect on some of the harder data. We are seeing the categories most affected by sentiment showing less price pressures. Those are those discretionary services categories.
The Fed obviously taking notice of all of this, and Austin Goolsbee, the Chicago Fed president, speaking at the Economic Club of New York, as we're on air, talking a bit about the inflationary aspect of these tariffs, saying they make both sides of the Fed's mandate worse. They deliver a stagflationary shock to the economy. Stuart, what's your sense of how they are processing this? I think back just a couple of weeks ago, Fed Chair Jerome Powell really adamant that the Fed was going to, for the moment at least, be able to kind of look through these tariffs, obviously seeing how they play out, what they were going to be, and how they're going to play out. How does the Fed sort of think through the tariffs and dovetail that with the data that we got this morning?
There are a few different factors that are in play. So not only is the Fed thinking about tariffs, they're also thinking about tax policy, immigration policy, and so on. And whenever Chairman Powell has the microphone, he's quick to remind listeners that the Fed has to take into account the totality of all these policy changes. As you mentioned, there is two-sided risk to tariffs. That's to say that it does create some demand destruction, and so you could see lower real growth, but it also creates inflation pressures, and the Fed needs to contain that inflation. So what's the Fed going to do? Is it going to hike or is it going to cut? Well, in the same set of comments from Austin Goolsbee, he reminded folks that the Fed's timeline is not the same as the market's timeline. Now, markets are pricing in about 92 basis points of cuts from the Fed this year. In the latest summary of economic projections, the Fed showed just about 50 basis points of cuts. If you think, as we do, that the Fed is going to be more concerned about inflation pressures than slowing growth, you would think that the Fed might even cut just one time in December of this year. And I think that it's that realization that could be taking some of the steam out of equities, that could be resulting in some of this retracing that we're seeing.
Well, and that's just what's going on in equities. I also want to talk about the bond market, Stuart, because the president specifically called it out yesterday when talking about his decision to implement this 90-day pause on reciprocal tariffs. He said he saw the bond market getting queasy. He felt that people, and this is his word choice, were getting yippy.
Yippee.
Right now, we're up 3 basis points on the 10-year, 436. The 2-year yield, of course, the Fed-sensitive part of the curve, down 9 basis points at 381. But clearly, the president got a little bit spooked by what he saw in the bond market earlier this week, Stuart. And I wonder, as you're considering kind of where the economy is and the kind of Fed uncertainty, the pressures that now exist with tariffs, if you actually think the president, with his pause, was able to get the bond market out of the woods, or is there a possibility that the Fed might need to intervene in the bond market at some point?
Yeah, Kaylee, I don't think that the Fed is going to be rushing to provide liquidity. I don't think that they view it as necessary right now. The 3 big pillars that have been affecting the bond market over the last 36 hours have been, 1, fear about China dumping securities, but it doesn't look like that's the case. Fear over a leveraged basis trade resulting in financial stability concerns and additional instability that might force the Fed to intervene, to your point. And third, just a couple of auctions yesterday and today that have people a little bit nervous. Are banks, are dealers going to have the space on their balance sheet to take down the bonds that are being auctioned? Is there demand out there in the market for the bonds that are being auctioned, especially given what we've been seeing over on Capitol Hill, and with concerns about the extent to which the U.S. is going to be able to grow out of its increasing debt burden? And with all of those factors in play, it's all contributing to the queasiness. It's not necessarily a reason for the Fed to step in imminently, certainly not imminently, and instead we're just going to need to see some auction results.
Seems like we may be seeing a second bout of that queasiness, and you mentioned the Fed stepping in should it come to that. What does that look like? If you're to imagine that or play clairvoyant here, what could the Fed do? What are they watching in particular? We, of course, know that China holds so many U.S. treasuries.
Yeah, so the international capital flows data that would reveal officially whether China has been dumping bonds, it comes very much so with a delay, but I think that the larger point is that China's been holding its U.S. securities portfolio basically constant for over a decade at this point, and the volume of long-term securities that it has on its balance sheet is not necessarily the thing that's going to cause the most concern. What would cause more concern, especially for the Fed, would be if something like a basis trade were to be blowing up, but it doesn't look like that's the case. So what tools does the Fed have in its arsenal? It can basically provide unlimited overnight liquidity if it wants to. There's very little that the Fed that limits the Fed's capacity. I think that the Fed would, however, be very slow to lower interest rates, even in response to, let's call it bond market queasiness. I think that the Fed would only lower rates in pretty dire circumstances. Doing so, a supposed emergency rate cut would actually instill more fear in markets. And so I don't think that the Fed is going to be rushing to respond through interest rate policy to any sort of queasiness that we're seeing.
Well, so there's that. I guess you're not necessarily going to see the cavalry riding through to the rescue in terms of the monetary policymakers, which puts more onus on the fiscal policymakers and what's coming out of the White House, Stuart. And they continually have argued that even with this kind of pause period in which they're going to be negotiating better trade deals, that these deals are aimed at getting a better deal for America and also bringing back manufacturing to the United States. Can you just talk about, A, how long it would take if those investments were to materialize on the part of companies deciding to build out more infrastructure and hire more people here, but also how difficult that is to do in an environment like the one we are currently experiencing?
It's going to take a long time. Even the money that's been offered up, even the money that, the $1 trillion or so that's been waved around as investments by foreign companies and foreign countries in the United States, it takes a long time to stand up. Even brownfield investments, new factories, it takes years, 18 months at a minimum to really start ramping up U.S. capacity in a meaningful way. I think that instead what we're likely to see is, in the interim, would be an increase in U.S. capacity utilization, which right now is running at about 78%. Instead, even just based on sentiment, you see, however, a retreat in factory activity. We just saw that in March, according to PMIs, manufacturing PMIs. Looking ahead to next week, one of the first data points we're going to get next week is March industrial production. And we're expecting factory output to be basically flat, right? Even though all these manufacturers are seeing tariff threats, they're seeing tariffs that are being put in place, the actual increase in aggregate hours worked in the manufacturing industry was just a few thousand hours in March. So it really does take a long time to get those factories fired up in response to tariff policy. And what we saw just yesterday, this walk back of tariff policy for everybody but China, basically, is reason for companies to sort of slow their roll when it comes to investment. And the final thing to think about is that all of this uncertainty puts upward pressure on rates. When you're financing a brand new factory or a retooling of a factory that's been sitting idle for decades, you don't want to see higher financing costs. So the upward march in interest rates right now is something that's going to take some of the steam again out of the idea that factories could be fired up.
Stuart, last question here. As you're kind of going through your calculus and looking at the health of this economy, you mentioned sentiment just a moment ago. At a moment like this where there is so much uncertainty, how much do you kind of hold that up higher than the hard data? So we're kind of waiting for this moment in which the hard data might reflect those inflationary pressures we've been talking about. How much at this moment does sentiment matter to you as you try to get a handle on where the economy is today and where it's going?
Under normal circumstances, I put very little stock in sentiment. Under current circumstances where conditions on the ground are evolving so quickly and the news cycle is evolving so quickly, it's actually far more important to put a lot of stock in sentiment data. And when you see political uncertainty indexes spiking through the roof, when you see that taking some steam out of investment plans, when you see companies that are both revising guidance or even just withdrawing guidance completely, I think that actually matters a lot. So as we get deeper into earnings season, even beyond sentiment, I'm going to be looking towards guidance for some insight, especially into investment plans. And then that's going to matter a lot for developing forecasts for the larger macro data prints.
And in these early days of earnings season, seeing a lot of kind of revamping of those forecasts, that forward guidance. Stuart Paul, thank you very much. Stuart Paul, U.S. economist with Bloomberg Economics. As I look at my Bloomberg screen, see a lot of red on it. I know Charlie Pellet does as well. Let's go to him in New York for an update on these markets this afternoon.
All right. I thank you very much, David Gore. Thank you very much, Kaylee Lyons. We are off session lows right now, but let's get right to the numbers. We'll keep it all in context for you here at Bloomberg. S&P right now is down 4.94%, looking at a drop currently of 268 points. You run the HCPI function on the Bloomberg. We can see at the worst level a few minutes ago we had the S&P down by 6.3%. Again, keeping it in context, down now by 4.9%. The Dow down 1,722 points, down 4.2%. NASDAQ is down 997 points now, a decline of 5.8%. So the bottom line, stocks are sinking as investors continue to worry about the impact of the U.S.-China trade war on corporate earnings, economic growth, and new hiring. The 10-year, 4.34%. The 2-year, 3.80% on the 2-year. Spot gold up $82 the ounce, up 2.7%, $31.65. And West Texas Intermediate crude now down 4.9%, 59.34 a barrel. So again, equity markets selling off. The Dow, the S&P, NASDAQ deeply in the red. We are off session lows. The Russell 2000 index of small cap shares down 5.5%. Again, the S&P right now down by 4.9%. You got to keep it locked into Bloomberg Radio to find out how things shake out right through the closing bell, and of course how Asian markets react tonight. Again, right now the S&P down by 5%. Balance of power continues right now, and back we go to Washington. Once again, your hosts David Gurup and Kaylee Lyons.
All right, Charlie Pellet, thank you so much. I said it yesterday, what a difference a day makes. And once again, a different day and a very different story in these markets than what we were dealing with yesterday. As the president, of course, yesterday announced a 90-day pause on reciprocal tariffs for countries that hadn't retaliated against the U.S. That means everybody but China. And his reasons for doing so were in part due to market activity, the kind of which we are seeing once again today. Although while we're focused on equities today, the president seemed specifically to be worried about the bond market. Here's a reminder of his commentary.
I thought that people were jumping a little bit out of line. They were getting yippy. Bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy. The big move wasn't what I did today. The big move was what I did on Liberation Day.
Markets apparently getting a little yippy again today, as we just heard there from Charlie Pellet. I want to bring in Rick Davis, partner at Stonecourt Capital, Gina Sheehan Zaino, senior democracy fellow at the Center for the Study of the Presidency and Congress, Bloomberg Politics contributors both. And Rick, let me start with you. And you watched what unfolded yesterday, and there was kind of a uniqueness to that moment, what the president did there. I'm curious sort of what you think the path forward here is for the president if we see this kind of sell-off deepen further and perhaps go into resurface or continue over the course of these next 90 days? What are his options? They seem decidedly more limited in light of what happened yesterday.
Well, I don't know if they're more limited, but, yesterday reminded me of running John McCain's presidential campaign in 2008 when the markets collapsed and Congress said, oh, we're going to come to the rescue with this TARP bailout, and then they couldn't get the votes for it, and the markets were swinging wildly, mostly down. And I thought, this is the biggest impact on a global financial market by Congress in history. And yesterday was the biggest impact of our markets by a president in history. So we see the decisions being made at the government level having just really profound impacts on our markets and our economy. And this is a global impact that the president had yesterday. So look, I think that what we're hearing today is that more and more executives, more and more bankers are saying, hey, if you can actually rationalize these 75 countries that are saying, hey, let's negotiate to a fairer trade regime than what we started with, then maybe some of this pain and anguish that we're going through right now will be worth it. But let's go cut some deals. Let's show progress there. And I think that hopefulness is partly what we saw happen yesterday when the president delayed the reciprocal tariff implementation by 90 days. So I would say there is some upside for this president, but he's enjoying the downside right now. Clearly, he isn't worried about it, but we are starting to see a profound impact on his popularity ratings, and tariffs are showing up in these polls for one of the first times.
Yeah. Mm-hmm. Yeah, evidenced by the YouGov poll, where his popularity is the lowest it's been since he retook office. It's interesting, though, Jeannie, because the tone from the president yesterday about the markets was different than what he had been trying to strike in the days before. When our colleague Anne-Marie Hordern, who was traveling with him on Air Force One, asked if there was going to be a Trump put at some point, and he completely rejected the premise of that question, said he wasn't worried about the markets, and still yesterday happened the way that it did. And I do wonder if you think we have learned something here about what the president is and is not willing to talk or tolerate, or is it less about President Trump himself and more about those around him, his economic team like Kevin Hassett and Scott Bessent and Howard Lutnick, what they are willing to tolerate?
Yeah, I'll tell you what I learned, Kaylee. Number one, I learned the definition of the word yip and yippee. So that was very helpful for me as I'm not a golfer. But the other thing I learned is he is not nearly as tough as Thelma and Louise. There he told us he was going to drive right off this cliff. There was no negotiation. There was no turning back. This is a commitment he's had since he was a kid. And he's been very vocal about his favorite word. And yet, when the pressure came, and it came particularly from the markets and the bond market, as you guys have been talking about, he did blink. And this is the, I think, largest U-turn we've ever seen a president make. And so while Rick is saying there may be an upside for the president, I find it hard to believe. This is a political disaster for a president who has made his mark saying he is tough as nails. You know what? In politics, sometimes it's better to be wrong and strong, that old adage. And what he showed us is he's not willing to be strong against this. Now, do I think he should have been? I don't agree with the policy, but it was a policy of his own making he's deeply committed to, and we've seen where it went. And of course, the markets woke up today and said, wow, this is an uncommitted disaster because we still don't have any certainty. So I don't see a lot of upside for the president at this point.
Rick Davis, let's talk about the pressures the president has been and is under. So yesterday, we know from Bloomberg's reporting, he was monitoring the markets very carefully. He saw that queasiness in the bond market overnight. That was something that gave him some agita, apparently, and then woke up and saw on Fox Business, Maria Bartiromo interviewing Jamie Dimon, the CEO of JP Morgan Chase. He took note at the kind of praise for tariffs, I guess, in broad strokes, but the worry about a potential recession. Then there's what we've heard from Congress. So we had the first opportunity to have comments from Jamieson Greer, the president's trade representative on Capitol Hill for 2 days, testifying before the House and the Senate. We saw lawmakers expressing perhaps some confusion, uncertainty about the president's policies when it comes to trade. And we know that he spoke with Senator Lindsey Graham, a close ally as well, yesterday. How much did we see that terrain shift over these last few days? Members of Congress who had been kind of in lockstep with him on trade and tariffs policy beginning to if not express outrage, raise some concern or questions about the way all of this has proceeded.
Yeah, and I think you keyed on an important aspect of congressional concern, and that is, what is the policy? I think that there would be more support in Congress with Republicans if there was a static and very clear plan that said, here's what we're embarked upon. Here's how the trade reorganization globally is going to work. Here's the benefits, and this is what the costs are going to be to the American people. And yet, right now, we hear the president, he got out early and said, hey, this is going to be painful. We got to go through, take our medicine to get to a good place. Yeah. But we're not going to negotiate. And then, as Jeannie said, now the biggest talking point that seems to be helping the markets is, hey, we're going to negotiate with 75 countries. And so Republicans get out there and they go home and they talk to their constituents. They say, hey, we're not going to negotiate. This is the way we get manufacturing brought back to America. These are going to be great jobs, and we're going to be less dependent upon people around the world.
Well, and Rick
then
Davis,
they turn around and cut a deal.
Well, and President Trump is talking about the prospects of the deal, saying he's going to try to get the world to treat us fairly. He's speaking right now in the cabinet room at the White House. Let's go there live here on Bloomberg Radio and on YouTube.
Very strong country, but we have Scott here and Howard and some of the people that are working on deals, and the biggest problem they have is they don't have enough time in the day. Everybody wants to come and make a deal, and we're working with a lot of different countries, and it's all going to work out very well. I think it's going to work out really very well, but we're in good shape. There's no inflation. There's very little inflation, and I went 4 years without inflation, and I took in hundreds of billions of dollars from China and others, taxes in China. But we took in hundreds of billions of dollars a year from China, and we had no inflation, essentially. So we think we're in very good shape. We think we're doing very well. Again, there'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing. We're doing, again, what we should have done many years ago. We let it get out of control, and we allowed some countries to get very big and very rich at our expense, and can't let that happen. It's not a sustainable formula. So I wanted to just thank everybody at the table, and maybe I'll go around and ask some of you a little short couple of answers. Pete just got back from Panama, and he's been all over the place, and you want to give us a little report on that and whatever else you might have to say. Everyone at this table is doing an incredible job, by the way, I have to say, incredible. And the relationships it's like they're friends. They're really, the relationships are very strong, really good, really strong. And these meetings are very good. And I think, I don't believe there's any other president that allowed the press to come into a meeting such as this. These are very sacred meetings. These are very private meetings, but we have nothing to hide. And I think it's good. I think it's a good, we want to be, a word you like to use, Jeff, is transparent. So we want to be transparent, and we'll do that by starting with Pete. Go ahead, Pete.
Yes, Mr. President, we just got back from Panama last night. We were at the Panama Canal with their Southcom commander ships, F-18s, troops, and signed a couple of historic deals. One which is with the Panama Canal Authority, a framework for U.S. vessels, first and free through the Panama Canal. Right. And then also a memorandum of understanding with their security minister for the presence of U.S. troops. Fort Sherman is an old U.S. base there, as well as their naval station and air station, jointly with Panama to secure the Panama Canal from Chinese influence. That's something you said, we're taking back the canal. China said too much influence. Obama and others let them creep in. We, along with Panama, are pushing them out, sir. And so we had a very successful trip there. President Molino sends his regards, very complimentary of the U.S. as he's a great ally, and I think they want the Communist Chinese out, and with our troops there partnering with their forces, we've got a chance to push them all the way out, sir.
We've moved a lot of troops to Panama and filled up some areas that we used to have, and we didn't have any longer, but we have them now, and I think it's in very good control, right?
Yes, sir.
Okay, thank you, Pete. Very good. Howard?
So, so we've have so many countries to talk to. It is, it's incredible. I think Scott and I'm not sure we could ever have enough time in the day to talk to all these countries because they want to talk and they want to talk now, and they have come with offers that they never, ever would have come with, but for the moves that the president has made. Demanding that people treat the United States with respect. We're getting the respect we deserve now, and I think you're going to see historic deals one after the other. And then I'm very excited that within a week and a half, we're going to start with the gold card. And the Trump card is coming out, and we're very excited about that, and that's coming soon. So very excited.
Good. Thank you very much. Good job. Linda?
Well, on a couple of fronts, we have been addressing the issue of anti-Semitism on campuses. There's been some grant funding and contract funding that we've reviewed, and some canceled and some we've put on hold, waiting for that while we do an investigation. On the other side of what my responsibilities are in having education go back to the states, we're meeting and talking with governors. I was with, this week, all 50 commissioners of education around the country, and because we also want to provide them with tools and best practices as education does move back to the states. Making great progress, great response from the states, and very positive.
And what about colleges? You're holding back $400 million from Columbia, $8 billion from Harvard. Can you imagine the money we pay Harvard? They have a $60 billion fund, and we're giving them $8 billion, and we're trying to figure that out. And then they hire de Blasio, the worst mayor in the history of New York, and they hired the woman from Chicago who was a disaster, total disaster, and they pay them massive salaries, and they're supposed to be teaching you government. That's not Harvard. That's not Harvard the way it used to be. So, do you have anything to say about that? The dollars you're holding back from quite a few universities that were not behaving.
Yeah, and the other, there's some Princeton, Cornell, others that are coming in, and actually getting calls now from the presidents of the universities who really do want to come in and sit down and have discussions. And so we're investigating them, but in the meantime, we're holding back the grant and the fund money.
Okay. Great job. Thank you.
Very thankful for the House voting for the president's budget resolution along with the Senate bill. Made a ton of progress this week in working with members to ensure that a desire for flexibility in the Senate was not misconstrued as a desire not to slow and do spending reforms. And so we're very thankful for that. And now we can get after writing that bill, getting the president as big a package of his agenda to his desk. So very good week.
Good. That's right. We just got the House vote, and now we're well on our way to getting, as we call it, the great big beautiful bill. It's a beauty. there's never been a bill like this one. We're trying to get it all into one beautiful bill. It's tax cuts, regulation cuts, and many other things. The border, a lot of money for the border. Well, you're doing a fantastic job. So, but we just got a report that we, as you know, you knew before us. Were you surprised we got the vote? Got the vote. And we're happy to get the vote. So I think we're going to be in very good shape. Okay, please.
Mr. President, last year the Chinese received 1,700 orders for new ships. American shipyards received 5. Under your leadership, like so many other industries, we are going to revitalize and make shipbuilding and maritime great again with these blue-collar jobs. These are the cranes, the ports, opportunity zones, and drive that investment back in. We have, under that executive order, and also one to streamline foreign military sales for people that want to buy our equipment, and of course acquisition reform, all just this week under your leadership, Mr. President.
So we're going to be rebuilding our shipbuilding business. We may order, would have to go to Congress for this, but we may buy some ships from other countries that we're close to and that do great jobs with ships, but we're going to start the process of rebuilding. We don't really essentially build ships anymore, which is ridiculous. It's going to be a very big business for us in the not too distant future, but in the meantime, we have countries that do very well at building ships, and we'll be dealing with those countries, and we may be ordering top-of-the-line ships from those countries. And within a fairly short period of time, we'll be building our own ships. So we'll probably have to go to Congress for that, but we're not going to have a problem. Susie, thank you very much for the job you've done. Go ahead, please.
I just want to make sure you know that this cabinet, I think, pretty uniquely collaborates and cooperates and works together to accomplish all that you've asked them to do, and I think they deserve a lot of credit for that.
True. You're doing a great job. The chief of staff, doing a great job. Lee, go ahead.
Mr. President, the Biden EPA was strangulating the economy. The Trump EPA understands it's not a binary choice. We can protect the environment and grow the economy. Working with Doge and Elon Musk, we've now canceled $22 billion worth of grants, and we have launched what is the largest deregulatory action in the history of the country, just in one agency. That's how much of a mess the Biden EPA left us. It is going to end up reducing the cost of living. It's going to create jobs. It's going to make it easier to purchase a car. It will be easier to heat your home. We're proud of this effort. The effort that we have is fulfilling the mandate that you earned from the American public. Clean air, land, and water for all Americans, unleashing energy dominance, permitting reform, advancing cooperative federalism, making America the AI capital of the world, and bringing back American auto jobs. When you called me that day asking for me to take this position, I was honored. And you were very specific and clear in what you wanted us to accomplish. We understand our mission, and at the Trump EPA, we're going to make it proud.
Great job. You're doing a great job. And you have a lot of applications for approvals for power plants, which are going to really power the regular plants, and they're going to be right next to each other because we can't rely on our grid. It's old and it's tired, and it's very subject to being attacked, whether by rain or by bombs or by anything else. And we're letting people build their own power plants, and these are a lot of them being built with the AI and beyond the AI chips, and we're letting them build their own power, and never been done before, and we're going to get it done quickly and approved quickly. As part of a plant, they'll have a sort of be their own power company, and it's very exciting. They couldn't believe it when I told them that. I said, we're going to get you the approvals very fast as part of your regular plant. You're going to build electric producing plants, and it's very exciting. And they're able to do it very quickly and very well, and you made it possible. Thank you. You have a lot of applications for some of the biggest plants that have ever been built in the world. These are serious plants, aren't they? Huh?
Approved. We are open for business. Working with Secretary Burgum, Secretary Wright, we are going to make it proud.
Good.
Sean?
First off, Mr. President, it's Brooke's birthday today, so she keeps getting younger, so happy birthday to Brooke.
Thank you.
I want to thank you as well for the shipbuilding at EO. Again, to build ships, you also need mariners to sail those ships. I was just up at Kings Point for the Merchant Marine Academy a couple days ago, and we have some of the greatest young men and women who are learning how to be mechanical engineers, to rebuild and fix the engines on those ships, but also how to sail ships. I would tell you that over the past decades, this academy has become, it needs some love. It's been a little bit dilapidated. We have to invest in sailors, and I appreciate you taking the initiative. To be a global power, we have to build ships and have sailors to sail those ships. These are the very people that help Pete should we come into points of crisis to support the military. So thank you for that. Number two, the last administration announced 3,200 projects, big, beautiful roads and bridges. Most of them are good. But they announced them, they didn't sign a grant agreement. 3,200, so the money doesn't go out the door to build the infrastructure in the country. And it's fun to do an announcement. It's actually the harder work to put together these grant agreements. So we're doing the work right now at DOT to get these grant agreements done and build the projects. Most of them are good. And they also put in all of this green and social justice requirements on roads and bridges. We're pulling all that out and putting the money toward the infrastructure, not the social movement from the last administration.
Good steel, right, as opposed to green paper mache. Okay, thanks. Great job.
Sir, first, we are, I would say, more than friends. We've all become family, and I think that what you have assembled in your vision is a turning point and an inflection point in American history. And so just being a part of that is the greatest honor. So thank you for that. And again, just the relationships here and the honor and respect we have for each other is a reflection of you and your leadership. So I just wanted to say that first. The second thing I want to say is that on behalf of the farmers and ranchers, food security is national security. We have to be able to feed ourselves. And your idea of using tariffs along with deregulation and tax cuts, but your idea of using tariffs to ensure that we are putting forward and putting America first, no one understands that better than our farmers and our ranchers. But having said that, emerging from 4 years of Biden with a 30% increase in inputs for our farmers and ranchers, with an almost $50 billion trade deficit. When we left the first time, it was zero, meaning that they are hurting. So the period of uncertainty we're in, they know that your vision will move us into an age of prosperity for all Americans, but for my people, for the farmers and ranchers, unlike any they have seen before. And I think they are really, really excited and so grateful for your leadership. But also, you have never failed to say that you have the backs of our farmers and our ranchers. It was the first phone call that I had after I was voted with the Senate. And that message just resonates with almost an 85% support of you in the last election. They're with you. Interestingly, the biggest budget driver at the United States Department of Agriculture is not farming and ranching or agriculture, it's food stamps. And so as we emerge and embark, Secretary Kennedy and I, on your vision of making America healthy again, a massive part of that is realigning and reworking our food stamp program so that it better serves those who need it. And yeah, to the point of getting the transgender, DEI, Green New Deal out of the USDA and realigning is really important. So
It's out of the military, right?
Yes, sir.
Is it 100% out, would you say?
99.9, sir. I'm going to get that last point.
Get the rest of it out.
But thank you, sir.
We've got a much different military, I will tell you. Thanks very much. Good job. And eggs are down.
Eggs are
big,
down.
right?
Yes.
Big.
Yes, sir. Wholesale prices. Retail will come. Easter is the Super Bowl for eggs. So, you know, there may be a little fluctuation, but no, we feel really good about it. Thank you.
That's what I hear. Thank you.
Thank you.
Good. I'd echo what Howard said on the trade queue, that we've got over 75 countries that want to come in. So it'll be Treasury, Commerce, Jameson at USTR, and we're putting a process in place. And as you said, you're going to be part of the negotiations too, because you know I've had these countries call me up and Secretary Bessem, we're happy you're going to be negotiating. Well, President Trump's going to be involved too. So bring your best deal on the budget. It's moving quickly in the House and the Senate, thanks to your leadership. We're also going to have debt ceiling in there, so we're going to get an increase in the debt ceiling. So, and that will be the done and dusted for
Part of the bill that we just got to vote on today. So.
part of the bill. It'll be done and dusted for 2 years. We won't have to worry about that. And then I gave a speech yesterday to 1,400 small and community bankers, and they were so happy to hear from your administration. And I told them Wall Street's done great for the past 4 years, 10 years, 20 years. It can continue doing great, but it's Main Street's turn now. And it's those small bankers through deregulation, through emphasis on Main Street, your Main Street agenda, bringing back jobs, that is going to power the smaller communities. And then finally, the bond auction went very well yesterday. We had a lot of foreigners show up as the support, showing that the U.S. is still the best place to invest. The inflation report, as you said, was quite good. And energy prices are down more than 20% since January 20th.
Amazing.
That's great. Very good numbers.
Great number.
Thank you. Pam?
President, we've had some great wins in the last few days. That you were
we just heard from
overwhelmingly
Secretary
elected
Scott Bessent
by
alongside
the
other
biggest
cabinet
majority.
officials at a
The
cabinet
US,
meeting live
Americans
in the
want
White
you
House.
to be
Thanks for
president,
joining us on
president
Bloomberg TV and radio. This is Balance of Power. I'm Kaylee Lyons alongside David Gura in Washington. As we were just hearing multiple cabinet officials talk specifically about tariffs, the Treasury Secretary Scott Bessent saying that there is a process being put into place for negotiations in which he will be involved, but President Trump himself will be involved. And President Trump began this cabinet meeting with the press assembled in the room by saying that they are working with a lot of countries, though he did note there will be transition cost and transition problems as we go through this. We also heard from another important voice when it comes to this administration on trade, the Commerce Secretary Howard Lutnick, saying that countries want to talk and they want to talk now, suggesting they're coming with offers they never would have come with without President Trump's policies. So perhaps no surprise, David, that they're obviously very focused on trade given the developments of the last 24 hours, the pause in the 90-day pause in reciprocal tariffs for most countries, hence leaving room for these negotiations, that the tariffs on China remain in place and actually elevated to at least 145%.
And the Commerce Secretary allowing there's hardly enough time in the day to talk to all of these countries who are calling the White House now, trying to talk through what a deal might look like for each of them. Again, a fairly short time horizon here for all of these deals to be worked out, and we see the president sort of making his way around that cabinet table in the cabinet room. If, in fact, he fields questions from reporters at the conclusion of that, rest assured we'll go back to capture some of that for you here on Bloomberg Television and Bloomberg Radio. I want to turn on to Michael McKee, our international economics and policy correspondent, who has been, listening in as the president and his team have been speaking, but also paying very close attention to the 30-year bond auction that we saw just a moment ago, and also the undulations that we have seen and continue to see in the markets, both in the bond market and the stock market, and to the economic data that we got as well, the CPI data this morning. Mike, I just want to get your reaction to what you heard there and maybe give us your sense of sort of what these next 90 days look like. Here we have an administration eager to broker deals, as we heard there in that meeting. That's meeting with the realism of how difficult it is to broker trade deals historically, all the nuances and details that go into them.
Well, I took a year, more than a year, to renegotiate NAFTA, and almost nothing was changed in that treaty that came out as the USMCA. So I think you have to approach what this administration is saying about these deals with a great deal of skepticism. For example, we heard there, and we've heard from others in the administration, that 70 countries have approached the administration. But Kevin Hassett said this morning on one of the other networks that there are 20 countries. So, I mean, what is the actual truth? And what are we actually going to get out of it? And how much of this is going to be tariff reduction? And how much of this would have anything to do with non-tariff barriers? I mean, remember, they went after the Europeans and the British for having a VAT tax. Does that get addressed?
Yep.
So a lot of reasons to be skeptical about what they're talking about. But what we can say will happen is if these other tariffs that are already in place stay in place, we will see prices go up and we will see the economy slow down. It's going to be very interesting. These are very heavily weighted, obviously, towards China, and we import a lot of stuff from China. So how is that going to affect the American consumer's psyche if they can't get things from China?
Well, and investor psyche as well. After the remarkable gains of yesterday, the best day since 2008, obviously we have a massive reversal on our hands with 5% losses on both the S&P 500 and even greater for the NASDAQ 100. And we know markets did play a role in the decision-making of President Trump yesterday, though he was specifically concerned about the bond market, talking about queasiness, Mike. And I wonder if a little bit of that queasiness has been abated, not just by the tariff moves, by once again, for a long-duration Treasury auction, the 30-year yield, it looks like demand was a bit better than expected.
Yeah, 30-year comes in reasonably strong. It stops through 2.7 basis points, about what we saw with the 10-year yesterday. It does suggest that people are out there looking for duration. Dealers took less. Directs, though, took a lot more than they did yesterday. Direct bidders and indirects were down a little bit from their average, but still relatively strong. So not a major change in the auction statistics, but a well-received auction in this case, as was the 10. So that may supply a little more confidence to people in the fixed income markets about foreign demand and overall demand for U.S. Treasuries. There's been some talk that people were backing away from investing in the U.S. I think the equity markets are reflecting what normally happens in these kinds of situations where you have a big turndown. This is what we've seen before, where you get these rallies and then stocks go back down again. Very much the pattern after 2008. After Lehman Brothers. So you just have to wait and see how long that takes to play out and where people start to find value again. And it may be hard to do in the sense that people can't trust exactly when all this tariff news is going to stop and we'll have what there is.
Mike McKee, at the start of that meeting, the president remarked on the inflation data that we got today, the CPI data, and he said, quote, "There is no inflation." He then corrected himself. There's very little inflation, he said. We know that those data are looking backward, not forward, and there's a lot on your agenda today. You couldn't escape for the speech that Austin Goolsbee of the Chicago Fed gave at the Economic Club of New York, but he brought this up and talked about the inflationary aspect of these tariffs and indeed the difficulty that it's going to pose for Fed policymakers going forward here, having to navigate, yes, these kind of inherently inflationary policies, but also what we saw over the last 24, 36 hours, that being a chief policymaker who's making a quick reversal on his policy priorities, seemingly. Talk a bit about that, the way that central bank policymakers, yes, the ones that you cover most closely here in Washington, have to focus on, but those around the world who are trying to figure out the direction of policy going forward here and how they sort of complement that.
Yeah, it is an issue for central bankers around the world, but a little different in different places. It is possible that because the Europeans, for example, will be putting on, if they actually follow through, lower tariffs than we're putting on, and it depends on what they tariff. They may not have an inflation problem. They may have more of a disinflation problem. And so the way they're going to approach this is different. Because the U.S. is driving all of this, we can have a growth slowdown and we can have inflation rise. And pretty much all of the Fed officials who have spoken this week have addressed that conundrum for them. What do they do in that situation? If you raise rates to bring down inflation, you might hurt growth and vice versa. So they're all saying we've got to be careful. We can't make decisions right now. We have to watch what happens. They've sort of all leaned into the idea that inflation is the thing that would matter more. But the formulation that they've always used is we'll look at which number is deviating the most from where it should be and attack that. So the bottom line message from them all is it's going to be tough on us. Don't get mad. We'll get around to it when we have some idea of exactly what we're doing.
All right, Michael McKee, Bloomberg International Economics and Policy Correspondent. Thank you so much for joining us as we're keeping an eye on financial markets. We may be off of session lows, but the NASDAQ 100 right now down 6.2%, still on pace for its worst day since March 2020. So let's get a check on the latest with Charlie Pellet in New York. Charlie, I'm having COVID flashbacks for sure.
Certainly a day of fast-moving developments. We got you covered on Bloomberg Television and Radio. Let's recap and reset here in terms of U.S. markets as our market coverage continues. Investor psyche does remain fragile. We are on track for the fifth decline in the last 6 sessions. Right now, the S&P is down 5.4%. Keeping that in context, you run the HCPI function on the Bloomberg. We were down 6.3% at the worst level of the session, but right now a drop of 5.4% on the S&P. We're down 291 points. The S&P at 5164. The Dow down 1,866 points. That is a drop of 4.6%, with the NASDAQ Composite Index down 1,050 now, a decline of 6.1%. The Russell 2000 Index of small cap shares down 6%. NASDAQ 100 Index also down by 6%. Bottom line here, another day of steep losses for the U.S. equity market. 10-year, 4.35%. The 2-year, 3.81%. Gold is up $76 the ounce, up 2.5%. $31.59 the ounce on spot gold, and West Texas Intermediate crude is now plunging by 5%. WTI $59.24 a barrel. So bottom line here, steep losses again, fear engulfing Wall Street, with the S&P now down by 5.4%. Our market coverage continues on Balance of Power. Back we go to Washington once again. Your hosts, David Gura and Kaylee Lyons.
Charlie, thank you very much. Charlie Pellet there in New York, following the markets for us as we look at the sell-off this afternoon. Gold, that glimmer of green in a sea of red. As we look at this kind of violent reversal, and I'm kind of curious here, Kaylee, as we watch all this unfold, sort of what fundamentally has changed? Yes, I think we can all agree it's a good thing that a trade war isn't being fought on 70-plus fronts, but it seems like the biggest battle, the most fundamental one here, is between the U.S. and China.
Yep.
And we were talking a little while ago just about the notion of decoupling and sort of where we are in that conversation, but a very deep divide now between these two economies, and I think investors are reckoning with the fact that that's the case.
Well, and it's not just any two economies. It is the two largest economies in the world. So while it does have major ramifications for both the domestic economy and the Chinese economy, there could be ripple effects across the globe as well, as we consider that when you add on the 20% fentanyl tariffs to the now 125% reciprocal tariff President Trump has placed on Chinese goods, that gets us to at least 145. And of course, China has slapped 84% tariffs back in the other direction on U.S. imports. And that leaves specifically tech companies incredibly vulnerable. If you're an Apple or an Nvidia with that China exposure, perhaps the euphoria of yesterday is giving way to a bit of a reality check on that front today. And it's on that note we go to Mike Regan, Bloomberg senior editor, joining us from New York. And it is remarkable, Mike, after the best day since 1998 for Apple yesterday, that stock down 6.5%, Nvidia taking it on a chin as well. It does seem that technology stocks are looking particularly vulnerable in this Thursday selling.
Yeah, Kelly, and I would sort of reiterate what Mike McKee just said about whenever the market has one of those just insane rallies like we saw yesterday, that doesn't necessarily inspire the type of confidence you would think it would. Wall Street traders are all too familiar that those type of eye-popping rallies really only happen in the middle of bear markets. We saw it in COVID, during the financial crisis, and many other bear markets. So I think when you think about the difference in mood from yesterday and today, yesterday, the rollback or the delay of the tariffs for 90 days was certainly good news. It wasn't likely worth almost 10% in the S&P 500. What seems to have happened, according to a lot of investors and strategists, and just looking at the data itself, is that there was a massive short covering. When you think about some of the most sophisticated, biggest hedge funds and other investors in the world, many of their strategies actually can be boiled down into something very simple and trend following. We've had this downtrend in the market since the middle of February, and that just inspires a lot of traders to short this market, to borrow securities in hopes that their prices will go down further and they can buy them lower and sort of pocket that difference when they repay that loan. So a big part of that rally yesterday, I think, was short covering. That happened in a flash, and now it's over. And we're back to really thinking about these fundamentals and the uncertainty around the fundamentals and the market resuming that downtrend.
I was reminded of something I read from RenMax Neil Dutta yesterday in light of what you said there, Mike. He wrote in his latest note, when markets rise 10% in a day, it's not a sign that things are healthy. I think getting at the point that you were making there. What is your sense from going through notes this morning and sort of getting a sense of where the market is today, of what investors are looking for here, what that kind of clarity is that they need to see here? There was that allowance from the president yesterday that he intends to be more flexible than we thought he was going to be going into this, perhaps an indication that he's willing to carve out some exceptions, something that he and his economic advisors had sort of ruled out flatly at the beginning of this process. What more do investors need to see here to kind of cheer them, or is this something that you think we're likely to see going forward over these next 90 days, this kind of anxiety about the uncertainty, sort of how these deals come together?
When it comes to that sort of looking for clarity, David, one of the really, I think, most illustrative things I read this morning was from our colleagues writing about Walmart. Walmart basically told one of its suppliers in China that produces Christmas ornaments, don't put the price tags on the ornaments. That was typically the last thing they did before shipping them out. You know, Walmart would tell them, put this price on each item, and they'd ship them out with the price tags on them. Now they're saying, don't put those price tags on these Christmas ornaments. And that really, I think, speaks, it's a great anecdote that speaks to the unknowns throughout not only the C-suites of companies like Walmart, but in the spreadsheets of investors trying to figure out exactly what to expect for the rest of the year. You know, we've seen Delta pull its earnings guidance. We've seen CarMax pull its earnings guidance. A pulled earnings guidance is almost as alarming to investors as a reduced earnings guidance. In some ways, I think they would prefer to see that. At least there's some numbers to work with. When a company completely pulls its guidance and says, we just don't know what we're going to make this year, it's very alarming for investors. And that's really the clarity, I think, from the Wall Street, from the trading side of things, is clarity on what that earnings outlook is going to look like. And there's just none to be had right now because of all the issues, all the uncertainties, and lack of clarity from Washington. You know, Trump is famously can change his mind from day to day and increase tariffs, pause them, eliminate them, and you know, it's just impossible to predict. So that just sort of feeds into all the decision makers in the C-suites around the country and the world, really, and all the investors trying to put a value on what these stocks are worth. And it's just a very hazardous situation when you don't have answers to all these questions.
Well, and Mike, that's an excellent reminder that big bank earnings kick off tomorrow. JP Morgan will be reporting at 7 a.m. Eastern time on Friday. For banks that came into this year thinking there was going to be a revival in animal spirits, investment banking fees potentially were going to fly. Obviously, we're living in a bit of a different reality. You were just speaking to the idea that earnings guidance is getting pulled, but we've seen IPOs pulled as well due to the volatility in markets right now. And I wonder what you're expecting the banks might be signaling tomorrow and how much of a catalyst that could be for wider equity markets.
Right. Well, they're in the books earnings through the end of March won't tell us a whole lot just because a lot of this turbulence has happened since then. For this current quarter, I mean, some of the big banks, you know, that have trading desks might be able to put up some great numbers for those trading desks. But those don't tend to really impress Wall Street investors because they do come at the expense of everything else you're talking about, IPOs being pulled, likely some M&A that is being reconsidered. And it just, you know, it's going to be a volatile outlook for the banks. I think the remarks, especially from the likes of Jamie Dimon, will be the most important thing. Again, the banks aren't going to be able to give us any more clarity than anyone else can. But as we've seen, you know, even yesterday, the words of someone like Jamie Dimon mean an incredible amount to investors. So I really think his conference call remarks will be must-see TV, or at least must-listen to earnings call for all of Wall Street coming up.
Mike Regan, thank you very much. Mike Regan, senior editor on markets in New York. And I think back on what he just said there, we've heard an awful lot from President Trump this week. Maybe second to him, we've heard a lot from Jamie Dimon. There was the lengthy letter that he wrote to investors earlier this week, followed by that interview, which was in a way kind of unprecedented here during a quiet period before earnings, going on Fox Business and having a long conversation about the economy with Maria Bartiromo. And then, as Mike was alluding to there just a moment ago, the comments we expect him to make on the earnings call that JP Morgan has in the coming days. I want to go to Terry Haynes now, the founder of Pangea Policy, and I suspect that he was shaking his head as I was asking Mike Regan for sort of a sense of the rational response that we might see in markets to what the president is doing here. Terry, we talk a lot about sequencing in the context of the president's legislative and economic agenda. Let me ask you about sequencing in another context. That is, how this White House, how this administration goes through what they say is a long call log, a long list of countries and trading partners eager to meet with this administration to hammer out deals. They want to send a sign to the markets, to Americans, that in fact they're making progress. Who needs to be at the top of that list? Who should they be prioritizing as they go through the sequencing of these trade deals?
Thanks for having me. I think they should sequence in a couple of different ways. One, they should probably look at the United Kingdom, in Europe, but not of it, so to speak. I'd also look at major unaligneds, particularly India. India is hugely important, and working out some deal with Modi would be a great signal. Let's remember just 2 months ago in Washington, Modi came here and talked about MAGA plus MEGA, make India great again, equals mega. So maybe Trump should figure that out. And finally, somebody in the Asia Pacific, either Japan or Australia, would be very good. I think those three would send large signals about the seriousness and kind of the direction of travel of the administration.
Well, as we talk about the seriousness of the administration, Terry, and it's great to have you back here on Bloomberg TV and radio, I wonder if you see any kind of credibility dent that the administration is now going to have to contend with as it conducts itself in these negotiations, considering, once again, we have seen an extreme change in tariff policy and a flipping and flopping of the narrative. Does that actually give these other countries who are coming to the table a little bit more leverage? Is there a bluff to be called at some point?
Oh, sure. There's credibility gaps all over the place. There's a credibility gap on the part of the administration to some extent. There's an awful lot of allies and friends of the United States that feel whipsawed and feel bruised in a lot of different ways. And this pause does a lot of things, but one of the things it does is gives Trump an opportunity to right-size those relationships and frankly reassure people. One other thing that we should all be aware of too was that Lutnick's people at Commerce were out to a number of major countries, and I assume others as well. I know of a few that giving people a laundry list of what they wanted to talk about, both in terms of tariffs and other sorts of trade barriers, before the tariffs even went into effect. So, I will give the Trump people good marks for being able to talk to allies and friends and others before all this started. So hopefully that can help push things. Thirdly, I would point out as well, I thought Mike McKee gave a very good summary of all of this a few minutes ago on your air. One thing I would add to that, though, is that countries may well be able to come to deals by making future promises. The United States itself does this by saying, we're going to reach a deal to do X, Y, Z on trade, and as part of that, we promise within a certain period of time, we're going to pass legislation, we're going to change rules, whatever. Those countries will do similar things, I think, in order to make deals.
It must be grading season. We have here Terry Haynes giving his marks to the White House. Ira Jersey, our chief rate strategist for the U.S., giving his marks to the auctions that we've seen over the last couple of days, giving the 10-year auction an A+ and a 30-year auction an A, saying that they were really solid. Makes me ask you, Terry, sort of how you look at this administration's visibility into the markets and their response. You wrote earlier in a note that perhaps the White House, we've misjudged how much this president cares about market moves. And I think yesterday we saw perhaps an indication that it's still something that the president cares quite passionately about, that he could see those startling moves in the bond market, for instance, and feel like he has to do something, that things aren't going to course. Do you care to revise the statement that you made earlier? Have things changed this week vis-a-vis our sense of the way that the president looks at the markets?
No, I won't revise. I will extend my remarks, though.
Fair enough. You may.
On Capitol Hill. I will extend my remarks in this way. When markets say, geez, Trump cares about the markets, I mean, to me, that's a illusion and a rationalization extraordinaire, because they don't really mean Trump pays attention to the markets. What they mean is we, the markets, are actually the masters of the universe, and Trump will do as we wish. Well, I've been telling markets for a couple of months on tariffs, that's not going to be the case. The reason why it's not going to be the case is because the goals here are geopolitical. This is not 2017. The reason why it's not is because economic policy is roped and yoked to geopolitical goals across the board. And, you can even see that with tariffs, where some of the tariffs exist for geopolitical reasons. Presidents don't think about the markets all the time. The markets are not the only thing that needs to be dealt with. And so what I would say to folks is that you've shown, or as Trump has shown, that he's certainly interested in where the markets are on these things, but he's not paying sole attention, and he's not gonna dance to markets tunes. Number one. Number two, I think the other thing we need to remember here too is anybody on Wall Street that's self-congratulating today shouldn't. Because one of the reasons why these tariffs happened is essentially that Wall Street let them happen. In Washington, silence equals assent. If you're silent, that means go ahead. And they didn't really raise any objections to what was about to happen until well after it happened.
Well, it's a very fair point. Certainly, we're seeing, it seems, some protest happening now, looking at the red on my screen, Terry. Also on my screen, I would point out we are still paying attention to the cabinet meeting at the White House, which is ongoing. The president has gotten reports from almost every cabinet secretary at this point. The Secretary of the Interior, Doug Burgum, is speaking now. As you can see, if you're with us on Bloomberg TV or on YouTube, we still have Secretary of State Marco Rubio to hear from, and then the president may well start taking questions from reporters. We'll dip back in for those if indeed that happens. In the meantime, though, Terry, as you speak to this idea that the president isn't exclusively focused on the markets, what have you learned this week about the influence others in his administration may have in interpreting the market action and then shaping presidential policy by extension? As we understand that Scott Bessent and Howard Lutnick presented a kind of united front to the president yesterday, which helped lead to this change in tariff policy. Is this actually a sign that Wall Street's initial expectations of Scott Bessent being kind of a steadying hand, if you will, when he was tapped for this position may indeed be serving in that role?
Markets still have a policy concern, of course, in large part because this is a pause. It's not a volte-face or a throwing away of the policy. And Trump still has a lot of urgency around this. So markets are right to continue to be concerned. Where I think the White House has improved here is, though, in communication message, something that's important. And we've been talking for 6 months now about a so-called team of rivals that are headed up by Bessent and Lutnick. And I think what you saw yesterday here is Bessent put pretty much in charge of the messaging to Wall Street, while Lutnick is supposed to be responsible for the shepherding forward of negotiations and potential deals. Bessent has a foot in two camps right now. Bessent is trying very hard to push the tax cuts bill, and they'll try to push a bill and get it done, frankly, I think within this 90-day period. They have a pretty good chance of being successful at that. But at the same time, Bessent's going to continue to be the soothsayer for Wall Street, and that seems like the right conclusion for the Trump people to reach, since Bessent tends to stoke some confidence where I think Secretary Lutnick, for rightly or wrongly, doesn't.
Terry, you've mentioned a number of names there, and one that didn't come up is Jamieson Greer, Ambassador Jamieson Greer, the U.S. Trade Representative. And there was that photograph that we saw from the House hearing yesterday where the Truth Social post went out, and an aide had to lean over toward the U.S. Trade Representative and show him what the president had done. Where does he fit into this pantheon of economic advisors, and what does that tell you? Is it at all worrying that the man who has been charged here with trade policy wasn't in the Oval Office yesterday as Howard Lutnick and Scott Bessent and President Trump sat down and pounded out that poetic, important post on Truth Social?
Well, the USTR is typically given cabinet rank, not always by every president, but typically given cabinet rank. But at the end, not only does he get his power from the president, but he's essentially a staffer of the president. I mean, they all are, but they're not cabinet secretaries or anything else. And the USTR in this case, I think, is treated a little bit more as a staffer than as a peer of Secretaries Bessent or Lutnick. I also think, in Greer's defense, he's pretty new to this. Just got confirmed very recently, and probably not quite as up to speed on it as everybody else. But I think the net of what you point out clearly is that the three people who are in charge of all this are the president as the decision maker, Bessent as the person who has his eyes most clearly on the markets broadly, and Lutnick is the person who's supposed to go out and execute these deals.
Terry, finally, all of this conversation on tariffs and the activity we're seeing in financial markets today, which I would point out the NASDAQ 100 right now off of session lows, still down, though, 5 full percentage points. The S&P down by about 4.5%. Seems to have overshadowed what happened on Capitol Hill earlier this morning, which was a successful vote in the House to pass the budget blueprint that was passed by the Senate, advancing forward the budget reconciliation process in the aim of achieving President Trump's legislative agenda, which is expected to include sweeping tax cuts. We keep hearing from this administration, tariffs are just part one. You have to wait for the second half of the economic policy, and I wonder how that factors in, although I understand now that President Trump is taking questions from reporters from the cabinet room at the White House. So let's listen and watch live on Bloomberg TV and radio.
I think Scott went out. Scott, you want to have a statement on that?
Sure. Look, the up 2, down 1 is not a bad ratio, or up 10, down 5. And I think as we have talked about, as we go through the queue and settle with these countries who are going to bring us their best offers, we will end up in a place of great certainty over the next 90 days on tariffs. But we had very good inflation numbers today. Oil's down. We had a successful bond market, so I don't see anything unusual today.
And next steps for China, sir?
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. They've ripped us off beyond anybody, nobody. How people stood for it, sitting in my position, is not even believable. And we're talking about many presidents, not just a couple. But they did, and all we're doing is putting it back in shape. We're resetting the table. And I'm sure that we'll be able to get along very well. I have great respect for President Xi. He's been, in a true sense, he's been a friend of mine for a long period of time. And I think that we'll end up working out something that's very good for both countries. I look forward to it.
Mr. President, China retaliated today by reducing the number of American films that can be shown there. What's your reaction to them now targeting cultural exports from the United States?
I think I've heard of worse things. Yes, please.
Also on China, the Ukrainians say they have evidence that Chinese soldiers have been found fighting for the Russians in Ukraine. Can the U.S. verify this? And if so, what does the U.S. plan on doing to China to counter that?
We'll look into it, but I think beyond that, we're really looking to get that war stopped. They're losing 2,500 and even more than that young people a week. They're Russian and they're Ukrainian. They're not American, but they're people. And we're seeing if we can get it stopped. And I think we're making progress. I appreciate the ballerina who was released. It was at the request of a very good friend of all of ours, actually. Dana White called me and he said it's the friend or the relationship of one of the fighters for UFC or one of the fighters. And Dana's an incredible guy, and we spoke to President Putin about it, and they made a deal. They released the young ballerina, and she is now out, and that was good, so we appreciate that. We hope that we're going to be able to make a deal relatively soon with Russia and Ukraine to stop the fighting. It's so senseless. It's such a horrible thing. It would have never happened if I were president, but it did happen, and we were given that card, and I think we're going to get it. I think we're going to get it stopped. Got to get going. We got to get it. We have to move it faster. Likewise with the hostages, we're making progress. We, there's 59 hostages, but only 24 of them are living, and that's the way it's been presented to me by the mothers of some of the dead, mothers and fathers of some of the dead hostages, and they want the bodies of their baby, as they say, their baby, their young boys. They want them back as much as if they were alive. It's amazing, because when I met the hostages 2 weeks ago here, I couldn't believe what they had to go through, by the way. But when I met them, they said, yeah, there's 59, but 24 are living. And they actually consider, I guess if you're a parent, you do consider it this way, that the remainder who are dead, the 24 that are alive, the remainder that are dead, they want them back just as much as they would want them back if they were alive. It's really pretty amazing and pretty sad. So we're getting close to getting them back. We have a lot came back. A lot of people are very grateful. Some came back in pretty bad shape. Some came back, they're okay. I think they're going to be scarred mentally for a long time, because if you sit down and talk to them, as I have, what they went through is incredible. But we're making progress. We're dealing with Israel. We're dealing with Hamas, and it's a nasty group.
Mr. President, how close are you to the first country coming to actually make a deal with the United States over tariffs? Is it days, months?
Well, I think it's very close, but we have to have a deal that we like. We don't want a deal that's going to be a bad deal, or I could make every deal in one day if I wanted to. I could do this all in one day. I could just say, here's what we'll do. And I was saying to the people before, to Scott, mostly to Scott and Howard, and some of the other people that work with us on the negotiations. We have a lot of law firms that have paid me a lot of money in the form of legal fees. We're going to probably use those firms to, if we can, I think we can. I'll make a contribution to the country, but they're great firms. They're the best firms, the biggest, and really the most prestigious. And we may be using them to help you guys out, because you're going to need a lot of lawyers. And I'm not sure Pam's going to be happy if I say, can you send over about 200 lawyers that work on trade? She's working on criminal stuff, and I think that's going to be her focus more than anything else. So we'll find out if we can do that. But we have a lot of lawyers that you've been reading about, where they paid $100 million a firm on average. Now we have the final 4 or 5 are at $125 million. So I have a lot of legal fees I could give to you people, and we might as well use them. Hopefully I won't need that many legal fees or that much. I may. Who knows? After it ends, after we leave, maybe I'll need it. But if I do, it's not going to be very pleasant. So I think we're going to try to use these very prestigious firms to help us out with the trade, because we have a lot of countries. But we want to make deals that are proper for the United States, not just we can make deals easily. We want to make them proper.
Mr. President, if you aren't able to reach the deals that you want to see at the end of the 90 days, will you put those higher tariffs in place, or will you extend?
Well, that's what would happen. I mean, if we can't make the deal that we want to make, or we have to make, or that's good for both parties, it's got to be good for both parties.
You wouldn't.
And then we'd go back to where we were.
Go back to the numbers that you announced last week.
I think so.
You wouldn't extend the pause.
Yeah. We'll have to see what happens at that time.
Thank you, Mr. President. You said yesterday you were considering some exceptions for companies. Can you talk about what you're considering? And then also on the reciprocal tariffs, you said they'd be substantially lower. Is the same math formula going to be used, or is that tossed out?
I'm not considering now for any country or company, but it's possible that I would. But I'm not. We don't have that situation right now. People understand where we are, what we're going to do. But it could happen. It's called flexibility. You have to have certain flexibility.
What are you planning on using the money that you're gaining from revenue through the tariffs on?
Paying down national debt, reducing taxes, creating good budgets, helping Christie with the border and all of the other things. I built hundreds of miles of wall, as people now understand, 571 miles of border wall in the first administration. But we're going to beef it up, and we're going to add more. And the numbers are incredible. Really, the numbers are what's taken place. We had great numbers, but these numbers are topping my last administration. And Christie and Tom Homan have done an amazing job. But it's an expensive process. This weekend, where they used to have hundreds of thousands of people standing there pouring through the border in Tijuana, Mexico, this weekend they had nobody. You had a man sweeping this massive piece of concrete, which is, the area where they said massive. And I've looked at that during the Biden administration. You couldn't see a piece of that concrete. There were so many people on it. You couldn't, if you had helicopter shots, you couldn't see concrete. Now, this weekend, you had nobody there but a man with a broom sweeping it and cleaning it up. Pretty amazing. It's really an amazing job. But it will be used for that. It'll be used for a lot of things. It'll be used by the Department of Justice for doing a great job. Pam is doing a fantastic job. So it's going to be used for a lot of different things.
Mr. President, on a 10% tariff, is that a basement? Is that the
It's a
floor?
baseline.
Can countries negotiate that to bring that
It depends
down?
on what they're adding. You know, some countries we have massive deficits with, or they have big surpluses with us, and others it's not that way. So it depends. That's why it's really they're all different. Every country is different. Some have certain advantages that others don't have, and certain things. We have some. China has a surplus of $1 trillion. I mean, the numbers are crazy, and others have basically no surpluses. You know, we have some that are pretty even, but they hurt us in other ways, and we just want to get that taken care of. So everyone is a little bit different.
So are you negotiating with the EU as one bloc or individual nations for the tariffs?
We're looking at it as one block. They've been very tough, but they were very smart. They were ready to announce retaliation, and then they heard about what we did with respect to China and others, but China, and they said, you know, we're going to hold back a little bit. They decided to hold back. I thought they were very smart. Look, the EU is very smart, but they really have taken advantage of the United States. They were formed for the purpose of taking advantage of the United States. And I don't blame them, and I don't blame China. I don't blame anybody. I blame the people that were sitting at that desk in that other beautiful Oval Office for allowing it to happen. Many presidents I blame. They should have never allowed it to happen. And I'm doing something that a lot of them wouldn't want to do. But I'm here, I do those things, and we're going to make this country great again. We were taken advantage of by almost everybody. I sat back in the last administration. I would actually read them. I don't have to read them now. I know them so well. I would read some of these documents that were signed, deals, and I said, who would do a deal like this? Who would do it? You've seen it, Elon. Yeah. I'd look at deals where it's so one-sided. Even we have a deal with Japan, and we get along great with Japan, and we had the Prime Minister here. He was fantastic. As you know, Abe was great. Shinzo was great. He was a good friend of mine, unfortunately no longer with us. But we defend them, but they don't have to defend us. I said, that doesn't sound too good. But we have a deal, a defense deal. We pay hundreds of billions of dollars to defend them. But if for any reason, in other words, we pay all the money. They don't pay anything. But if we're ever attacked, they don't have to do a thing to protect us. I said, well, that sounds like a wonderful deal. So that's just one out of thousands. And I just wonder who did this. And it's people that either hate our country or didn't care, an expression that you use. I think it's really a lot of them didn't care. It's just hard to believe how bad they are. Now that's a little bit of a defensive deal, but I'm talking about trade deals, the same thing. They're so bad, you would say, how come? And even when I'd renegotiate, like I'd go to a country, they'd give me everything I asked for. I said, why didn't somebody ask for it like originally? They give me everything. I think when they were negotiating, they didn't care, or they didn't ask, or they were shy, or they were very stupid, or they hate our country. Yeah, go ahead, Jeff.
You were speaking about Japan. Can you clarify what your vision is for U.S. Steel? You referenced it yesterday.
Yeah.
There's some questions about what you actually want to
Sure.
see happen
Look,
with that.
U.S. Steel is going to do very well now because of tariffs, and I don't know why they even need a deal. But the only thing is, U.S. Steel, if you go back 80 or 90 years, that was a behemoth in this. That was our biggest, most. If we were around, we would have been very proud of it. Today we have different types of companies that are big. Google, it's not the same as U.S. Steel, and I love Google, and I got to like the people that run it. They're very capable people. They didn't like me so much in the first administration, but they like me a lot now. I don't know what happened, but I like them. But I think they would be the first to admit, when I envisioned, you look at some of those steel factories from 90 years ago, it was a different kind of a country. but they were miles long. Today you see just empty hulks. Those hulks are going to be filled up very soon because of what I'm doing with tariffs. It was a different kind of a thing. But if I didn't do that in the first term, my first term, if I didn't put tariffs on, we would have, because China and others were dumping steel, billions of dollars of steel. Our steel companies were all closing. Every fact, we wouldn't have one steel plant open. And now we have a steel industry that's doing very well, but soon it's going to be thriving, really thriving. And those factories are going to be filled up, but more importantly, they're going to build brand new ones. Nucor and so many other companies call me, Nucor being a big steel company. They're building massive new steel plants, and it's great. And likewise, car companies. We have many, many car companies. 3 of them, I'm not looking to hurt Mexico, and I like Mexico. And by the way, I think the new president is a terrific person, a fantastic woman. We've had many conversations. She's a very elegant, just a fantastic person. And she's been very nice, very, very nice. But I'm not looking to hurt them, but we have 3 car plants that were under construction in Mexico. They stopped constructing, and now they're going to build in the United States because of tariffs. See, we should have never let this happen, because whoever it was that was president at the time, we lost 90,000 plants and factories since NAFTA. 90,000. It's not believable. How about that, Laura? You know, you're in that sort of world of factories and
build back
plants.
manufacturing, construction jobs, and bring those workers back home.
That's right. We're going to bring them all back. But think of it, from that period of time, which isn't so long ago, we lost. I said the other day, if you had a map on a big wall like this, and if you had pins, 90,000, I don't know if you'd have enough. I don't think you'd have enough room on the map to put the pins. 90,000 factories that we've lost since NAFTA. And it's not even, and about 6 million jobs, really, I think probably a lot more than that, but they say 6 million jobs. We're going to bring many of that back. I think we're going to bring more than all of it back. We're going to be better and stronger than ever before. But if a president, when they were leaving, said, look, you can leave, but if you're going to build a factory someplace else, and you think you're going to come and sell your steel or your car or any product that you make, your pharmaceuticals, which we're going to do, we're going to get them all back. But if you think you're going to just, all they had to do is say this, and they wouldn't have left. You know, I said it the other day. I said it with respect to, I made a speech a year ago, and I told them if I win, we're going to charge a big, big tariff at the border. And people were thinking about building in Mexico a car plant. And I said, we're going to have a big tariff. So if you want to build a car, you're going to have to pay 25% more than the cost of that car. You're going to have to pay 25% tariff at the border. They would have never left. They could have kept everybody. If a president said, if you leave this country, you leave Michigan, you leave Detroit, you leave anybody, any of our states, because to me they're all the same. I love them all. I love them all, and I probably won them all, but they say I won most of them, but I think I won them all, but that's okay. But all you had to say if you were the president is, if you leave and you think you're going to now fire all those workers, leave all that, everything behind, and you're going to build in another country and sell it any, and no, you're not going to. You're going to pay 50% or 100% tariff. They would have never left. And all you had to say, Marco, all you had to say very simply is, you don't have to write it down. All you have to do is say it verbally. If you leave, you're going to pay 100% tariff. Therefore, don't leave. They would have never left. But they left 90,000 plants. I mean, it's hard to believe that many. It's not, you can't envision it. So just getting back to your, because I'm the great weaver of all time. To weave, you have to be a genius. To go on tangents, anybody can do that. But we'll get back to your original U.S. Steel. U.S. Steel is a big name in this country. Babe Ruth is a big name. We have a lot of big names, but not too many. U.S. Steel is one of the great names in the history of our country. And normally I wouldn't mind so much. I wouldn't be thrilled with it. But to buy for a foreign country, and we love Japan, but for a foreign country to buy that cherished U.S. Steel brand, That's hard for me to do. And maybe somebody else may want it. The company Nippon that's involved with it is a big, powerful company who do a good job. But why can't they just build a plant themselves? I mean, why do they have to, take U.S. Steel? So as you know, I rejected the deal. Now they've come back in a different form. They're coming back as an investor. And, I feel better about that, I guess. But, I know them very well. I know the thinking. It's the investor. They'll invest, and somebody else maybe is sitting in this chair, and they will no longer have an investment. They'll have the whole thing. That's the way it works. They're very smart. They're very, very smart people. We're dealing with very smart people throughout the world. Great geniuses, actually. Look what they've done to our country. And again, I don't blame China. I don't blame anybody. If I could have done it, if I were in that position, I'd have great respect. I have great respect for the people. They ripped off the United States, and all we had to do, have a president that knew what the hell was going on, and none of those countries would have left. Those companies, none of them would have left. So that's a little lesson in basic business. And it's really basic business. It's not complicated business. It's very basic business. And we'd have every one of those car plants going just the way they were 30 years ago. None of them would have left, but now they're coming back.
Mr. President, the Labor Department has confirmed that $400 million went to fake people for unemployment benefits.
Yeah.
Just what are your initial reactions?
I think it's terrible. I just heard it from Lori, and I appreciate it, and you heard it from Elon's people, right?
That's right.
Elon's done a fantastic job. Look, he's sitting here, and I don't care. I don't need Elon for anything other than I happen to like him. But I'm telling you, this guy did a fantastic job. I don't need his car. I actually bought one and they said, "Oh, did you get a bargain?" No. I said, "Give me the top price." I paid a lot of money for that car. But honestly, he makes a great car. You know what I do with it? I let the people in the office drive around in it. Margot and Natalie, they're all, Chamberlain, they're all driving around the most beautiful car. It's gorgeous. But I did that as a sign of, just a show of support. Numerous people have done that. Just a show of support. Because, he's done a fantastic job, but he hasn't been treated properly. Hasn't been treated properly, yeah.
Mr. President, can you talk to us about your communications with China? Has President Xi reached out at all since the tariff?
Well, I don't want to say who's reached out. I just say that I think it's going to work out, hopefully well. They're very big. It's hard to get over, if you're me, what they've done to our country. They've destroyed our economic base to a large extent. The good news is we're very vibrant, and we're going to get it back fast. We already have. Look, we're making $2 billion a day now, and during Biden, we were losing $3 billion a day. Biden was a disaster. He was the worst president in the history of our country. And to me, worse than that, because the money you can make if you have the right guy in this position, worse than that was what they did on the border. By allowing the jails of the world, not South America, all over the world, to be opened up so that we take everybody from Africa, Asia, South America, Europe, the bad ones. They opened up their jails and they dumped them in the United States. And now this beautiful young woman who seems to be, boy, she loves what she does, though. I think she loves what she does because she's a patriot. She hates to see it. And Tom and all the people. But for us to spend, hundreds of billions of dollars this is just, I don't know. They either hated the country. Who would do this? Who would want millions of people to pour through an open border? We have no idea who the hell they are. And just walk right through. And half of them, whether you like it or not, you could look at them and you could say, they are not going to help us. These are some rough people. But they'd empty out their jails, and they'd empty out their mental institutions, insane asylums, and they let them into the United States of America. And inflation we can fix, and all of the other things we can fix. We'll get it going. But this is something, it's such a horrible thing, and it's really hard. we have to do deportations. Now we're doing self-deportation. We're coming up with all sorts of ideas. And they must have known it's not going to work out well. And, we want people to come into our country, by the way. We need them badly for the jobs. But we want them to come in legally. They have to come in legally. They have to show that they can love our country. Thank you very much, everybody. Thank you. Thank you very much.
President, Democrats are making allegations about market manipulation yesterday.
Thank you.
All right, everybody, you have been listening to President Trump there at the White House holding a meeting, talking about a variety of things. Very good afternoon. Live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week for this Thursday, April 10th. Another day where, again, we're focused on tariffs. We're seeing market volatility, Tim.
Yeah, the stock surge, that was so yesterday. The S&P 500 down 3.4%. The NASDAQ composite down 4%. The Dow down more than 1,000 points, 2.6% to the downside. We're going to have more from Charlie Pellet in just a minute.
Yeah, and we should point out we are bouncing off our lows of the session, but nonetheless, a reversal, not giving back necessarily everything that we gained yesterday, but nonetheless, again, a negative tone, risk off. We've got a great hour coming up. We're going to talk with Goldman Sachs Asset Management's Global Head of Insurance Asset Management. He has seen a lot of market cycles. He's got to figure out how to put money to work, investments to work in this environment. Curious to see what he has to say, but let's get to the trade, your top business stories on this Thursday. Here's Charlie Pellet.
Hi, thank you very much. Again, another day of selling on Wall Street. It is the fifth decline in the last 6 sessions. As Carol mentioned, we are well off session lows. You run the HCPI function on the Bloomberg. I can tell you the S&P 500 index was down by 6.3% at the worst level of the session. Here's where we stand now. We've got the S&P down 3.3%, down 179. The S&P now at 5278. The Dow, though, down 1,025 points on the Dow, a decline of 2.5%. The Nasdaq Composite Index right now down 687 points. That is a drop of 4%. The 10-year, 4.36%, with the 2-year that's currently yielding 3.84%. Spot gold higher by $80 the ounce, up 2.6%. The precious metal now at $31.62. Bitcoin is trading lower by 4.4%, 79,477 on Bitcoin. Cannot ignore West Texas Intermediate crude was trading below $60 a barrel. Back above that level right now, 60.21 on WTI. It is down by just about 3.5%. So bottom line here, we do have stocks plunging again today as economic angst continues to hit Wall Street. The S&P 500 index down now by just about 3.1%. Briefly, Prada is buying Versace for about $1.38 billion in cash, strengthening its position as Italy's largest fashion group by adding one of the luxury industry's best-known brands. Prada ADRs, they're up by 7.7%. Again, recapping, S&P lower now by 3.1% for on-demand news. 24 hours a day. Subscribe to Bloomberg News Now wherever you get your podcasts. Keep it locked into Bloomberg and television and radio for the latest. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are up to date on the markets. We're going to focus on the markets until we see the close today. But we do want to mention, of course, we're just off a cabinet meeting, President Trump holding one at the White House. Let's get some thoughts in terms of the policy, the implications. Ed Mills is Washington policy analyst, managing director over at Raymond James. Ed, safe to say many would assess that this is a very different political environment, geopolitical environment, and investors have to make sense of it. What do you make sense of what you just heard from the president and really the last 24 hours?
Yeah, Carol. So what I've been telling folks here at Raymond James is that there are 3 paths forward here on the tariff discussion. Number 1, Trump cuts deals or changes his mind. 2, the courts or Congress stop him. Or 3, he doubles down, and we're going to see a change of the global world order that's been established since World War II. I think in the immediate aftermath of the tariff announcements, the markets was over-indexing number 3. Yesterday's announcement was a move back to, oh, Trump is going to cut the deals. And I think that was a positive reaction. But as we're digesting this, here at Raymond James, we calculate that actually a 10% across the board, but 145% on China, the dollar-weighted kind of trade impact there is about 40% higher than the original announcement. So we get relief, But the China issue here is a huge issue. And from a dollar weighted average, a significant increase of tariffs across the board.
Ed, in your view, does the China issue get resolved?
I think it's a question of what does resolution mean? We have seen a greater openness from China in the last 24 hours than we've seen since January 20th. When I've talked to my China contacts, Tim, is that there's a sense that China doesn't want to get involved in another drawn-out negotiation. You go back to the first term. It took 3 years before we got the quote-unquote first kind of phase of that trade deal done. Xi does not know what Donald Trump wants. China does not want to negotiate and have the goalpost moved on them. They can't really sustain this forever, so something has to happen. But what Donald Trump wants, what the administration wants, is not clear enough just yet.
Ed, real quickly, 30 seconds. Can you invest in this market?
I think you can. I think that the bull case from here is that we get the deals. Congress, the House passed the budget resolution today. We're moving towards tax cuts. We saw executive action on deregulation. If we can build upon that, that's an investable market. We tell folks at Raymond James, stay the course, stick to your plan.
All right. Uncertainty, though, still the watchword. It certainly feels that way. All right, Ed, going to leave it there.
Absolutely.
Thanks for weighing in. Ed Mills, Washington policy analyst. He's also managing director over at Raymond James.
Well, back to the selling on Wall Street, because at one point today, the S&P 500 was off the most going back to March of 2020. It's bounced off that low, but still down 3.2% right now. Whenever we whip out these superlatives, we know things are getting a little, well, I don't want to say scary.
They're becoming the norm,
I was going to say, it's going to be like, it's kind of relatively rare, but the last week, Carol, we've been doing this quite a bit. We've also been checking in with Eric Weiner quite a bit. He's a Bloomberg News senior editor of Equities America. He joins us here in the studio. What happened between yesterday and today? Why the change in tone?
Well, yesterday was kind of a euphoric reaction, and you had this momentum of everybody waiting for that, that delay and it coming in. And then as that happened, we went up about 4%, and then the short squeeze started coming in, and liquidity was
and yesterday
really
was a lot about short covering, wasn't it?
Yes, that was it. So you had liquidity tight,
right?
So it just basically pushed everything way, way, way beyond where you would think it would go based on the news. And then there wasn't a whole heck of a lot of analysis on exactly what the tariffs meant, to speak to Ed's point, where China actually means a lot more. So escalating on China versus de-escalating on the others was, something that had to be figured out overnight. Once the session ended, on our team, we started talking about preparing for today, and we were talking about 2% to 3% down. It went further than we thought. But there's a lot of correlation in the market right now. So things are moving in groups and in clumps, much more so than they normally do. And when you see that, you get these massive moves one way, massive moves the other way.
So dollar down, stocks down, bonds down?
And yes, and also broad sectors of the stock market down all at once. So it's not just selling, say, tech. It's selling all of tech, everything in tech, and the whole sector goes.
Can I ask you, what's the significance, though? Because this is a thing that we've been talking about since we've seen the selling, is that global investors in general, maybe not looking at the U.S. as being a safe haven, whether it comes to stocks, whether it comes to the treasury market, the real world rate, the dollar as well?
That is exactly what's going on. We actually saw some movement away from utilities and REITs, where people get their dividends. So that's like the safety play in the market, in the stock market in general. And people are moving. The Europe Stock 600 is up today. Was up today. So it's people are finding other places to put their money.
You sat with us a week ago. You sat with us earlier this week. One common refrain we've heard from you is this has been an orderly demonstration of actions in the markets, whether it's been up or whether it's been down. Do you stick to that?
Yes, although at 6% we were preparing for the shutdowns. What we
circuit breakers.
The circuit breakers,
okay.
Exactly. Well, actually, yeah, because it would just be a 15-minute hold.
But still orderly to you?
Still relatively orderly. What we haven't heard and what we're waiting for is some hedge fund can't make their margin call. Some counterparties not showing up and there being empty trades. We're not
Things are
hearing about
working.
that. Things are still working. Yes.
What would make you change that view? What are you going to look for to say this is no longer orderly? I'm getting flashbacks to 2020, to 2008, 2009,
COVID, yeah.
and flashbacks to the dot-com bust.
Yeah, when we start hearing about a fund going under, we start hearing about funds being caught, because everybody's caught off sides here, but caught dramatically off sides. And it's a lot of leverage in the system. There's still a lot of leverage. So when that starts unwinding, we will start getting calls like, oh my God, we're hearing a fund is going to go under, and it's a big fund. And that's when things start getting really concerning. We haven't reached that point yet.
Oh, TBD.
Yeah.
Just kidding. Just kidding. Eric, thank you so much. Eric Weiner, Bloomberg News Senior Editor, Equities America. All right, stocks down, and this is despite some good inflation data. Yeah, folks, we got a CPI report this morning. I know it feels like hours ago. It was hours ago. But let's talk a little bit about the economic fundamentals and someone who here at Bloomberg just kind of rolls in trade policy, the global economy, everything into one. Michael McKee is back with us.
Yeah, but
I'm talking you up, so you better deliver.
I thought Duke was going to win the Final Four. So.
A lot of
spoiler
people,
alert. Well, I know.
A lot of people missed it.
Yeah.
How are you? Okay, inflation was good.
Inflation was good.
Yeah.
And it really doesn't tell us much, which is kind of the cliche that we were all going into this with, because it's before the tariffs came on.
Yeah.
But it was better than expected. The headline dropping 0.1%, and that was largely due to gasoline prices going down 6.3%, which isn't necessarily good news because prices went down because people were marking down growth outlooks.
Huh.
But we also saw furniture and apparel. We get a lot of those from China up, but they were up by about the same amount they usually are in March. So it wasn't a big deal. There were two things that were interesting. Smartphones down 1.1%. You would have thought that maybe prices would have gone up. Unless Apple was, we saw a story today about how they brought in a bunch from India.
Right.
But then travel is the one area that seems to be already taking a big hit from tariff talk. Airfares were down 5.3%. Hotels and lodging down 3.5%.
That's real.
And what was really interesting is Omar Sharif, Inflation Insights, he gets granular with this stuff. It was all hotels in the Northeast, which to him suggests it was Canadians.
Oh, interesting.
Okay.
We've heard that from people on the states here on the East Coast that border.
And so maybe this spreads
upstate
into the
New York.
next month, but because it's the timing, the Fed isn't going to pay much attention.
But from a tourism perspective, if you can attribute that to Canada at this point, or if Omar Sharif can do that, is it economic uncertainty that we can also attribute to the decline in hotel prices and the decline in airline prices? Are companies not booking to the same extent that they were several months ago as a result of uncertainty?
It definitely seems that way, and we're getting tourist boycotts. And so this could be a major impact on the economy. Tourism is much bigger than people think, certainly big in New York City. That's something we have to keep an eye on. And what's also kind of interesting is we don't know how long any of this will last, but remember next year we're supposed to have the World Cup here. And there are people already talking about...
Well, not just here, but throughout North America.
Yeah, well, everybody will go to the games in Canada and Mexico, but will they go to the games that are here?
That's really interesting. Hey, listen, our most read story on the Bloomberg right now in the past eight hours, stock slide as economic angst hits Wall Street. When you look at the economic fundamentals, when the Fed, Mike, is looking at the economic fundamentals, right, we know what their mandate is. How are they assessing the situation right here on this afternoon, and how are they maybe thinking about the market volatility and how that plays in?
Well, I haven't talked to anybody this afternoon, but I suspect that, like everybody who's a professional at this business knows, this is kind of the pattern that you see. You get the big up day, and then it goes back down again. And so they're not going to be surprised by that at all. Depending on how bad the correction gets, you could have a wealth effect issue that would slow growth. We'll have to see on that score. The real issue for them was what was happening in the bond market.
Right.
And we did talk to a number of them yesterday, including Beth Hammack, who used to be the treasurer at Goldman Sachs. So she knows the markets. And they basically felt that there was a lot of volatility, but there wasn't a systemic issue. There wasn't an imminent failure of market operations, which would be about the only reason that the Fed would get involved. So it's good news that when we're having these kinds of disruptions, that the system is holding. And you were just talking about how this is an orderly decline. I mean, we're getting 3-4% down a day. We're not. Yesterday we had the big rise, but we're not seeing the kind of collapses that we saw in previous episodes, like when you have a Thursday down 7% and a Friday down 5%, and then Monday in 1887, 22%.
Right.
That hasn't happened, so it doesn't suggest there's a panic out there that the Fed would have to worry about.
Okay, well, 30 seconds on that, Mike. A host of Fed speakers making news today. How would you characterize that they're looking at this?
Oh, it's almost like they're singing from the same script. They're all saying, we have to keep an eye on this. We could have a problem with growth. We could have a problem with inflation. We're more worried about inflation than we are growth at this point. But we are unable to make a decision about moving rates one way or another because there's not enough information. But the good thing is where rates are is perfectly acceptable to us. So you just expect them to stay on hold and to not say anything controversial for quite some time.
20 seconds. I'm going to squeeze in one more. Anything that could a Fed rate cut, do anything to kind of appease our trading partners? Like, I think about the trading picture overall, how global investors, how other countries are looking at the United States and feeling uncertain about the outlook or what we might get from the White House next.
I don't think a rate cut would make a difference because it wouldn't be coming from the administration, so it wouldn't have any policy impacts. It could have an impact on the dollar. It could, in theory, bring dollar's value down, but it seems to be doing that on its own.
Yeah, it's doing just fine on that.
I'm not sure.
All right, cool stuff. Michael, thank you so much. Mike McKee, he's Bloomberg News International Economics and Policy Correspondent. Let's talk a little bit more about the U.S. Treasury market, the U.S. rates market. Bloomberg Intelligence headquarters out in Princeton, New Jersey. That's where we find Ira Jersey. He's the team's chief U.S. interest rate strategist. So, Ira, glad we could talk to you. I feel like it really is about the bond market. We did have a 30-year auction. Looks like I think it went fairly well. So talk to us a little bit about that and the overall trade that we're seeing in treasuries today. We also had, of course, that inflation print that Mike just talked about.
Yeah, so the long bond, the 30-year Treasury bond, had sold off pretty dramatically this morning, and I think some people were trying to say, oh, let's hop in here a little bit. We can get cheaper levels, and the auction went very well. I mean, the auction, we graded it an A, and after yesterday's 10-year that got a grade of A+, the people don't mind buying demand at auction, but it didn't stick, and I think that that's an important factor here, whereas yesterday, you kind of got this big snapback and a pretty big, large rally after such a strong 10-year auction. Today we rallied a little bit, but as I mentioned, it didn't stick. And the yield curve has just steepened absolutely massively. And the question becomes, is that because of some flows and just people getting out of the long end, like private pension funds or insurers from overseas? Does it have to do with people thinking the Fed's going to cut rates and that's going to stem inflation in the long term, or is there something more nefarious going on under the system? And some of these things we don't know yet. I suspect that a lot of it is just people who are fearful that foreign investors who have had such a big bid for long-term Treasury bonds, that bid's just gone away, and now we're trying to find a new level where buyers care.
I mean, are you talking Japan, China? Who are you talking about?
Well, we're just about everybody. I mean, so for one thing, a lot of people have been saying, "Oh, is this China selling? Is this China selling?" You know, I don't know, but at the same time, China has a lot of FX reserves, the same as Japan, and foreign exchange reserves generally are not held in long-term treasuries. They're usually held 5 years and in. And if you go, just speaking with central banks globally, that's the case. Whether it's Brazil, Peru, China, it doesn't matter. They tend to buy only short-term treasuries. Who does buy long-term treasuries are private investors. It's the insurance companies, the hedge funds, the sovereign wealth funds certainly are own them. So I suspect that it's some combination of them and it might not even be them selling. It's just fear that they won't be buyers. And I think that that's a big thing that we have to remember. Sometimes the market reprices not because of actual flows, but because people think that those flows either will or won't materialize. There's private foreign investors globally own a ton of duration risk. We put out a note earlier this week where we show a chart just of how much duration they own, and it's hundreds of billions of dollars. So it would not be a big surprise that if a life insurer in Taiwan gets a nod from their board and says, hey, don't buy treasuries anymore, that wouldn't surprise us at all, because it's with what's going on with trade flows, that's going to affect boardrooms and how people perceive U.S. Treasuries as an investment vehicle.
Net, Ira, because I've been thinking about this a lot, and we've had everybody talking about, of course, the stress that they've seen in the Treasury trade. We heard the president addressing it and the reason why he put that 90-day pause in. I mean, has that gone away, and do we truly understand the stress points at this juncture?
Well, if you mean stress points, like when I look at the market and market depth, the market depth certainly has gone down a little bit, but I think in large part that's just because of the volatility. So generally speaking, you're talking about bid offers getting wider as the market becomes more volatile. So that's a natural cause. I do think that there are some stress points insofar as that dealers, so Treasury dealers, were as long Treasuries as they've ever been as of last week. Now we get more of that data. We get a new read on that data as today at 4 o'clock. And so because they're so full, I think they went into this sell-off without having the capacity to buy more. So that's one reason why doing something like exempting treasuries from the supplementary leverage ratio or supplemental leverage ratio might maybe help liquidity generally, because then you can have elasticity of dealer balance sheets that just doesn't quite exist today. And like I mentioned, dealers also had over $400 billion of treasuries on their books, the highest ever a couple of weeks ago. So they weren't able to buy more. And that just means bid offer has to widen. That means that it's harder for them to intermediate the long end, right? These long duration, high risk, price risk securities anyway, in the 30-year. Meanwhile, the front end, that rallies, right? Look at how massive this curve steepening's been. It's been incredible. It's been a great call by us, not the way that we thought that the curve was going to steepen, but that was our key call starting the year, was being steepeners.
Ira, there's been a lot of reporting in the last 24 hours about why we saw the pause, the 90-day pause from the president yesterday. And some reporting has indicated that the bond market helped him make that decision, or helped his officials move him in that direction. How do you view the power of the bond market when it comes to this president?
Well, for every president, the bond market is key. The U.S. Treasury market is how we fund our debt. It's how we're perceived globally in terms of having both the safe haven currency or have the reserve currency and a safe haven asset that is U.S. Treasuries. But we're still going to have, regardless of what President Trump and what Congress tries to do, we're still going to have multi-$100 billion, if not trillion-dollar deficits for the next few years. And in order to fund that, you need to have a functioning Treasury market. And obviously, if you're the government, you want to have interest rates that are as low as possible, especially given whatever the economic environment is. So all of those things are true. So the Treasury market is key. And if people aren't buying treasuries globally, that's, or I should say that people buy treasuries globally because of the recycling of dollars, because we export a lot of dollars because we buy other people's goods. If that goes away, you're going to see probably in aggregate interest rates are a bit higher than they would be if we did export a whole lot of dollars.
What I want to go to, though, is what the Wednesday sell-off that we saw, the basis trade that everybody keeps talking about, right?
It's not the basis trade. Oh, my goodness. It's like the basis trade's in two-year notes. Two-year notes are rallying. If this was due to the basis trade, the two-year notes would be selling off, and they're not.
Okay. Well, that's why, because I'm trying to, everybody's kind of shooting stuff out there in terms of exactly what happened, and I just want to have the right context in terms of the president pointing to the bond market, everybody talking about it. Do we really understand what happened, and are we in a better place, I guess is my question.
Well, I don't think we completely understand what happened, and I don't think anybody does yet. We will find out over time. But in terms of the basis trade, right? The basis trade, I think, is scary to a lot of people because it is so large. But keep in mind, the basis trade exists basically for two reasons. One is that asset managers, so general investors, whether they're hedge funds or mutual funds and the like, they go out and they buy Treasury futures. Well, if they buy Treasury futures, someone else has to be on the other side of that.
Right.
And the person on the other side of that has to hedge their interest rate risk then. And so they do that by either buying Treasuries or receiving in interest rate swaps. And either way, you wind up in an environment where someone has to put on that basis trade. And there's been a lot in 2-year notes, 5-year notes, and 7-year notes that people have been doing this. And it's in large size. Is it a systemic market risk? I don't think so, right? It's only a systemic risk if everyone, only one side of that trade wants to get out of that trade. So that's where I question whether or not it's the basis trade is driving this volatility.
It's what I wanted to ask you yesterday, and I couldn't get to you, and now I got to you today. So I'm so glad we could. Ira, thank you. Really appreciate it. Bloomberg Intelligence Chief U.S. Interest Rate Strategist, Ira Jersey.
Hey, keeping an eye on markets is Charlie Pell. Let's get to him for an update on the markets and, of course, the business flash. Hey there, Charlie Pell.
Well, hello there, Tim. We are lower, off-session lows. Do want to begin, though, with a couple of developing stories, headlines right now on the Bloomberg Professional Service. The U.S. wants to install federal oversight of Colombia. The Trump administration wants Colombia to enter into a consent decree, that according to the Wall Street Journal. Also getting word that Novartis, the drug maker, is going to invest $23 billion in U.S.-based infrastructure over 5 years, and Novartis up now by about 0.1%. A lot of red on the screen today as the selling continues. We are down in 5 of the last 6 sessions. Right now we have got the S&P 500 index dropping by 2.9%. At the worst level of the day, we did see the S&P down by roughly 6.3%, but again down 160 points now on the S&P. Dow Industrials lower by 904, down 2.2%, and NASDAQ is down 637. For the NASDAQ Composite Index, a drop of 3.7%. The Russell 2000 Index, broad-based selling, down now by 3.6%. Small cap shares moving lower. The 10-year, 4.38%, with your 2-year at 3.85%. Spot gold up $82 the ounce, $31.65, up now by 2.7%. West Texas Intermediate crude down 3.7%, just above $60 a barrel, $60.02, and Bitcoin is now down 4.2%, 79,700 on a Bitcoin. So again, the Dow, the S&P, NASDAQ, all declining, off-session lows with a 3% drop right now on the S&P. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, you're up to date on the markets. Again, volatility and uncertainty, the watchword. We've got a great next guest who's got a global view, has seen a bunch of market cycles. With us is Mike Siegel. He is a partner at Goldman Sachs Asset Management, serves as global head of the insurance asset management and liquidity solutions businesses, as well as co-head of the client solutions group in Asia Pacific. You do see a lot. Also with us as Bloomberg TV global finance correspondent Shonali Basak, who actually brought us Mike. So we're so grateful because there's so much going on, Mike. And we want to dig into your specific worlds, but you do watch everything globally. And I'm assuming everything is connected. You watch a lot of different markets at this point. Let's start with the environment. We had one auto parts CEO describe it to us as the great financial crisis, the COVID shutdown, and the auto strike all rolled into one, at least for him specifically. How do you see today's market environment?
Well, Carol, thanks for having me, and thanks for that question. I think that people are clearly on edge and are reluctant to make any significant decisions until we get better clarity as to where the tariffs are going to end, where that situation is going to end. Once we have more clarity to that, you can then go back and see the markets will react, they'll adjust, the Fed will react, it will adjust, and so will companies in terms of how they're going to invest, including my insurance clients and including the liquidity clients.
We don't know how it's going to end, but I'm curious if you've mapped likely scenarios for how they'll end. What do you think is going to happen?
Well, we do map scenarios, and so first I'll stick with the insurance industry, which is very well capitalized and not levered in the sense that they're not over their skis. They don't hold a lot of equities on the balance sheet, so the equity market volatility that we've been seeing is not creating a capital strain. They are primarily fixed income investors, and by the way, we're seeing the intermediate and long end of the curve rise. We're seeing credit spreads widen. So on reinvestment, that's a pretty good situation, as long as it doesn't continue to cascade into something much more significant. Yeah.
Even though it's good for the longer term, for people who are reinvesting in bonds, you have insurance clients that are holding long-term bonds, and 10-year, 30-year notes are really blown out at this point. Are they suffering through a lot of pain because of it?
Yeah, so Sonali, you're absolutely right that on a mark-to-market basis, these bonds have lost value. But most of these institutions don't have to report on a mark-to-market basis. They're able to hold their bonds to maturity. So really, they are more benefiting from the ability to reinvest at higher yields than what's been happening to the current holdings. Not the same thing being true for hedge funds, example, or other institutions that are marked on a daily basis may have to provide collateral as their asset values are dropping. But that's not the case for the insurance industry.
But do they feel that there's a certainty that this does get resolved sooner rather than later? I think I love your interview you did with Boaz Weinstein, who I thought was assessing the situation and saying the thing is here, we have a president who's in for just under 4 years here, and that he said the uncertainty genie is out of the bottle. So do we continue to, in your view, and you've got to think about short term, longer term, medium term, that uncertainty will be with us throughout this tenure?
I think uncertainty will be with us, hopefully not at the level that we have right now. And again, it's are companies in a position where they're forced to act or not? And to the extent that they're not over-levered, they're not forced to act, they could sit, watch, and look for opportunities. And I could tell you—
Are they nervous at all?
Oh, absolutely.
Okay. Keep going. Sorry.
So I would say, when you game plan out, right now this has primarily been an equity market event. Concerns that it becomes a bond market event. Rising yields are not that much of a problem. Draining liquidity becomes a problem. So there's a concern or a watch for that. Also, I would say for our insurance clients, they are long-term holders of corporate debt. How are those corporations going to fare? And certainly some corporations are going to be much more affected by tariffs, which would weaken credit. Others are immune to it. So we and our clients are doing a lot of work right now, going literally bond by bond, security by security. What is the sensitivity to the tariffs or not?
Well, on a micro level, some of that uncertainty has already led companies on a case-by-case basis to pull guidance. CarMax today, certain financial goals that it's just not giving. Delta earlier this week. You mentioned a lot of uncertainty, and I know yesterday Goldman Sachs rescinded its call for a recession this year. Are you seeing signs of a recession?
So let me say this. So one of the things we want to talk about was the survey. First, I would say on the insurance survey—
it's a 14th annual global insurance survey, 405 companies representing over $14 trillion in balance sheets assets combined. That's a lot.
That's a lot. It's about half the global industry's asset base. I bring that up because one of the questions we said is, what are you concerned about? And that question they got absolutely right. They're concerned about inflation. They're concerned about geopolitics. They're concerned about tariffs and market volatility.
Welcome to our world in a nutshell.
What they didn't get right, and nobody did, was the magnitude of the tariffs and the implications for that. So they didn't see recession this year. That view is changing, including at Goldman Sachs and within our clients. They thought the equity markets would be well-behaved, not rip-roaring, but well-behaved. That view is changing quite dramatically. That they also thought that rates had peaked and would be coming down slowly, both at the short end and the long end. And I still think that that's the prevailing view. So this backup in longer-term rates is looking like an investing opportunity. None of our clients have been selling or directing us to sell on their behalf. They are looking for opportunities to get into the market, but they're not in a rush. They want to see how things settle out. Once they see how things settle out, then they'll know where to put capital to work.
You mentioned that you're looking bond by bond right now. And the reason that's so interesting to me is because you're already seeing somewhat of a capital markets freeze. And if you're worried about corporate debt at all in this environment, what does it mean for the way people have confidence in investing in corporate debt in the future, in new issuance, for example?
Yeah, so Sonali, that's really going to be industry by industry, case by case. And that gets back to this uncertainty. Until we know how this unfolds, and it may not it may not unfold to a point where that we have definition. This is the way it's going to work. You've elevated the amount of uncertainty, which is elevating the amount of risk. I need to get paid a bigger risk premium to hold any of these instruments. And that's why we see credit spreads widening out.
You know, a lot of people are saying this is also a golden opportunity for while public capital markets are freezing to look at private capital, because you're seeing these private credit giants just float right in as the public markets are closed. But are you concerned that there's still a lot of pain under the surface in private markets, given that, you know, they call it the denominator effect? These companies are seeing their public portfolios really shrink and their private portfolios therefore become a bigger proportion of their holdings.
So let me take that question break that into two parts. One is the underlying asset values themselves. And so we've got private equity, we've got real estate, we've got infrastructure, we have private credit. At the moment, we're not seeing any of this flow through to the existing investments that have been made, but we have to see how things unfold. And if we end up in a deeper recession or a deeper recession, that's going to weaken the underlying asset values. Now, the thing you said about the denominator effect is the ability to put new capital to work. And there's two components to that. One is I already have a private equity portfolio. I was hoping to get realizations, give me fresh cash to put back to work. And if the public markets are closed, particularly the IPO market, you're not going to see as many of those realizations. So I'm going to be keeping more of my capital tied up in those assets. And then the second point you're making, which is more applicable, quite frankly, to pension plans and sovereign wealth funds, is as the public assets, particularly the equity assets, decline in value, all of a sudden my exposure on an asset allocation basis to the private assets has increased. Again, reduces my willingness to invest more. So
because this was supposed to be the year, right? That all of a sudden we could tap the public markets, sell some assets, IPO, whatever, right? Or M&A, and it.
Well, this was supposed to be the year. It is only April.
Okay. So you are hopeful that it gets better?
Well, I'm always hopeful, but we shall see.
I guess I'm just saying in an environment where if we expect more uncertainty over the next 3.5 years, that makes it tricky, right?
It makes it tricky. I think, you know, right now the administration is in the middle of trying to rebalance trade through tariffs. At some point that will settle, and then the markets can assess what does it all mean. And then I think you will see markets open up again. You'll see more flow of capital.
We're talking about the risky stuff. But I'm also wondering, you have one of the biggest money market businesses in the world under your purview. So how are those behaving? What are they being used for in an environment like this? Because it's generally safer than a lot of the debt markets that we're talking about.
Yeah, so Sonali, we manage over $700 billion of short-term liquidity products. We consider that to be the canary in the coal mine. So we're always watching what's happening with flows there. And at the moment, things have been very stable. The vast majority of the assets are government assets, you know, short-term treasury bills, et cetera. And we don't see flows coming into that market. We take that as a good sign. Another part of the market, which is called prime, includes a lot of commercial paper and other short-term debt of corporations. And we don't see companies moving out of prime. So at the moment, and we watch very closely, things feel calm at that end of the market.
When money leaves your money market funds, where does it go?
Well, over the last several crises, if I could say it like that, it's been actually coming into the money market funds. Basically, you know, the two competing forces would be bank deposits and money market funds. And, you know, some of the crises have called into question, you know, creditworthiness of banks, so it comes into the money market funds. If people are very nervous, it's going to go into government money market funds. So primarily T-bills and other government guaranteed forms of debt.
Are you calling this a crisis right now?
No.
Are you seeing money coming into money markets?
No, as I said, we're watching on a daily and minute-by-minute basis, and we haven't seen any flows come in, unusual flows, nor have we seen flows moving out of prime into government.
Guys, by the way, every single crisis for the last decade or so, Mike has been one of my first calls, which is exactly why I wanted to bring him.
How's it going?
Sonali, I hope that's not why you called me in today.
Is any money going outside the U.S.? Increasingly?
So, you've seen, coming into the beginning of the year, it looked like the U.S. economy was going to be the fastest outside of China, the fastest growing economy in the world.
Exceptionalism, right? We talked about American exceptionalism.
Exceptionalism. And you also saw the dollar strengthening over a long period of time. So if I took foreign money and put it into the U.S. market, I had probably a underlying market that was going to rally, and I pick up the currency appreciation, a double whammy. Right now, the dollar's weakening, and the U.S. markets are selling off, so I'm sure that that's putting a damper on those flows.
I want to go to China and specifically the U.S. relationship with China. You spend a lot of time in China. You live partly in Hong Kong. You're co-head of the Client Solutions Group in Asia Pacific. Is the relationship between the U.S. and China broken?
That's really not in my bailiwick, but I will tell you our relationships with the government entities and the companies that are there, between our firm and those entities is very strong. What's playing out is just playing out above everybody's head, and we're leaving it to play out at that level.
But it has significant implications for the way that companies do business with one another. If one country has tariffs that exceed 125%, if it exceeds that, that's a big deal.
It's very important for the two countries to have good relationships, and then that translates down into the entities that we work with and the relationships we have with them.
Can I ask you one last question? Oak Tree Capital Management co-founder Howard Marks wrote today that Donald Trump's tariff policies have the potential to be the biggest economic event of our lifetimes, and warned that reversing them could still have consequences. Do you agree?
I don't know if I agree with that statement, but I will say this, that volatility has a cost. It's undermining, people's confidence to invest, whether it's corporations building plant and equipment, whether it's investors putting money to work. So there is a cost of volatility, and we're seeing that by the declines in the market and the widening out of spreads.
So appreciate this. Thank you so much, so much. Mike Siegel, partner at Goldman Sachs Asset Management, global head of the Insurance Asset Management and Liquidity Solutions business, also co-head of the Client Solutions Group in Asia Pacific. Mike, thank you very much. Really appreciate it. And Shonali, thanks for bringing us Mike, Bloomberg TV global finance correspondent. So if she calls you, you know what it's about. Is this a crisis?
But he says no for now.
He says no for now.
All right, let us know if that view changes. I do appreciate it. Thanks again to Mike Siegel. Let's now head on over back to Charlie Pellet. He's been keeping his view on the markets. Hey, Charlie.
Hi, thank you very much, Tim. Here's what's going on. Economic angst, big time again today. We are off session lows, but the Dow, the S&P, NASDAQ, all very much in the red right now. Looking at a 2.8% drop on the S&P 500 index. We're down 153 right now at 53.03. We've got the Dow lower by 2.1%, NASDAQ down 3.5%, keeping that all in context. Again, the S&P down by 2.8% of the worst level of the day. We did have the S&P falling by more than 6%. The 10-year 4.38% with the 2-year currently yielding 3.84%. We got a whole lot more on the markets coming up with our Gina Martin Adams. Spot gold is surging $90 the ounce right now, up by 3%. Precious metal at $31.73 the ounce. West Texas Intermediate crude down 3.2%, 60.38 on WTI, and Bitcoin right now down 4.2%, 79,639 on Bitcoin. CarMax backing away from the timing of its financial goals, joining a growing list of companies, indicating that uncertainty around President Trump's trade war is making long-term planning difficult. CarMax right now down by 16.1%. And we're just getting word that a passenger jet carrying at least 2 members of Congress was clipped by another commercial plane on the ground at Ronald Reagan Washington National Airport. Developing story. We got the headline right now. We'll have more details as they become available. Recapping S&P now down by 2.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie, giving you the update on the markets. Got to say, our Gina Martin Adams warned us yesterday that yesterday's rally did not give her too much comfort. I think I'm saying it safely. Based on her models, they're data dependent. Her view and concerns about the equity outlook has not changed. So let's just see what her thoughts are today. Gina is, of course, Bloomberg Intelligence Chief Equity Strategist. Did I say it right?
That's right.
All right. No, but did I say your warning was
Yeah,
right?
yeah, it's close. It's close enough. You know, it's minute to minute these days, Carol. So,
well, so how do you make sense?
Yeah.
Like the rally yesterday, right? It wasn't.
She basically, you came in, you basically shook your head at the rally yesterday, and you said, anytime we see a move up such as this, it's not a good thing.
Yeah.
And you pointed to 2008,
right?
And you said sure enough, the superlative was going back to 2008. You reminded all of us the market did not bottom until March of 2009.
Yeah, this is something we did earlier this week. Is just looking at these major capitulation moments in the S&P 500 and put them in context of what's happening in the fundamentals. And what you do find is that the big sell-off, VIX spikes, capitulation moments, whatever you want to call it, distress tend to happen way earlier than the ultimate bottom occurs. Whereas you can use things like capitulation, VIX, pairwise correlations, whatever technicals you love to show capitulation. You can use those for timing bottoms when the bottoms are a little minor 10% corrections that are not necessarily affiliated with major economic distress. But the simple fact that we're in this period of extraordinary uncertainty, and our other models, our more fundamentally oriented models, are telling us that the economic downside has really yet to be fully priced in the S&P 500, that kind of context would suggest to us we could be in for a more extended period of volatility, even if the volatility never reaches the levels that we got with Liberation Day.
So even though we're like off our lows, I mean, like how are you thinking about like how we end up today and what's important coming off of yesterday's rally?
I think the most important thing to watch right now, frankly, is fundamentals. I think that the market is going to be volatile. I think it's going to jump around. It's, you know, I wouldn't be surprised in any given day if we're up 5,000 and down 5,000.
The VIX kind of tells us that, right? A little bit.
Hold on. Say that again. Up what?
5,000 or down 5,000 on the Dow, not the S&P 500, which of course is at 5,000. It's a huge move.
That's a huge move.
Yeah. So I would not be surprised to see extreme volatility because our sensitivity levels to any kind of policy movements right now are enormous, right? We saw that yesterday. What I think we want to keep our eye on now is what are companies telling us throughout this earnings season? Are they going to start pulling guidance because that's usually a sign of pretty extraordinary uncertainty? How are they navigating this crisis? Are they planning to push costs onto the consumer? And then further, are they starting to change their operations in response to the tariffs that are enacted?
We've kind of heard that that's happening already. We heard CarMax and Delta this week. Amazon CEO Andy Jassy said, and I'm going to get this, I'm not looking at exactly what he said, but the gist of his comments were, we think that producers will pass along the increased cost to consumers.
Yep.
That's happening.
Yeah, and I think they'll try. And then
What do you mean try?
I think they'll try to put those prices out on the market, but will
Can
the
we handle
consumer
it?
accept those prices
Right, if you
or
don't
not?
buy it, right?
Or also, is there a substitution, right? I think that this is very interesting in the context of China in particular, which provides an enormous amount of our consumer-focused goods.
Is there a substitution there?
Is there a substitution? Does the consumer have to take the price? And then the consumer only has so much disposable income to go around. What are the alternative categories that they have to cut back on in an environment of accelerated price? Because we know wages are only growing at a single-digit pace. Tariffs are already coming in at 26% on average. That's a whole lot faster than wage growth is, and especially for the lower-income consumer, could be very, very meaningful at driving the ultimate pie and how they slice up that pie of income in their spending.
Bank earnings.
Yes.
What are you going to be watching out for?
Oh, I think this is going to be really interesting because we've seen such a tightening in financial conditions. Our sector strategist, Mike Casper, runs a macro model of financial sector earnings. And one of the things that model told us earlier this week is to expect financials earnings to be about half as much as consensus is anticipating. That's in terms of a growth rate. So some sensitivity coming for financials because we've seen such tightening in financial conditions. So what does that mean? What do we look for then? How tight are financial conditions, and are banks starting to prepare for a downturn? Because you would see loan loss provisions accelerate. You would see bank sort of lending get tighter. You would see them talk about the credit quality, what's happening with delinquencies and default rates. Those sort of indicators are things that we want to watch for in the banks specifically.
Well, we got a little clue, right, from Jamie Dimon being on Fox and talking about the prospect of recession.
What about basic day-to-day movement of customer funds, what they're doing with their debit cards, what they're doing with their credit cards, how they're doing paying this stuff off.
Yeah, I think that that's a great point, because you can get a lot of that data now in today's world of alternative data.
Yeah.
You can get a
So
lot of that.
You don't need to wait for the banks. You don't need to wait for Bank of America or Brian Moynihan to tell us what's going on there.
How are consumers actually handling this situation? What are they spending on? You could get that out of MasterCard data. You could get that out of all kinds of second measure data.
Are you seeing anything of concern there?
You know, I haven't looked in the second measure data that's available on Terminal. It's something I'll put on the to-do list, the laundry list of to-dos. It's something we should definitely do in advance of the consumer sector earnings season, especially. I think given that tariffs really just got implemented, we're at the point where we can start to really follow that data series. But it's not something, I have to admit, it's not something we've really tracked too much.
You do follow the economic data. So what's the next data point you're thinking about here?
Oh, God.
I know earnings, obviously, but...
So we have consumer prices and producer prices this week. We're sort of in the midst of getting those indicators out now. I think the Fed is going to be absolutely critical to watch. You know, what tends to happen in the sequence right now is the market starts to acknowledge that recession risk is real. They start to follow the earnings numbers, and the analysts will mark down their expectations. And then the market will feel so lost and confused that it starts to look to saviors, right? It looks to the Fed, and we've already seen how the market looked to the White House as a potential savior from this. I think the market will start to really push on the Fed, and how much will the Fed be able to respond in the environment of inflation and growth is going to be absolutely critical. I think the job market is also really, really interesting right now. Challenger layoffs are at levels we only usually see in recession experiences already. So we're getting the layoffs there, but we're not seeing it in the non-farm number. Why are we not seeing it in the non-farm employment? Why are we not seeing it in the unemployment rate? Some of it, I think, is just survey. Some of it is we're still creating some jobs to offset those layoffs. Will we see job creation then start to slow? And will we also ultimately see the unemployment rate start to rise? Because those are really key triggers for the Fed.
I'm going to ask you the question that I asked you yesterday, but a day has passed and we have new data.
Yes.
Are you more or less concerned today than you were when you walked in yesterday?
Oh, I'm still very concerned. I don't think it's changed a whole lot.
It hasn't changed at all.
I think if anything, the only thing that I can say is at the very least, it does look like we had our panic. Our major first big capitulation event has happened.
Yeah.
I mean, does that make me feel really better that we won't have another one? Not necessarily. You know, I think that this whole the tariff situation is just incredibly uncertain. We still have average tariffs to contend with of 26%. Even if it's 10% on everybody, that still is a big sea change for the economy to contend with.
That's what we were thinking about. Or we had some guests yesterday. Maybe it was you too, who just said, look, let's not forget 10% in any given environment. Tariffs would be a big deal.
Yeah, huge deal, considering we're coming from an average tariff pace that had been close to 3.
All right, we're going to leave it there. Gina, thank you. So appreciate it. Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence, our go-to every day in terms of the trade. Tariffs, we heard a lot about tariffs at the White House today from President Trump.
Yeah, tariffs on Chinese imports are at least 145%. We heard White House National Economic Council Director Kevin Hassett say that trade talks with some U.S. counterparts are already well along, including deals that were close to done last week.
A wild 24 hours. I hope you're keeping up, everybody. Bloomberg News White House correspondent Stephanie Lai has to keep up. She's out there at our Washington, D.C. News Bureau. All right, where are we? The latest. We know the president held his cabinet meeting. Negotiations with countries. What are we hearing? Update us.
Certainly. So the president did not mention whether or not he was speaking with President Xi as of yet. There really is no word from the administration as to if conversations have been happening with China. However, with other allies, there has been discussion among some of his economic advisors that there will be deals underway. This morning, Kevin Hassett had told a various number of news outlets and reporters that the U.S. has already been in discussion and that they have about 15 deals that are in the works right now, as according to the USTR.
But does he really know? And the only reason I say that is I feel like Tim and I have been talking about this, different reports about who's saying what, and then the president comes out and says something. Like, who really ultimately, is it what President Trump decides in any given moment, or is there somebody who really has his ear hour to hour?
Yeah, so the president said just an hour ago in his cabinet meeting that most of the discussions are being led by Secretary Bessent and Letnick, and that President Trump is looped in on these conversations. Kevin Hassett also earlier this morning tried to insinuate that there is a orderly system for how this gets done, that the Chief of Staff, Susie Wiles, is coordinating all of this with the secretaries who then will make the deals and run them by Trump.
I anticipate, Stephanie, this is going to be on a country-by-country basis, but do we have any idea what a deal looks like when it's done?
It's actually funny that you mentioned that, because Hassett himself said, you know, it's kind of an open question right now what a deal is, or what they're considering an offer from these countries. And so really it does seem like something that is an open conversation between the two nations to you know, try to bring down the tariffs.
Look, again, country by country here, you know, we're not just talking about China, or we're not just talking about a trading partner such as Australia, or maybe even the entire European Union. But what's on the table to satisfy the president?
You know, it's not just trade. Just yesterday, Trump had mentioned that he's also open to a number of other projects. One big one that he's mentioned quite a bit is LNG plants, and there's a number of things that he's just trying to get, and concessions that he's trying to extract from our trading partners.
I'm just thinking about kind of where we go next and what the expectation is. Because I do feel like the president tends to kind of gear up Monday, Tuesday in a big way, and then kind of wind down heading into the weekend. But we're living in unusual times, safe to say. I'm not going to say that. But so what are we expecting tomorrow in terms of the president? Might we hear some updates?
Yeah, so tomorrow what we know right now is that he is going to travel back to Florida for the weekend. As you note, he tends to wind down, but that doesn't mean that the work stops. You know, what some of his economic advisors have been saying is that the work is really just ramping up now, and that they're having these conversations with the trading partners, and that for the next couple of weeks, we should really expect a lot of world leaders to be coming to Washington to be having these conversations with the president. So, you know, as much as this is behind closed doors, we might also get a glimpse of it playing out in real time.
Well, you know, I asked general questions to you about what a deal looks like with, you know, country X or country Y. The elephant in the room is certainly China and the 145% tariffs that are on the country right now, Stephanie. What does a trade deal with China look like based on your reporting?
Yeah, I think it might be too premature to say. Obviously, they haven't seemed to even have communicated yet. Not only is the conversation centered on tariffs, it's also, we know, it has derailed the TikTok deal. And so one big aspect of these conversations will also be, how does the U.S. move forward with the TikTok deal, specifically if they would move forward with the Oracle proposal, and that, of course, would need buy-in from the Chinese government. And now we had reporting last week that that was already in the works, that the Chinese government was informed, and that ByteDance was helping usher that deal into fruition. But because of the tariffs, that was derailed, and we saw the president extend the deadline. And so when it comes to a deal with China, that will most certainly be one of the aspects of the conversation.
I think there's also a notable entertainment angle here, Carol. Disney shares are down by about 6.5%. Early this morning, we learned that China will reduce the number of imported U.S. films and introduce more films from other countries. Disney got about 10% of its revenue from Asia Pacific last year. The president was asked about this. His answer, quote, "I think I've heard of worse things."
Yeah. What?
He was asked about this specifically during the cabinet meeting by press. He said, "I think I've heard of worse things." Yeah. As in like, it didn't really bother him. That was the takeaway that I had.
It's interesting because when I think about the movie studios and content and getting distribution in Asia, this is something when trade talks have come up over the last decade or so. This has been a big issue of contention, so something we'll continue to keep a watch on.
The studios worked so hard to get into China, and they work with every film to make sure that it works in China.
Exactly, right. It's very tricky in terms of changes and meeting, you know, certainly what the government will find acceptable. Stephanie, thank you so much. Stephanie Lai, Bloomberg News White House correspondent, joining us from D.C. All right, folks, that's going to wrap up this first hour of Bloomberg Business Week. We are looking at a market where the S&P 500 is down about 3.2%. NASDAQ 100, it is down about 3.8%. Dow, down 2.5%. We're definitely off our lows of this session. If you're watching on TV, the close is coming your way in just a moment. Tim and I continuing right here on Business Week.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. On Wall Street, the Dow is tanking again after news that the Chinese tariffs are at 145%. Jennifer Jacobs reports from the White House, though there are signs both sides are willing to negotiate.
I think President Trump hopes that China makes the first move, and then the Chinese coming out with a statement saying, hey, listen, we've been clear and consistent that we're willing to have talks. That's a message that they've had for a long time. They're not just saying right now.
The Dow is off 924 points. CBS's Jill Schlesinger watching the numbers.
So much of investing is about confidence. And it's very difficult to have confidence in an administration whose policies change day by day. And it's very difficult to build confidence once you rob confidence by making herky-jerky moves all the time.
It's not just investors who are worried. Here's CBS's Michael Wallace.
A survey by Harris X and Allison Worldwide finds Americans expect car prices to rise by more than 14% over the next year. Olivia Ojeda of Costa Mesa, California, has to buy a new car. Her old one caught fire.
The people that get impacted are me.
41% of those polled say they are very unlikely to buy a car. That's up from 28% in February. Those who do plan to buy are leaning toward American-made brands and away from foreign models slapped with tariffs. Michael Wallace, CBS News.
House Republicans have narrowly approved their budget framework after satisfying some GOP holdouts who wanted deeper spending cuts. Democratic Senator Chuck Schumer gives it a thumbs down.
House Republicans plowed ahead on a morally and financially bankrupt plan to gut Medicaid while cutting taxes for billionaires.
Secretary of State Marco Rubio said today he hopes nuclear talks with Iran this weekend lead to peace. Iran's supreme leader said his country could expel nuclear inspectors ahead of the talks. The U.S. just said that would be a miscalculation. Health Secretary Robert F. Kennedy Jr. says a large-scale study is underway into the cause of autism. He called it an epidemic and said by September we will know the causes. The CDC is stepping up its vaccination advice in the wake of the measles outbreak. Alexander Tin has that.
The CDC is now backing stepped-up recommendations for measles vaccination for Americans traveling to areas within the United States affected by this year's record measles outbreaks, including parts of Kansas and Texas. That means a second dose for many adults who were previously considered up to date with just one dose, and a shot of the vaccine ahead of schedule for many children.
The World Health Organization is calling for greater efforts to combat measles. It's spreading in 58 countries. This is CBS News. A mega deal in the world of high fashion. CBS's Vicki Barker reports.
It's Versace.
Just weeks after Donatella Versace stepped down from the fashion house founded by her late brother Gianni, another era is ending for the label. Luxury Italian brand Prada has just announced it's buying Versace from U.S.-led Capri Holdings for close to $1.4 billion. It marks the end of Capri's attempt to create an American luxury group to rival its European competition. And analysts say it will allow Prada to diversify its portfolio and compete on a larger global stage. Vicki Barker, CBS News, London.
Do kids perform better in school when they're given universal pre-K? A new study claims they are often better prepared in math and reading than kids who don't have the free programs. On the other hand, the study notes their improvements tend to fade with time, suggesting kids still need support in early elementary school. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec. Live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, is it Friday yet?
No, not even close.
It is Friday's Eve, everybody, so don't
You've
despair.
got like an hour to go until the close of equity trading here, Carol. And then you got all day tomorrow, friend.
Hey, listen, just quick check on the markets, folks. We're off our lows of this session, but still down on the S&P 500, down about 2.8%. NASDAQ 100 down 3.4%. Looking at the S&P, 401 names to the downside, Tim, 102 to the upside. So very different tone from where we were 24 hours ago yesterday.
Yeah, the S&P 500 at one point was down the most since 2020. In the bond market, long-term treasuries tumbling. We are going all in on markets over these next 2 hours.
Yeah, it's all about tariffs, right? Oh, once again, investors worried about the tariffing impact, what it means for the global economy, what it means for the U.S. economy. So we're going to talk with someone who's been quite a bull in the market, and he's made really good calls over the last couple of years. We'll see what Ryan Dietrich has to say in just a moment.
Hey, first up, though, a check on the day's trade and top business stories. Here he is, Charlie Pellet.
Thank you very much indeed. 54 minutes to go ahead of the closing bell. Keep it locked into Bloomberg Radio for the very latest. That's what we do here at Bloomberg. We keep you up to date on what's happening with markets and, of course, excellent first-rate analysis. Here's where we stand. We've got the S&P 500 index down now by 2.9%, well off session lows in the late morning. We did see the S&P down more than 6%, but right now down 158 on the S&P 500 index. The Dow down 883, now down 2.2%, and NASDAQ lower by 625 points, a drop there of 3.6%. The 10-year 4.39%, with the 2-year that's currently yielding 3.83%. Spot gold up $91 the ounce, higher by 3%, $31.73 on the precious metal. West Texas Intermediate crude was trading below $60 a barrel, $60.36 right now. It is down 3.2%, and Bitcoin down now by 4.4%, 79,527 on Bitcoin. Economic angst enveloping every corner of Wall Street as U.S.-China trade tensions escalate. As for the economic outlook, Lauren Seidel-Baker is an economist at the Institute for Trend Research.
We still see general growth this year and for the next, I'll call it 3 to 5 years. But the risk with tariffs, once we finally do get certainty on tariffs, and that is a big wild card at the moment, the risk, I think, is that this takes growth slightly lower. I don't think it takes it negative, though. So we are not forecasting recession even with this tariff impact.
Lauren Seidel-Baker of the Institute for Trend Research. China has announced it will curb imports of Hollywood films, opening a new front in its trade war with the U.S. hours after President Trump's record tariffs took effect. Media stocks hard hit today. Case in point, the Walt Disney Company down 6.4%. Shares of Paramount Global, they're down by 2.4%. But Warner Brothers Discovery, that stock now plunging by 13.7%. Again, keep it locked into Bloomberg. The S&P down 3.3% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for the update, Charlie.
You ready for this?
I'm ready for it.
I've been waiting.
Well, Ryan Dietrich has been a U.S. stock optimist and right about his market and recession calls over the last couple of years. He nailed it in 2023 and 2024. And when we talked to him in December, he said the bull market had more room to run. So given the volatility and the declines that we've seen, including today, it's time to check in with him again. Ryan Dietrich is a chief market strategist at the Carson Group. They've got about $42 billion in assets under management. He joins us from Cincinnati, Ohio. Ryan, are you still bullish?
Boy, first off, thanks for having me back. You know, we are. I know it's been